That's only from the Asian session. It actually dropped off by around about 1% overnight on the back of that US dollar strength. And that, I suppose, has helped the materials sector a little bit in terms of just their dealing in US currency for their commodities, but even still absolutely hammered when you take a look at the iron ore miners. They're all off by around about 2.5–3%. There are some signs of positivity when it does come to Australia's gold plays, but only just. They're basically mostly riding the flat line in trade today as the market does shift a little bit risk off. But the biggest losses that we are seeing across the ASX 200 today is most definitely in the infotech stocks, really playing off that tech sector weakness that we have seen on the US markets overnight. So you've got the likes of Afterpay off a further 4%, Appen off almost 7%. So it really is taking a battering Australia's tech sector. Plus, we are also awaiting the latest out of the Virgin Australia creditors meeting that actually got underway at around about 8 o'clock Singapore time, so around about an hour and a half ago. We are waiting to see what the decision is when it does come to the voting on Bain Capital's proposal and what this could potentially mean for not only the creditors moving forward, but a vast swathe of their workers that are going to be hoping that this Virgin Australia airline can enter into the domestic market and perhaps ensure that they retain their jobs, Tanvi.
Oh, yes, indeed, and we'll be closely monitoring that vote. Well, thank you very much for joining us with the latest on that story. Over in South Korea, the Kospi doing this in the session, like I said, being pulled down by the kind of sentiment that is prevailing in the rest of the region, which is a downer. So a downer for the Kospi. Pretty much that's the case with the Kosdaq. The tech-dominated index actually is outperforming on the downside, so 2% lower for that one. And for the Korean won, we are drawing a flat line at 1189.62. The country saw its largest current account surplus since October last year, coming in at $7.45 billion for the month of July. But drilling it down to specific South Korean heavyweights first, and it's a sea of red across the board. For Samsung Electronics, also down 1%. SK Hynix actually bucking the trend, so higher about 0.7%. But like I said, and I may be sounding like a broken record in this one, the sell-off across Asia is not as bad as what we've seen in the overnight session on Wall Street. The big tech names then, flip over and take a look at those within the region, and some pain continuing for that pack. Healthcare-related stories in Korea, we need to flag those as well for the benefit of our viewers. And given that the rally was strong here, we are seeing some reversal play out as we speak. Okay, up next, after a very short break, Broadcom beats on earnings, is bullish about its business. Our next guest has an outperform rating on the stock. We'll get you the word on the street from Stacey Rasgon from Bernstein Research on the other side of this break. The stock in after hours, however, down 2%.
COVID-19 has really taken a heavy toll of the economies of many countries in Asia and elsewhere, and particularly the lower income countries. That is why, as a multilateral development bank, we would take a flexible approach to provide liquidity support to those countries. But we understand this is not something which can be dealt with very soon. So we are working with the government, and we also would like to work with the private sector.
Next, managing Asia, Sunny Verghese of agri-food giant Olam International.
Africa alone, 150 million people have lost jobs during this crisis. The health pandemic is now become a hunger pandemic. Our first focus is to help the most vulnerable parts of the population to get them food.
The group CEO of Olam International on the next managing Asia.
Welcome back. You are looking at U.S. chip stocks in the previous session. Not a pretty day, and it was a sea of red for the semiconductor plays stateside. Broadcom wasn't spared from the rout in that chip sector. The stock also slipping in extended trade despite a beat on earnings. Now, this comes after the chipmaker did warn about a delay in its shipments, which could mean that the next Apple iPhone will arrive later than its usual September launch date. Well, CNBC's Josh Lipton has more on Broadcom's earnings.
Broadcom reporting Q3 earnings per share of $5.40 versus expectations of $5.24. Revenue $5.82 billion. That's also better than expected. The street was closer to $5.76 billion. As for the forecast, Broadcom is guiding for Q4 revenue of $6.4 billion, plus or minus $150 million. Street was closer to $6.2 billion. As for their two big segments, Semiconductor Solutions comes in at $4.21 billion, and Infrastructure Software comes in line at $1.6 billion. That's mostly enterprise software. CEO Hock Tan with a statement here saying our outlook for the fourth quarter reflects, he says, a strong anticipated ramp in wireless, as well as the continuing surge in demand for networking from cloud and telecom customers. Says that more than offsets expected softness in the enterprise. Josh Lipton, CNBC Business News, Atherton, California.
Okay, let's focus on Broadcom. Let's get the word on the street on this one. Stacey Rosgan is the Managing Director and Senior Analyst, U.S. Semiconductors at Bernstein Research, joins us live from Los Angeles. Thanks very much, Stacey, for your time this morning. Good morning to you.
Good morning to you. Good to be here.
The sell-off, the reaction that came to the earnings, it was a bad day because tech was generally off. But do you think it's an opportunity to buy the stock? Sorry.
So look, everything today in the sector sold off. I mean, you have the broad profit taking in tech and semis, and I think Ciena's report also spooked things. So that's why one reason Broadcom got hit a little worse than the sector today, because of the networking exposure. The numbers on the print were very good. The quarter was a nice solid beat. The guide was a very solid beat. They even had enough wherewithal to sort of give some visibility into Q1, and it's looking like Q1 is pretty strong as well. I think the big worry here obviously is just going to be around the sustainability of this, and I think that's why it's slipping still a little bit in the aftermarket, along with I think everything else in tech right now. There's just a lot of uncertainty out there, and especially when we're hearing divergent things from different companies. You've got some companies that the outlook is okay, like Broadcom. You've got others in peripheral parts of the market, like Ciena earlier this morning, that were not quite as optimistic about things. It raises the uncertainty, and people start to worry about how sustainable is the profile that we're seeing, and I think that's why it's a little weak. But the numbers overall were very, very good.
Yeah. No, exactly my point. So that being taken on board, Stacey, you have an outperform rating on the stock with a price target of 335. Have you revised that post-earnings? Because the stock is way higher than that. And how would you compare Broadcom to the likes of NVIDIA, as well as some of the other key names, Qualcomm, which is a direct competitor in this environment?
Qualcomm's not exactly a direct competitor all that much. They play in different parts of the market. And even within Apple, they're selling different things into Apple. So they're actually both benefiting from the Apple cycle coming forward. Yeah, in terms of the price, we haven't revised anything yet. I mean, this was our target from 3 months ago, and certainly the stocks have all run quite a bit. And this is one thing I think people need to keep in mind. Like, semis got whacked today. They're all the way back down. The SOX's index is all the way back down to where it was on Friday. It's not like things haven't been on a tear recently. And so the fact that we're seeing a bit of a pullback now, maybe it's not entirely a shock, but I don't want people to get too worked up about it just yet. Things are still, at least the sector, I mean, even in the middle of a global pandemic and a potential recession / potential depression, the sector is still holding up reasonably well in the wake of all that, even with the pullback that we've seen.
Yeah, I mean, it's all relative, Stacey. I mean, we can't divorce this from the extraordinary run we've seen in many of these names. When you talk about sustainability, though, going forward, I mean, one thing we heard from Broadcom once again is that they're benefiting from the stay-at-home, work-from-home trend because of all the demand that requires for stay-at-home offices, too. Do you think that stays intact even as the pandemic situation eventually, hopefully, improves?
Yeah, so look, we're seeing a lot of that strong demand. It's not just Broadcom. PCs, broader cloud demand, anything that's fueling that is certainly strong. It's been strong, and it seems strong for now. At some point, that will start to slide off. I mean, it has to. But I do think it's plausible to postulate a scenario going forward where, at least work from home is higher than it was a year ago, even if it's not quite as high as it is right now where everybody's home. I think at least parts of this are probably sustainable. Now, that being said, areas of the market that have been benefiting greatly from work from home, things like, for example, PCs, some data center and that sort of thing. At some point, like we're obviously pulling forward demand there. Like we'll see some kind of a digestion phase there. I think there's a broader concern, and not just for Broadcom, but I think like more broadly for the sector. There was concern broadly that because of demand uncertainty and the environmental uncertainty, and we've had supply chains that have been disrupted, that there's been some broader pull forward of demand in general for the sector. I think investors, certainly have had that worry, even though the stocks have been going up. And now that we're starting to see at least some end customers and others start to show some signs of weakness, I mean, those kinds of fears going forward will come back to the forefront. I think that's what's going on right now, too.
Okay, and given that the selling in the sector has been broad-based, almost indiscriminate, if you will, Stacey, I mean, if you're out there and you're thinking, okay, I want to buy in the dips, is there a name that sticks out to you that looks better positioned in the pack?
Yeah, I'll be honest. I'm kind of liking Qualcomm here, and so we upgraded the stock a month and a half ago. And you have to sort of keep in mind, Qualcomm has been death to own for half a decade because of a number of potentially existential crises that they were facing. They were effectively going to war with their biggest customers, and the regulators were just coming down on them. All of that is basically done. Most of the regulatory issues have now been put to rest. They finally settled with Huawei, so that was sort of their last big outstanding customer dispute. And it's a lot cleaner now because smartphones are one of if you're looking for things that have not been strong and have not been benefiting from work from home, and that actually are cyclically low and could potentially recover, I think smartphones are one of those. Smartphones have been weak because they're not viewed as necessarily critical on work from home. There's also been a transition. We're moving from 4G to 5G, so 4G smartphone shipments have fallen off a cliff. And we're at a cyclically low point right now. You go into next year, presumably or hopefully smartphones can actually recover just cyclically. We've also got the Apple cycle, which is about to kick up the 5G cycle, and then the broader 5G cycle. And now that the structural issues are sort of clear, I think Qualcomm's poised to benefit from that. And the stock, where numbers are likely to go, the stock is actually relatively inexpensive, versus where some of the valuations we're seeing broadly in the space. I like Qualcomm.
Right. Stacey, we need to wrap up in a short while. So very quickly, what's your call on NVIDIA on the back of Mellanox's earnings and rather revenues coming in from that tie-up, and also MediaTek that's done really well from mid-March lows?
Yeah, so I don't cover MediaTek. It's a colleague of mine, so I won't comment on that. For NVIDIA, however, again, we like NVIDIA, and look, the valuation on it it's a little hairy. It always is, but at the same time, within tech, you never sell stocks just because they're expensive. You never buy them just because they're cheap. With NVIDIA, we're in front of two product cycles: data center, which has just kicked off and it's going very strongly, and gaming. They just released their new gaming products officially the other day. Gaming looks like it could be a monster cycle. So we're right at the beginning of both of those. The narrative has not changed at all. If anything, it's getting stronger. Numbers are going up. I think even here you stick with it.
All right, Stacey, thanks so much for joining us. We do appreciate you bringing us your insights on this very important, busy day for the sector, that's for sure. Stacey Rasgon there from Bernstein Research. Well, lots more coming up for you in the second hour of Street Signs, including Virgin Australia creditors voting on a takeover plan from Bain Capital today. We'll have all the details for you coming up in the next hour of Street Signs and much more. Stay right here.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
our viewers. You're watching the second hour of Street Science, and I'm Tanveer Gill.
And I'm Nancy Hungerford. Let's get to your headlines this hour. Asian markets in a sea of red after a sharp sell-off on Wall Street. The Dow losing more than 800 points as the tech wreck erases a full week of gains.
The market drought hitting the wealth of the world's top billionaires, wiping out $25 billion from their net worths. Amazon's Jeff Bezos and Tesla's Elon Musk feeling the most pain.
And it's decision day for Virgin Australia's creditors as they gear up to vote on Bain Capital's proposal to revive the moribund carrier.
Live from CNBC studio at the Singapore Exchange, this is Street Signs.
Top of 10, take a look at Asian markets right here, right now. And it's a sea of red, but we're not seeing deep red across the board. Yes, on average, losses are between 1.5% for the major markets. The ASX 200 doing worse than the rest of the pack. The rest of the regions are down about 2.5%. But like I pointed out, for the Greater China markets, for the peripheral markets, for the main markets, it's a day which is one of nervousness on the street, but not a whole lot of nervousness if you compare to what markets did in the overnight session on Wall Street or in the US. Okay, let's get the lay of the land, as always, across Asia. Will Kluris is tracking the sell-off down under. Sam Vadas is watching the movers in China. But let's first get out to Sherry Kang, who's got her eyes on Hong Kong. Sherry, good morning once again.
Good morning, Tanveer. So I actually want to start off with taking a look at the volatility index for the Hang Seng Index. Is this anything disorderly? I think that's really the main question that a lot of investors and a lot of us on CNBC are asking. So it's actually up 8.3%. And I gave you 12-month chart on purpose to give you what we had at the end of March. And then, well, the volatility index has been coming down quite a bit. So just to show you that this is nothing, very much of a disorderly kind of action at this point. In the meantime, though, technology is certainly the big loser when it comes to the Hang Seng Index. All sectors are out of money. The sectorial landscape is very much intact. Tech as well as consumer cyclicals are leading the losses on the Hang Seng Index. In the meantime, we do see some, relative outperformance when it comes to sectors like utilities as well. As you can see, the Hang Seng Tech Index, that's the perfect gauge when it comes to days like this, down 3.6%, although it is actually coming off from the lows that we saw right at the market open. In the meantime, let's give you some individual movers by taking a look at some of the top heavyweights on the Hang Seng Index. Well, most notably, I should say, Tencent Holdings, continuing with its losses from yesterday, down 2.8%. Financials are also hurting, with the exception of a CCB at this point. And bear in mind, we've got some rebalancing act happening with the Hang Seng Index at the close today. And of course, Alibaba, Xiaomi, as well as WuXi Biologics will be joining the main benchmark index starting on Monday. But these names are also deeply in the selling side as well. Really quickly, one individual movers, SMIC shares under a lot of pressure at one point, hitting that 2.5-month low. This comes on the back of IFR reports suggesting that China IC Fund has basically sold out of this chip maker shares by raising $533 million. This kind of sell down is actually explained with that 4% discount compared to Thursday close. Well, the stock is down 4% at the moment. That's a quick check on what's happening here in Hong Kong. Now let's get out to Sam for a check on the mainland Chinese market action. Sam, take it away.
Thanks very much, Sherry. And just over half an hour into the trading day over on the mainland, and the markets are under pressure this morning. The Shenzhen Composite down around 1.6%. The Shanghai Composite also edging lower. The US dollar Chinese yuan is trading at 6.8409. We are seeing almost all the sectors in the red this morning, dragged down largely by consumer non-cyclicals and healthcare stocks on both the major indices. Telcos over in Shenzhen are the only actual patch of green there. It's not a good start to the trading session for Inbang Clad Material. This is one of the defense-related stocks that we have been tracking this week after it surged amid these rising tensions on the China-India border. It is pulling back again this morning. It's one of the worst performers over in Shenzhen. We are also seeing a lot of weakness coming through through the tech stocks for a second day now on these rising tensions with the US, but also with India now, which has now banned more Chinese mobile apps, which has, of course, angered China, which has now come out and said that India's actions violate the legal interests of Chinese investors and service providers. Now, it comes after the benchmark index actually suffered its steepest one-day decline in more than a week yesterday as investors pulled out of consumer stocks on worries about high valuations, but also amid these rising tensions with the United States. This has been weighing on sentiment despite that encouraging PMI data we got yesterday that showed the services sector grew for a fourth straight month as companies have been hiring more people. Broadly speaking, investors have been betting on this first in, first out sort of story that we've been seeing in China, but really the friction between the world's two biggest economies does appear to be sort of overshadowing some of this optimism of the economy really picking up speed in this recovery. And in the latest, China says it will make legitimate and necessary responses to new restrictions on senior Chinese diplomats in the US after US authorities said that Chinese diplomats would actually need approval by the State Department to enter university campuses over there and hold events outside the Chinese embassies, so perhaps weighing on sentiment over on the mainland as well today. But that's a quick check on the markets. Let's head over to Sydney with Will Colores.
Hey, Sam. Well, the ASX 200 absolutely getting thumped in the session today. It's off by around about 2.6%. We did see that weakness coming through for the Australian dollar overnight as well, off 1%. Right now, we are sitting at 72.72. We did get some retail sales data coming through for the month of July. After that preliminary read of 3.3%, the official full month read actually came in at 3.2%. So it really was a strong result. Ex-Victoria that actually did see a considerable amount of weakness that is to be expected due to the coronavirus outbreak down there. But in terms of the market activity, it's been an absolute sour session. All sectors are in the red, and even the one bright spot that was evident earlier on in the session, the gold miners, are mostly now all in the red as well. And the tech stocks of those, when it does come to the biggest hit sectors, they're what's seeing the biggest amount of losses. You got Afterpay off well over 5.5%, Appen off around 7%, and the rest of the wax stocks, as they are known here in Australia, are deeply in the red. We are still also awaiting any news out of that Virgin creditors meeting that did start around about 2 hours ago. There was expected to be some presentations and two separate votes that did have to take place. And this is coming alongside the National Cabinet meeting today that is basically all about those border controls. So hopefully for Virgin Australia, they're going to see some progress on the National Cabinet side in terms of states opening up their borders. So once this vote does go through, whether it has to be an administration process that's going to see creditors get 9 to 13 cents in the dollar, whether it's a liquidation process, if the vote gets turned down, Bain Capital will still be in control, and then Virgin can maybe take advantage of some perhaps weakening of these broader restrictions and really start to hit the ball rolling when it does come to their domestic side activities, because that is going to be the key, whether or not they can secure enough market share to remain profitable here in Australia in a time where COVID-19 has basically decimated the domestic travel market, guys.
Yeah, something we've seen in travel markets around the world really well. Thank you so much for bringing us the very latest. Well, let's get back to the broader market picture. I'm pleased to say we're joined by Gary Dugan, who is CEO of the Global CIO Office, joining us on the line from Singapore. Gary, good to have you with us today. Let's just get your reaction to what was really a tech sell-off overnight in Wall Street, spilling over into sentiment here in Asia. I mean, are you in the camp that thinks this is perhaps a healthy dip, looking at it as a buying opportunity, or the start perhaps of a bigger correction?
I think we could see a bigger correction. The index was very extended. If you look at where the index level was relative to normal support levels of 200-day moving averages, it was like 4 standard deviation events. So there probably is room here for a further correction. It's just how much interest there could be from retail investors who are all clearly moving out of cash accounts and bonds, looking to buy equities. So they would see dips as buying opportunities. So it's a battle between getting back to a normal level and this interest from retail accounts.
Okay, so if you're talking about a further correction, let's say stateside for the S&P 500 and the NASDAQ, what does that mean for your position out here in Asia? Because at the moment, we're seeing the weakness follow, though, by not the same magnitude.
Yeah, so to be honest, I think for choice, international investors are looking to buy into Asia. So I think they would be buy on the dip investors. I think they see, a market that has not performed as well as the S&P, or certainly nothing's performed as well as NASDAQ. So they've lagged, and therefore they shouldn't get beaten up on a kind of a localized tech sell-off.
Fair enough. Gary, good morning. Tanveer joining in this conversation. If you're talking about this correction getting a bit more extended, then what will be the key catalyst for that running into the next few months? And do you think it's largely linked to election risk?
I think it is. I mean, the stories you've seen today of, China going to source more of its tech products, such as semiconductors, within its country rather than using the United States. Now, these are longer-term pictures, but at the moment, people are trying to find the negative stories to bring the index down, as opposed to a few days ago, where everything was looked at in rose-tinted glasses and everything was fine. So there is a risk of further downside, and it could be, just as you suggest, one of the sectors that gets beaten up because of the tension between China and the United States leading up to the election.
So then how would you manage your portfolio right now? How would you manage the downside risk? And where would you find safety in this market?
Well, we've been still running some cash in the accounts, and therefore we look for buying opportunities, but we're only looking for, I would say, better value than the NASDAQ index. I think everyone's recognized that that's way beyond fundamentals, but it just has such momentum. Therefore, you're going to rotate, I think, still into sectors that will do well through the rebound from the worst elements of COVID. So you're still looking at consumer discretionary. You're also looking probably towards the banks and the financials, which, again, in many parts of the world are down 30 or 40% amongst the mid-cap banks in recent times. And that may, again, be offering a buying opportunity purely on the view that things are going to be okay and that you still want to stay engaged in the equity market.
Yeah, Gary, I mean, while we saw tech fall, I mean, the broader S&P index almost 6%, in fact. Financials were off about 1.5%. Energy faring much better, declining just 0.7%. Would you look to the energy space in this environment?
Not really. I mean, I think it just didn't do very much because it has fallen so far that people don't see the downside risk. But equally, you can't see the upside risk. Global growth is coming back, but we're not seeing sufficient momentum in terms of the demand for oil to overwhelm what is still, there's a lot of supply out there, and it could be brought back on stream. So no one's expecting the oil price to move dramatically, and therefore not really supporting much return from the energy sector.
What would it take then, Gary? I mean, to do a really sustained rotation here, because some people have said they want to see more information on a vaccine. They want to see that really come through. But we are starting to get more encouraging signs on a vaccine development. So this makes me wonder how you time it, right? Because you don't want to make the move on the vaccine development too late and then miss out on the gains.
That's right. I mean, I think everyone's out there with some kind of vaccine basket, stocks that are expected to rebound, rapidly when the vaccine comes through. But those include casino stocks, airline stocks, hotel stocks. And some of the better quality ones have not probably fallen far enough considering the backdrop. And the bad quality ones are down and don't get too much appetite. But I think knee-jerk reaction to a vaccine is a lot of those sectors will perform well. And it's no harm buying today because we're all hopeful that the vaccine will be with us within the next 3 to 6 months.
Fingers crossed. All fingers crossed for that, Gary. You spoke about how you are finding value in the financials that have been beaten down, in fact, have been underperforming the broader markets. But what about the risk of delinquencies? What about all that credit flow into the system coming back to haunt banks with essentially rising risk of default? How do you contend with that?
Yes, there is a bad backdrop, but I think it's been well discounted in the fall in share prices we're having. We're seeing the index in many parts of the world down 30 or 40%, which I think discounts the risk of these defaults. But remember, policymakers are helping the banks by providing liquidity, kind of situation we weren't in 2007-09 until the last. And secondly, although there will be defaults and damage to balance sheets, I think banks could get refinanced particularly easy. And I think they'll get great support from governments and central bankers. So, yeah, there's still bad news out there, but I think fully discounted in the sector.
Right. What about the COVID-19 hit businesses, travel, tourism, airlines? Do you see light at the end of the tunnel for them?
I see a small light. I think the problem I think most people have in buying these stocks is you've got to kind of forget the history of the share price. There's no way that those industries get back to normal. I think within the next 1 to 2 years. I think there's going to be still quite considerable spare capacity, which forces down the pricing or takes away their pricing ability to push prices up, and therefore suffering still relatively low volumes, even if they've rebounded from the worst. It really, they're going to struggle to get continued good performance out of these shares beyond the knee-jerk positive reaction to a COVID vaccine.
Gary, great to have you in the show, as always. Thank you very much for sparing the time to speak with us. Okay, time now for a short break, but coming up, a tech wreck rocking markets stateside. Apple, Amazon, Alphabet, Facebook and Tesla losing nearly $500 billion in market cap in one session alone. That's right. Are we on the verge of a true tech reckoning? We'll discuss that when we come back in 2 short minutes. Don't go anywhere.
We expect the second half of the year to remain very volatile. We expect the on-trade not to come back to pre-COVID level until there's kind of a more structural solution. Until that moment, it will be really 2 steps forward, 1 step backward.
The consumer demand will come back. We're confident about that. The pace of recovery, as you point out, is uncertain, and it's very local.
Countries got the crisis under control as much as you can control it. So we'll see how it goes, but obviously going forward there's some volatility associated with the probability that we will see a second wave.
Particularly in the Americas, you know, yes, there's a second wave, but there's still the first wave, which is ongoing. So lack of visibility, difficult to give guidance.
Within automotive, we have seen a certain recovery coming. China getting back, so is also Korea. So we expect that the worst is behind us.
US futures first. Take a look at what the implied open is suggesting as far as the benchmark indices go in the US. And a wobbly start is what you can expect in about 10 hours from now when trade begins this Friday stateside. Wall Street getting rocked by the big tumble in tech stocks. CNBC's Josh Lipton has a damage report on companies feeling the most pain.
Let's start with the world's most valuable company. Check out Apple, coming under pressure, falling about 8% in today's trade. Its worst day since March, now about 12% off its all-time high. But keep this move in context. It's still up about 130% over the past 12 months, up about 50% in the past 3 months alone. Other stocks that got clobbered, take a look at the SMH, the ETF that tracks the chips. Its worst day here since June 11th. And some of the hardest hit names included NVIDIA and AMD, Skyworks and Qorvo. Many of the chip names have benefited from that work from home trend that has meant more demand for everything from PCs to the data center. But chip analysts do say valuation after such strong runs is a concern for investors to think about. And finally, investors sold out of the cloud stocks too, the CLOU. Worst day since March. Among the notable laggards, high flyers like Zoom, Box, and Twilio. Again, though, keep in mind the moves all up triple digits since their lows in mid-March.
So there you have it. We've been talking about it in every passing minute of the show. The fact that there's been a big sell-off. For some, it would be a more welcome sell-off, given the fact that, they've been calling for one for a while. And given, I think one of our guests made a very interesting point. Given the liquidity that is waiting on the sidelines, Nancy, I would not be surprised if this dip would be bought into, even if this correction has more legs to run.
Yeah, I mean, if you look at what's happening with U.S. futures, we are looking at calls for a slight dip to continue in the NASDAQ. So perhaps it's not finished yet. Perhaps people are a little bit nervous when it takes some more profits on the table because it's all relative. I mean, this extraordinary run that we've had. And it's interesting, we've been asking the question of whether certain pockets of tech look too hot for quite a long time now. And people say, no, they can still go to the upside. Now everyone's saying no surprise, right? So that just shows you we've been in this frothy environment for a long time. If you need any evidence of just the kind of numbers we're talking about, take a look at some of the billionaires who lost out in the moves to the downside yesterday. I mean, we talk about these billionaires losing out, but in order to lose that much money in a single session, it shows just how much money you've made so far. Jeff Bezos losing $9 billion, Elon Musk right on par there, Mark Zuckerberg and Bill Gates.
You know how I always give context to numbers?
Yeah.
Together, they have $500 billion in their total net worth, right? 200, 100, 100, 100.
On paper, right? If you look at their
on
stock
paper,
holdings,
right?
yeah.
So this would be chump change for them. This is 5% of their overall net worth. So I guess they're not so worried about this sell-off just as yet. They have other things to be worried about. They're rich enough.
They are indeed. How do you define rich enough? But at these levels, I mean, it's pretty extraordinary.
Sky's the limit for them.
I will say, though, I do wonder if this will be an opportunity for investors to make some distinction here between names such as Apple on the one hand and Tesla, who have both been having a very strong run. But they may say, wait a minute, let's look more now at the fundamentals, not just this momentum trade that's taking place.
So on fundamentals, I want to quote Ashwath Damodharan here, the Dean of Valuation. You know, I was listening to him on CNBC US, and he said that 95% of our daily ecosystem, our daily life, is in and around these businesses. So he believes actually the markets need to catch up to that reality, and there's still some room to go. So on that debate on growth versus valuations versus the price that you pay, it's a never-ending debate, because some believe that these businesses are so deeply embedded in our lives that you can run the course with their growth and continue on a compounding basis to pay a premium for their businesses.
Yeah. Well, that's certainly been the story driving them higher for so long so far this year. So we'll continue to watch what happens next. And we will have much more for you on the markets after this short break, including a look at the big movers in Tokyo. First, though, check out how gold is doing today. We are looking at prices moving slightly higher, but just about 0.5%. So not a huge gain in what is perceived as the safe haven precious metal. Street will be right back.
We've all just lived through extraordinary days in the history of our country. It began with an explosion of shock and anger, but in recent days across the country, that anger has seemed to grow into resolve. It is said there's nothing more powerful than an idea whose time has come. Perhaps the time has come to fully realize the dream upon which this great country was founded: equal justice under the law. I'm Lester Holt. Please take care of yourself and each other.
In navigating markets,
green is the theme across the board.
What signs point to opportunities?
Gold hitting a near 7-year high.
In economic political crossroads,
Global slowdown grows. Central banks are feeling the pressure.
How do you brace for the risks ahead?
Debt levels in the world are rising.
Set your money on track with Nancy Hungerford and Tanver Gill. Get up to speed with the day's biggest moves, real-time updates, actionable insights, street signs on CNBC.
Welcome back with a look at the state of play on Japanese equities, and really the damage report not looking quite as bad as you might have expected given the dip we saw on Wall Street. The Nikkei 225 is off by less than 1% now. The Topix moving lower by just 0.7%. We did see the dollar moving against the Japanese currency, in fact, moving lower against the safe haven yen. At the moment, it is pretty steady on the session, though, holding at 106.14. A different story, of course, with the dollar against other currencies, as we saw the risk-off mood take hold overnight. Let's see how some heavyweight stocks are faring in the Japanese market for you. As you can see, fast retailing just slightly lower. It's SoftBank Group that is really trailing, which makes sense given all the emphasis on tech right now. It's off by 2.7%. Fanuc, though, lower by just 0.5%. And elsewhere, taking a look at some blue chips in Tokyo for you. Why don't we switch that board and have a look? And it is an uneven picture with the likes of Toyota higher by 1.2%. Elsewhere, Sony, Canon, Mitsubishi Electric on the back foot, but Toshiba up just about 0.6%. And one star performer to tell you about today, that is Honda. The shares have just been bucking the downtrend after announcing plans to develop new vehicles for North America with General Motors, working together in areas like engineering components and purchasing parts. Investors like what they see in that deal, and this is really an extension of further development of cooperation we've seen between the two auto giants in the past, Tanvir.
Well, yes, indeed. South Korean stocks are also in the red, like the rest of Asia. Let's get out to Sherry Kang, as always, once again, to get a quick check on the internals there. Sherry, take it away.
Thank you very much, Tanvir. So, yes, the Kospi is still tracking lower. The good news is that it's actually off session lows. Remember, right at the market open, it was down more than 2.5%, but coming back up and now trading at 23.59, and well, a bit of a recovery for the Kosdaq as well. Remember, this is a tech-heavy junior index, and that is down as much as 2%. And of course, when we're watching the dollar strength, the Korean won is really the loser here, but it is actually off the session lows as well. At 11.90 is really the handle. And when we're seeing a lot of investors going for something safer to figure out what this sell down means, at least when it comes to the Wall Street overnight and this morning, we've got South Korean Treasury bond yields also tracking higher as well. And when we're talking about technology weakness, obviously the Apple suppliers and the chip makers in South Korea are seeing that damage as well. But there is that exception as well, because SK Hynix is really trying to recover to at least the break-even point. And at one point this morning, it was actually recovered to positive territory as well. And in the meantime, I think it's important to talk about some of these other sectors like EV battery makers, as well as game developers, internet stocks. We're talking about names like SK Innovation that has heavily invested in EV battery making, and some of the, basically cheaper, but, the game developers. All this has to do with the South Korean Moon Jae-in administration's announcement earlier this week. And of course, what we're going to get from the Korea Exchange, the bourse operator, next Monday. He's calling for something called New Deal. And what this is, for individual investors to put in their money into their funds. New indices will be coming out next week. So obviously there is that bit of an outperformance this morning as well. Tanvir, back to you.
Shay, thank you very much for that. We'll take a short break right now. When we come back on the other side, focus on the markets and get you an update on the Forex session as well.
IBKR provides clients from over 200 countries and territories with the ability to invest worldwide. We offer the lowest trading and borrowing costs. Our clients have the choice of investing globally or locally in stocks, options, futures, Forex, bonds, and funds from a single integrated account. Our premier technology enables you to optimize speed and efficiency, perform sophisticated portfolio analysis, and manage your accounts. Start investing today at ibkr.co.uk.
6:30 in Singapore as well as Hong Kong. Here's a quick recap of all the top stories that we are following this hour. Asian markets deep in the red after a sharp sell-off on Wall Street. That's not all. Tech stocks showing the deepest dive. Apple losing 8% in its worst day since mid-March. And shares of SMIC hovering near a 10-week low in Hong Kong on reports of a stake sale by China's IC fund. Okay, after Wall Street's sharp sell-off overnight, investors are now watching the August non-farm payrolls data due out later today. Analysts polled by Reuters expect to see an addition of more than 1 million jobs in the month gone by. Rosanna Lockwood joins us with all the details on that. Rosanna, prepare us. Good morning.
Yeah, so the non-farm payrolls report, Tanvir, economists polled by Reuters expecting about a 1.4 million add of jobs to the US economy. But it comes with some conditions. Even with that 1.4 million add, that would still see around an 11.5 million shortfall in jobs that were lost around the height of the crisis. So you're still not seeing enough jobs being added. And of course, it differs widely from the ADP report that we had out on Wednesday that saw about 428,000 jobs added to the economy. And, you know, there is often this divergence between the ADP and the non-farm payrolls report. That's based on methodology differences. And when we're talking about methodology, I do want to bring in this week's jobless numbers, the weekly jobless claims, because there's a methodology item in there as well. Currently, the numbers for that are 881,000 for initial claims ending the week ending August 29th. But the Department of Labour has actually made changes to the methodology for its seasonally adjusted data. So it really isn't comparable to last week's 1.1 million number. People talking about it coming down below that million level at last. But for weeks, I've been receiving notes from economists saying you've got to look at the non-seasonally adjusted data, and that is the important figure here. And if you look at that raw data on a week-by-week basis, there was actually a 7,500 jump in the initial claims. And also want to take into account that when you look at mid-August, the amount of Americans receiving some kind of unemployment assistance of any kind, initial, continuing, other types of pandemic assistance, that jumped 2.2 million to 29.2 million at mid-August. And all of this adding, of course, to this picture of a stalling recovery in the US labor market. And without wanting to sound like a broken record, without still any fiscal stimulus package there from Congress. So it is tempting to get stuck in these week-by-week numbers and say, has it gone above a million or below? But when you look at it from the big picture, Tanvir, you still got this lack of stimulus adding to long-term weak economic growth and people without enough jobs and no paychecks and no aid.
Oh, absolutely. And you make a very important point, because ultimately it boils down to the direction of the data. And if you slice and dice the data, then it gives you one picture, whereas when you look at the broader numbers, it gives you another picture. So you can't conclusively derive whether the market is getting better or is actually just struggling still.
Absolutely. The devil is in the detail, as always, when you're looking at the data. But do take into account this slight methodology change from the Department of Labour this week. It's very important.
Will do, will do. Rosanna, thank you very much for taking us through those numbers and that preview on the jobs report in the US. Okay, let's take a look at the Forex majors right here, right now, across the screen. 92.73 coming in for the dollar index, 1.18 for the euro, 1.3 to a bit of a step back for the GBP. Not a whole lot has changed as far as the main currency crosses are concerned. The Chinese yuan very quickly flip over because there's been mighty strength in this currency over the course of the last few months. 6.84 on spot, so actually a bit of a retracement there. Offshore also likewise, and we are standing pat at 7 for the one-year NDF. Let's talk Forex with Nicholas Opel, who is Global Market Strategist at Fitch Solutions, joining us live from Singapore. Nicholas, it's great to have you on the show. Thank you very much for your time.
Good morning.
What do you make of the Chinese yuan's trend? Because after many sessions of strength, we're seeing some bit of a setback here. But do you think it's inconclusive that directionally this one is headed higher?
It's a tough question, I would say, because, you know, at the same time we had the weakness of the US dollar that we expected in terms of what the central bank in China has been doing. We continue to see them like trying to stabilize the yuan. When it strengthens too much, they will try to contain a little bit the strength of the yuan. And when it weakens too much, they will also contain the depreciation of the yuan. So right now, I mean, we are still in our like long-term scenario where it's still moving with a like long-term range between 680 and 717, 715. I know it's a wide range, but we are still in this scenario for now, and we don't see a change to this at the moment. As long as we remain within these boundaries, it's more likely to see like movements within the range.
Okay. I do want to get in your thoughts on the broad dollar call going into the election season. Do you think that it will continue to labor around these levels or with the Fed's average inflation targeting plan that the dollar might see more weakness?
Well, look, from a fundamental perspective, from a monetary and fiscal perspective, we should see the dollar heading lower because of loose monetary policy. On the one hand, you have the Fed; they are likely to keep interest rate on hold for longer, so it means lower for longer fiscal policy. We could see an acceleration of negotiation before the election. I mean, there's a lot of uncertainty there, but the drop that we have seen on the market yesterday could be a wake-up call for policymakers in the Congress to probably keep the stimulus alive. So from that perspective, the U.S. dollar should continue to weaken. Now, of course, we have this big uncertain event coming in November, and it's a very tough call at the moment. If you look, opinion polls are still saying that Biden has a comfortable advance on Donald Trump. Betting odds are actually having the elections, the result of the election very tight. On the other hand, we had some noise surrounding the postal service, and mail ballots will be very, very important, especially in 2020, given the pandemic. And as you know, mail ballots tend to favor Democrats. We see a risk, really a risk to see a contested outcome for the U.S. election, possible delay in the result due to the mail ballots, especially in key states where result could be tight. So unfortunately, I would say that's a very uncertain event. In terms of, we have about 2 months before there's narrow window of opportunity for other currency to appreciate against the expected weakness of the US dollar in the meantime.
And Nicholas, aside from the election itself, I mean, you also talked about stimulus expectations there, the fact that this round hasn't been able to get any agreement with just how bitter things are in Washington. And with that election approaching, I wonder whether it will get done, because neither side wants to be seen as giving a gift, and perhaps it will get done, but in a much smaller amount. So what would that mean for the dollar trajectory?
Yeah, you're totally right, Nancy. And before yesterday's drop, I was a little bit worried to see any form of stimulus before the election. So lesser stimulus should it's a bit tricky because it should actually underpin a bit of strength for the US dollar, and could be also on flight to safety. But on the other hand, the Fed has really clearly stated, Jay Powell has really clearly stated that they will overshoot both inflation and unemployment, so keeping monetary conditions accommodative in the meantime. So, when in doubt, I look at technicals, and the long-term picture of the US dollar still points towards further weakness. Now, on that way to the downside, we could see short-term rebounds, because we know we are in a long and bumpy road in terms of recovery, with quite a few uncertainties. And
well,
given
and those expectations for dollar weakness seem to have been causing some concern over at the ECB, is from what we understand, given what we had seen with the euro levels. But do you think we've already touched the upper limit there for the euro, given the setback we've seen in the last couple of sessions?
No, not really. I mean, from a longer-term perspective, I think like the inflection point if you look at the euro, will be around 125, 126. So we still have, from this level, a little bit further room to the upside. So that will roughly correspond to 90 on the DXY. So that's kind of the longer-term level I am looking at. Beyond this level, of course, on the one hand, euro strength means, there's an ongoing recovery in the eurozone, but at some point it will be detrimental to the exports. And that's, again, another complicated story, given the global recession and, exports contracting globally. So that will be the level I'll be watching in the long term.
Okay, we'll keep that in mind with the euro then. Nicholas, good to have you as always. Thanks for your time. That's Nicholas Sobel of Fitch Solutions. Thank you. And still to come.
You send them in, but you go to vote. And if they haven't counted it, you can vote.
U.S. President Donald Trump's suggestion that North Carolina residents could vote twice, prompting a swift warning from election officials. We'll have the details when we return.
You have freedom of speech, but you don't have a right to reach. It's the idea that you can say hateful stuff on Facebook, but no one else should have to see it, and no brand should ever be paying for it, and you should never profit from it. Those are the lines that you can draw, and that these platforms are currently not taking responsibility for.
Facebook makes billions of dollars from advertising. In July, more than 1,000 companies pulled their ads from the platform over concerns they were placed next to racist or other harmful content, and were in effect funding it.
The move was part of the Stop Hate for Profit campaign and included companies like Starbucks, Unilever and Coca-Cola, which called on Facebook to do more to tackle hateful posts on the platform.
Social responsibility as you build profit has to be tied together. It isn't just about what the brand is doing from a product perspective, it's about what the brand believes in from a values perspective.
Welcome back to Street Signs. We are about 2 months away from the U.S. presidential elections in November, and President Trump is encouraging voters to test the system. That's right, you heard me right. Test the system, suggesting they cast their ballot twice, once by mail and once in person. That move not sitting well with electoral officials, however. NBC's Pete Williams has the story.
In North Carolina, where mail ballots start going out, President Trump continued his attack on voting by mail, suggesting that voters test the system by voting twice, once by mail and then again at the polls to see if they can do it.
So let them send it in and let them go vote. And if their system's as good as they say it is, then obviously they won't be able to vote.
That prompted a stern warning from election officials and prosecutors.
To go and try to vote a second time as a way to test the system is a felony in North Carolina. Do not do that. It's a terrible idea.
Election experts say it won't work anyway. Here's why. If a voter is sent a mail-in ballot, that's noted in the official voting record. When voters show up in person, a poll worker checks their names in an electronic or printed version of that record. It flags those who were sent an absentee ballot, shown in this example from Michigan with red question marks. If they insist they never sent it in, they get what's called a provisional ballot, which won't be counted if it turns out the mail ballot was sent after all. Experts on the nation's election system say duplicate votes are easily flagged.
If someone were to vote twice, even if they did so innocently or they forgot what they had done, that will be caught.
Many states allow voters to track their mail-in ballots online to make sure they're received. But President encouraged people who vote by mail to go to the polling place on Election Day anyway to see if there is a record of it, and if not, to vote in person. State election officials advise against that, saying it will just slow down the voting line for everyone else. And now Twitter says the president's tweet violates its rules on election integrity.
Well, elsewhere, Facebook announcing that it will limit last-minute political advertisements in the week before the U.S. election. Ads that are already in the system can still run, but no new content will be permitted. CNBC spoke to Nick Clegg, Facebook's VP of Global Affairs and Communication, about the level of transparency the company hopes to achieve.
All these ads go into an ads library, which is far more transparent than political ads that are run on television or radio or in the printed press, where you can see who's paid for a political ad, who's targeted, when they're running it, all the different variants of the political ads. So we believe that that mixture of extreme transparency with this hard limit that new ads cannot be produced for a week up till election day, hopefully will mean that the ads do what they're supposed to, which is allow politicians to communicate to voters, get the voters to vote in the first place, but avoid an ad being run at the very last minute in a way that sort of hijacks the final stages of the campaign.
And in some ways, Tanveer, Nick Clegg is the perfect person to be talking about these issues as former UK Deputy Prime Minister. I mean, he has a very good view into the political stakes as well as what is taking place in just a communication standpoint. But already this week, I mean, when Facebook did flag concerns over accounts, concerns about foreign interference, making attempts once again in this election, they're obviously scrambling to make sure they have a handle on this. But others have cast doubt on whether or not they sufficiently learned the lessons of 2016 and have put the precautions in place.
No, and also there's peer pressure, right? With Twitter doing what it is doing in terms of putting the checks and balances in place, you know, you can't have Facebook that manages so much data and so much interaction and engagement from users largely, that they sit back and do nothing, especially in you know, during an event which is highly sensitive to foreign interference or any kind of meddling.
I do question, though, I mean, the fact that they're going to have existing ads that were already in circulation, they're free to run in the final days of the election. So what is the huge tipping point in terms of banning new ads? I guess they don't want to bring, maybe perhaps it's harder to monitor at the last minute and they just want to have a good handle on what that content is.
I think just in the run-up, in the last lap, you just want to be sure that you are not being an influencer any one which way for the users or the voters to decide what they need to do. So they want to keep the last lap clean from exercising any kind of influence.
But it is somewhat of a pivot from what we've seen in Facebook before, right? Because they've always held this line that we are a platform, not a publisher. We're not responsible for the content of the ads on our platform. And obviously public opinion has pushed them in another direction to an extent.
For sure. I mean, for so far, we've seen Facebook being pretty quiet on this issue, even through the ad boycott, right? But the fact that Mark Zuckerberg is stepping up and ensuring that, you know, Facebook doesn't come in the crosshairs of any sort of political debate or any sort of fallout because of what may happen through the counting process. He's just trying to keep his image clean.
Yeah, and I guess with great influence comes great responsibility.
Always. Yeah. All right. Time now for a short break, but coming up, all eyes on Virgin Australia as their creditors get ready to vote on Bain Capital's takeover plan. More on that story when we come back.
The president began this year thinking he was going to be running a re-election campaign largely based around a very strong U.S. economy. And what he's realizing now is that this election is going to be about his response to the global pandemic. We've seen an extreme economic crisis, and we're also seeing extreme political upheaval, from the Black Lives Matter movement to the anti-lockdown protests. The commitment and the values are what have to remain the same. Get the facts right, focus on the economy, meet the moment, and really get it right.
A former world leader dedicated to making a difference.
I'd always had a sense of mission, a sense of purpose.
A statesman looking to heal rifts and repair relations.
In my case, it's trying to act as some sort of bridge between, I won't say East and West, maybe China and the United States.
Join me, Tanya Breyer, as I sit down with former Australian Prime Minister Kevin Rudd, only on the next CNBC Meets Defining Values.
We are still waiting on news from the creditors meeting on Bain's recapitalization plan for Virgin Australia. So any moment now, the result will be out. Will Cluris, of course, joins us with the very latest as we wait. Tick-tock, tick-tock. Well, good morning.
TikTok, Tanvi. That's exactly right. I just heard from Virgin that the voting is about to close, and then Deloitte will be releasing a statement. So the wait is on for the results of this creditors meeting. Again, it is highly expected that Bain Capital is going to get a yes on both counts, both on the creditors by value and the creditors by total amounts. They got the support from the workers' union, and they got the support from the Virgin founder and Virgin Group head honcho, basically, Richard Branson. They still haven't sorted out their licensing issues, but it is going to be interesting to see just how all of this does indeed play out over the next couple of months. And joining us now to discuss some of those issues, very pleased to be able to welcome Simon Brown, his portfolio manager over at Tribeca Investment Partners. Now, Simon, so much of this vote and I suppose the outlook for Virgin Australia is going to be centred around the border situation here in Australia, and I suppose for the next couple of months to really hit the ground running for Virgin Australia. Do you think, though, that they're going to be able to succeed with the pressure that's coming from Qantas?
Yeah, look, in terms of reading the administrator's report, there's not a huge amount of the strategy that will change looking forward for Virgin Australia. I mean, you could potentially suggest that's a good thing or a bad thing, but we think it's going to be a good thing for ultimately the market and particularly Qantas and Virgin as well. They've got a major shareholder now who is going to be more profit focused, arguably, than the previous set of shareholders who were about sort of gaining market share. In terms of the outlook from company management at Virgin, they're talking about actually sort of potentially ceding some share, winding back capacity in the domestic market, and I think ultimately that will be a more profit-focused airline sort of going forward for Virgin, which ultimately will be good for sort of the two-player market here in Australia.
I suppose that does make it interesting, though, when it does come to perhaps their own interpretation of their outlook. They've said that they only want to, lay off around about a third of their workforce. Do you think that that's realistic if they do go to that really svelte model? Or do you think that there could be perhaps even further job cuts to come over the next couple of months?
Well, I think it ultimately will depend on what demand looks like. So hopefully we can get the COVID cases down here in Australia and actually get the internal borders opening up. Obviously, Virgin's talked about the fact that they're going to walk away from the Tiger brand, which wasn't particularly successful for them. They've also wind back the international business, so they'll be a purely domestic-focused airline. And I think like you've seen in the retail area, I think there'll be a lot of pent-up demand once borders come down and people are allowed to travel again. And so ultimately, yeah, I think they will see some good results. And look, they'll obviously have to cut the cloth to fit the dress to some degree. But I think, yeah, I think they'll be relatively successful early doors.
Simon, good morning. Thank you for joining in this conversation. So while you're saying that there would be pent-up demand that would ease the situation for the business going forward, we are still far away and very, very far away from reaching the kind of demand that we saw pre-pandemic. And so do you not think that there would be a lot of adjustment back and forth in terms of maintaining operational efficiencies through this transition period? Because there's still a lot of uncertainty there.
There is, that's correct. There is a lot of uncertainty. And look, it's a very large investment that Bain are looking to make in Virgin, and they've spent a lot of time in sort of going through this administration, and ultimately, I think private equity have been around the block a few times, and there's been a lot of experience in the airline industry in terms of going into an administration and coming out, and I think they will have studied the situation incredibly carefully as to how they're planning to, I guess, ramp capacity back up, not put too much capacity back into the market, and operate it on as well as they can, given that the demand's going to be relatively uncertain. So, look, I think there's probably been a lot of study put into this, and they'll obviously sort of, as I said, sort of meet the market essentially without putting too much cost in. And where that requires additional cost out, I'm sure they'll make that decision as and when it seems fit.
Right, but you know how private equity investors typically work. They do try to trim down cost bases and bring about more operational efficiencies, especially in the wake of the fact that their ultimate goal is to generate returns. So on that point, while Virgin Australia right now is maintaining that they will still be a full-service airline, will continue some of their international routes, have ruled out the possibility of going the low-cost model route, do you think that that would be perhaps a scenario that they may have to consider very seriously if things don't change fundamentally?
Look, you never say never, to be honest. But ultimately, the strategy has been set up by management. It's been talked about in the administration report. So
Oh, that was an important answer, but we snapped the line there with Simon Brown. But I think he's back with us. Simon, if you can hear me clearly, please carry on and make your point.
Yes. Yes. No, look, I think there is a very big cost base at Virgin. They do $7 billion of revenue, $6.5 billion worth of costs. So there's a lot of work that they can do to actually bring that cost base down. And ultimately, it will be about sort of potentially fares as well. I mean, maybe some price increases will have to come through for the market there to sustain that sort of second airline in the domestic market.
So in terms of the path forward, Simon, you've got Virgin Australia who are perhaps looking at around about 30% market share. You've got Qantas saying they're going to get 70%. What do you make of Rex in the domestic market? Do you think that they're realistic as a contender, especially on those profitable capital city routes?
Yeah, look, and it's fascinating when you do get sort of profitability, as we've seen in the domestic market, that other competitors look to actually add some additional routes. And that's exactly what Rex is doing. Now, I guess a lot of the money is made on that sort of Sydney to Melbourne route via the corporate market. It's a heavily patronised route. And ultimately, that is done in the key time slots between the two airports. Now, a lot of those time slots, the critical time slots at Tullamarine in Melbourne and up here in Sydney at Kingsford Smith, are pretty much locked up by the major airlines around sort of, your morning and your evening flights. So I think it'll just be incremental demand from Rex. I think it won't particularly impact the profitability. I'm not expecting here at Tribeca to impact the profitability too much in terms of the two major airlines.
Simon, great to have you on the show. Thank you very much for your thoughts and your insights. Okay, in the next hour of Street Science, we are still watching the markets over here in Asia after massive losses on Wall Street overnight. Our next guest is waiting for further correction before he starts buying again. More with Dan Niles from Alpha One Capital after this break.
very good morning and welcome back to Street Signs. I'm Nancy Hungerford.
TGIF, I'm Tanvir here. To your headlines this hour then. Asian markets in a sea of red after a sharp sell-off on Wall Street. The Dow losing more than 800 points as the tech wreck erases a full week of gains.
The high-flying FANG stocks tumbling across the board. Semiconductors playing also getting a smackdown. Apple losing 8% in its worst day since mid-March.
Plus, India's Vodafone Idea looking to revive its fortunes by raising new money. The company will discuss options for the way ahead at a board meeting later today.
Live from CNBC studio at the Singapore Exchange, this is Street Signs.
Top of 11, and what we have on the screen across the board, across Asia, a lot of red. That's what we are seeing in the peripheral markets, in the main markets. The Greater China markets are down. Kospi is down about 1.5%. The ASX 200 pummeled in the session, 2.5% down for this index. For some of the new markets, like I said, the peripheral markets, essentially, we are staring down the barrel as well. So no place to hide, suffice to say, in this part of the world. Though I must add the caveat that the sell-off in Asia is not as significant as the one that we saw stateside overnight, and also the fact that the techs in Asia are not selling out as badly as the techs in the US did in the overnight session. Let's get out to Sherry Kang and look at how the big tech players are doing in Hong Kong. They are down significantly, but not out quite just as yet. Sherry, good morning.
That's right, but let's bear in mind that tech declines was what described yesterday's session here in Hong Kong. So sort of that preemptive action when it comes to the tech sector as well. But if you take a look at the Hang Seng Tech Index, I mean that's really the perfect gauge to talk about what's happening with the sector here in Hong Kong. That index is down more than 3% at the moment. And if you take a look at some of the bottom movers, really the notable Apple suppliers are really, having a down session. We're talking about names like Sunny Optical, AAC Technologies as well. But in terms of the sectorial landscape on the Hang Seng Index, funnily enough, technology is not the big loser because we've got healthcare now at the bottom of the ranking in terms of the sell down this morning. But as you can see, AAC Technologies, for example, down as much as 3.8% at the moment. And I do want to talk about, of course, the SMIC shares. When, a lot of mainland Chinese chip makers and mainland listed chip makers in China are having a good session. That's not really the case when it comes to Hong Kong listed shares. And this comes on the back of IFR report suggesting that China IC Fund has raised $533 million by selling out of this particular chip maker's shares. And of course, this comes after that upsize in this particular stock. As you can see, 166% of an upside for the last 12 months or so. But it has to do with the 4% discount from yesterday's close that investors are reacting to. Really quickly, Taiwan is also under pressure. And of course, this is a market that has a lot of Apple suppliers, including names like TSMC, Largan Precision as well. And we do see some recovery from the market open, but that index still down more than 1% and red across the board for Apple suppliers. Nancy, back to you.
All right, Sherry, thank you very much for bringing us those movers. I do want to get straight out to Will Kalouris now because we have information for you to bring you, just breaking at the top of the hour on that Virgin deal officially passing. Let's get out to Will for the details.
Good morning, Nancy. That's exactly right. I have received confirmation that that deal has indeed passed. So basically, what my sources actually told me, there was 6,456 votes for the Bain Capital deal, with only 63 against. 257 of the creditors abstained. So in terms of those two separate votes, so you had the creditors by value and the creditors by number, 99% of the creditors by number voted for the Bain Capital takeover of Virgin Australia. 97% voted for in value. So that leaves only 3% of the creditors who weren't supportive of this deal. And it does perhaps signal that this is going to be the start of the second major competitor here in Australia when it does come to Virgin Australia. It's going to be very interesting to see where they do indeed go from here. We've got the border closures that are an issue not just for Virgin Australia but also for Qantas, and we're about to hear from the Prime Minister Scott Morrison about just that in around about 10 minutes' time, Nancy. So everyone, especially the airlines, are going to be closely watching what the Prime Minister says about any kind of agreements with the states when it comes to the borders.
All right, well, we do appreciate you bringing us this breaking news. Thanks so much for bringing the latest. Well, let's shift back to the action on Wall Street with a look at U.S. futures. And now all three major markets are pointing to a lower open once again when trade gets going on Friday. The NASDAQ looks to be the laggard once again with an implied open of about 150 points to the downside. The Dow and the S&P 500 looking at more modest declines. Now, tech and semiconductor stocks were among the biggest losers on Wall Street overnight. Just take a look at some of those individual moves. I mean, AMD off more than 8%, NVIDIA off more than 9%. You get the message here. Of course, some of the big winners that we've seen throughout this post-pandemic period, Apple taking a hit of 8%. You can't quite see Tesla on that board, but they were a big loser overnight as well. The market rout hitting the wealth of the world's top billionaires, wiping out $25 billion from their net worth collectively. Another reminder of just how incredible the run-up in the stock prices that each of those men are tied to has been. Well, let's bring in Daniel Niles, who is founding partner at Alpha One Capital Partners, joining us right here from San Francisco. Great to have you on the show. Thanks for staying up late there, Dan. We do appreciate your time today. Well, to consider what happened overnight, we have to keep in perspective where we've come from and this huge run-up in the big tech names. But bearing that in mind, Daniel, the question everyone has today is how much room to the downside could there still be?
Well, I mean, I think there's obviously a lot more room to the downside. I don't think anybody who's watching your program believes that the world's better today than it was on December 31st. But if you look at the S&P 500, before the sell-off, it was up 10% year to date. I don't think anybody thinks the world's 10% better today than before. And if you look at the tech stocks, a lot of those names in particular, you brought up Apple just now. I mean, it's run up a lot since a stock split, and a stock split adds no economic value to a company. But the stock is up, 34% from the day they announced the split to the day the stock split. You look at a Tesla, that was up close to 70% during that period of time. And so again, you had very small breadth of names driving the market higher, and valuations are at record levels on top of that at about 1.6 times market cap to GDP. And then today, Ciena reported, a forecast that was much, much worse than people thought. And we can get into that if you'd like, but that had broader implications for a lot of these other names.
But it's interesting you're saying that nobody watching this program thinks the world looks better, because we have heard from a lot of guests who are saying this could be a healthy correction, who are looking at it as a buying opportunity. That's a message we heard from many in U.S. program overnight as well. So why are you not so convinced?
Well, as I said, do you think the world's 10% better today than on December 31st?
Well, some people point to improvement in the pandemic, improvement in the vaccines, improvement in some economic data.
Do you see the glass as half full or half empty, Daniel?
31st, there was no pandemic. So the thing I'm trying to bring up is there's still a lot of issues. Obviously, we're going into a contentious presidential election. We don't have another stimulus package. Valuations are at record levels, and that sort of is a measure of the risk you're taking on at these levels. And then you look at the stocks and you go, it's great that Apple's up 65% year to date. Revenue growth is 5%. So, and the stock's trading at, very high valuations for the growth rate. So there's a lot of expectations built in. And then you had Ciena come out, which, your viewers may not be as familiar with, but, they're an optical supplier. They did about 800 million revenues a quarter, so over 3 billion a year. They service the big telecom carriers, both in North America as well as in Europe, as well as in Asia. And they came out and they said, look, we saw widespread weakness across the board, across geographies, across customers, and it happened very late in the quarter. And that's not something people were expecting. People were expecting them to have a good quarter, which they did, and then to raise the forward numbers, which they clearly didn't. They guided revenue 17% below the street. And they said, a lot of the enterprise customers were seeing weakness, and the stock had its biggest one-day move lower in over 10 years today. I think it was down 24%. Right. And they said customers were also weak. And so with this kind of optimism built into the market, don't forget, last year was a good year for the S&P. It was up 29%, profits up 1%. You need everything to be basically perfect for the tape to work.
I'm not so sure about that, Daniel, because at the end of the day, there are still a lot of people, and the market is divided. Like I said, glass half full, glass half empty. It's the way you look at the markets. But there are a lot of people who are saying that this market rally is more liquidity-driven and not reflecting fundamentals, and that the outlook on growth is expected to be an uneven recovery going forward. It's going to come in pockets. So I don't know whether there's a universal reality that people are kind of anticipating. Do you think that if this is a correction that is here to stay, then how much more downside can we see on the back of all the concerns you've raised?
Well, the thing, downside is a hard thing to predict because obviously you've got a presidential election in the U.S. and the president wants to get reelected. The Federal Reserve is doing everything they can to pump liquidity into the system, which is why the stock market is sitting, where it is. But if you look at valuations and you say, okay, market cap divided by GDP, which is a favorite measure that a lot of people use, that's at about 1.6 times. That is an all-time record high. The average over 50 years is 0.8. And to put it in perspective, in March of 2009, when the market bottomed, that number was around 0.6. So that gives you an idea of where things could end up. And if you compare the US market against Europe, or Japan, for example, where you've also got negative rates or zero rates, they have PE multiples that are closer to 20 to 24 times versus the US that's sitting up at about 26 times. And they also have higher dividend yields in those markets as well. Okay. So it's very hard to make any rational, have any rational view that the US looks cheap when you look at it from that perspective. The one good thing, obviously, is we do have some companies in terms of tech names that are benefiting from the pandemic. People are spending more, they're working from home more, et cetera. So that's good, but that's a small subsector. You've also got, obviously wider swaths of the economy. It's hard to take flights, restaurants, hotels, et cetera, cruises, where you've got other issues going on. That's where we have 10% unemployment, which is obviously that was peak when the financial crisis happened.
Okay, Dan, may I take the liberty of disclosing your position on Apple? I believe you've shorted Apple on August 31st. So what is your logic behind that trade, and what are you expecting from Apple's earnings and the stock trajectory from here?
Yeah, remember, we run a hedge fund. So for us, it's risk versus reward. And if you look at an Apple, it's great the stock has done well. But remember, this is a company that's pre-announced negatively twice over the last 2 years. So they're beating numbers that have been drastically lowered because they've continued to miss them. And if you look at the valuation for the company, it's trading at about 36 times earnings, and the revenues over the last 5 years have compounded by about 4%. I can buy, whether it's Microsoft, Facebook, or Google, those companies are growing revenues over 5 years at 10 to 30% for the same multiple. So it's a balancing position in our portfolio where we go, well, it doesn't really make a lot of sense for it to be doing well. That's why we own Qualcomm. And really, that's what it's matched up against. Because if you look at Qualcomm, their revenue should accelerate quite nicely this year because they're adding Apple as a customer for their chips, which they didn't have before. They got a positive FTC ruling as well, and they signed a new licensing agreement with Huawei, and I can buy Qualcomm at a 25 multiple versus Apple 36. So it's a nice way to balance the portfolio. And we like the gaming stocks the best, by the way.
Okay, so which are the ones that you would buy? And essentially in this fall, what would be your top 3 buys?
Yeah, so what we're looking at is we want names that'll do well, whether we get a vaccine that's effective, whether we don't. And so for us, we look at the gaming stocks, so like Activision, Electronic Arts. We've got a new console coming out from Sony and Microsoft, the first brand new console in 7 years. That should drive a lot of demand. The prices for these video games are going up as well, and people are downloading more content, which is incredibly profitable also. So those would be the first names where we'd add to positions. But don't get me wrong. If the sell-off continues, those names will go down as well. But that's where we look to be adding exposure along with Qualcomm.
Dan, if we look at Tesla as really what's been a poster child for the retail investors and what's been taking place, not just on Robinhood, but other platforms, do you think this is the start of a deeper correction for names like this that have benefited from that retail surge?
yeah, I mean, one of the things that's people may not be aware of is before you got into the pandemic, retail volume as a percentage of total volume in the market was closer to 10%. Since the pandemic, that number has gone up to close to 25%. And those investors are typically only looking at buying stocks. And so what you've seen is a lot of money move into the market, into names they recognize. So you have an app, you have an iPhone in your pocket, you buy that. You know the name Tesla, you buy that. And so they're gravitating, or Google or Facebook or something you're very familiar with. And if you look at the market, some of those names have done very well. Obviously, Amazon's revenues are up 40% year over year. So they deserve to have their stock go up. But remember, Amazon stock is up over 80% this year with its revenues up 40. So no matter sort of how you look at these tech names, and don't forget, they had great years last year as well. True. They've all gotten expensive, which is why, we don't own them anymore. And we've been, we've said before, we've said publicly, people can see it on my Twitter handle at Daniel T. Niles or at my website, danniles.com. We've been trimming those names as they've been going up because this kind of correction is something we've been sort of expecting in terms of a risk reward up at these levels.
In fact, taking a contrarian position, shorting Apple, that would be in the minority, I would reckon, given the kind of stupendous rally the stock has witnessed. But Dan, sorry, you want to say something?
Portfolio of other names that were long, and that's the way you need to think about it.
Okay, great. Point taken. Dan, great to have you on the show. Thank you very much for staying up and being with us on this story. Okay, Asian Apple suppliers, in fact, under pressure after the iPhone maker tumbled 8% overnight, which has been our top story all the way through in its worst session, remember, since mid-March. Right now, all of the suppliers are looking like this, staring down the barrel. We'll discuss more about the tech sell-off on the other side of this short break.
With over 1.3 billion people affected by disability, what can be done to improve inclusion?
This problem is too big for governments and charities alone to resolve.
A missed opportunity for business.
We're losing about 7% of the GDP because of this exclusion. Even if you put the bottom line first, it actually leads you to inclusion.
Finding solutions for disability inclusion with me, Tanya Breyer, only on CNBC.
COVID-19 has really taken a heavy toll of the economies of many countries in Asia and elsewhere, and particularly the lower income countries. That is why, as a multilateral development bank, we would take a flexible approach to provide liquidity support to those countries. But we understand this is not something which can be dealt with very soon. So we are working with the government, and we also would like to work with the private sector.
Welcome back. Well, let's get the state of play in China's markets, and Sam Vadas has the story for us. Sam.
Hi there, Nancy. Well, in terms of the reaction over on the mainland to that sharp sell-off on Wall Street overnight, we are seeing Apple suppliers falling this morning after the tech giant tumbled 8% in its worst session since March. Over in Shenzhen, We've got Lens Technology, which produces touch panels, and Goertek, which makes acoustic components, leading the declines this morning, both falling over 3.5%. We are also seeing leading Chinese consumer firms dropping again today over these concerns of high valuations, as I was speaking about this morning. Leading the fall there has been Foshan Haitian Flavoring, which is said to be the largest manufacturer of soy sauce in the world, which has dropped as much as 9%, extending yesterday's fall of 6.8%. The index, which tracks consumer staples, has shed as much as 3.5% and is on track for its worst session since July, but it is still up more than 50% this year, thanks in part to Beijing's efforts to actually help domestic demand. We are seeing pretty much red across the board today, with consumer non-cyclicals and healthcare stocks leading the declines on both the major indices. Bucking the trend, though, today has been the shares in Chinese semiconductor firms, which are climbing this morning off the back of a Bloomberg report of more state support for the domestic industry. So this report says that China is planning a set of new government policies to actually help boost the sector and counter some of this pressure from the United States. Leading the gains this morning has been tech semiconductors over in Shenzhen, which have climbed over 13%, while SMIC, that is Semiconductor Manufacturing International, is China's big chip maker, has been up over 2.5%. Of course, this is interesting because it does come as China has been really aiming to be more self-reliant in the tech space. It's been throwing a lot of support behind homegrown companies in the face of some of this US pressure, and as part of that, it has been reforming the capital markets to try to fast-track IPOs and include more high-tech strength. Tanvir, back to you.
Thanks very much for that, Sam. Let's touch base with our next guest. Tuan Hoon is CIO Europe and Asia Pacific from Deutsche Bank International Private Bank, and he joins us down the line from Frankfurt. Tuan, it's great to have you in the show. Thank you very much for your time. Weigh in to the topic of the day, which is essentially this tech sell-off, and what do you make of it?
Yeah, I think it doesn't really come unexpected, I have to say. I mean, the magnitude was, of course, quite huge, I have to admit, but I think it's clearly too early to call for a kind of rotation. We have seen this before, and if I look, for example, at the performance of overall markets, and then, of course, in particular tech stocks in August, which was the best in decades, I think it doesn't really come as a surprise that now investors also look to book some profits. So we have to see if this is just a short-term blip like before, or this is now the turning point of a rotation, which we don't think so.
But at what point would you be a buyer? Because that seems to be the consensus opinion that we've been getting. I mean, we've pretty much spoken to all analysts through the show over the course of the last 3 hours, getting a sense for them on what they are going to be doing with the sell-off. And it seems like the broad view is this is a buy on dips, downside adjustment. Would you agree?
We would agree to this. We still think technology and also healthcare, which we consider as quality growth sectors, are still the sectors to own. I think when you look at, especially this year, not many sectors could provide some positive earnings, and hence we think, especially during the pandemic, and maybe this is lasting a little bit longer than many people thought, this is clearly a positive for these sectors, and hence we would still recommend our clients, if they haven't already invested in these sectors, to use this kind of dips to increase their allocations there.
Tuan, how do you play this, though, relatively to what's happening in Europe and Asia? We spoke to a guest earlier on who said, don't expect Asia to decline by the same magnitude, and that's what we're seeing so far on the session. So is this an excuse to keep invested or perhaps to build positions in Europe and Asia?
Yeah, I mean, Europe has been, of course, a laggard. If you look at, for example, not only this year's year-to-date performance, but also already over the years. And again, this is also not a surprise given how the composition of the European markets is. It's usually more in the value camp, and hence I would also not expect, if Europe opens up the markets in a few hours, that of course this is going to trend down, but not as much as in the US, where of course both NASDAQ and also the S&P is heavily tech oriented.
Okay. I mean, I guess the underlying question I have is, at what point do you think investors will start to pay more attention to the fundamentals and valuation than just the technicals or some of the momentum plays? Because that's something that our previous guest raised. It's something that Mohamed El-Erian has raised over at Allianz. And given the backdrop we have from the Federal Reserve, it does complicate this picture, doesn't it?
Absolutely. I mean, when you talk about value, it comes directly into my mind. Then, of course, financials play quite a big role. But given now, as you hinted to, the Fed's decision last week at Jackson Hole now to abandon their previous inflation target, now moving to a more average one, which means something we have been saying many times before, and now it is even further supported with this Fed action, that the Fed might keep interest rate low for longer. Some are even saying forever, but at this stage we would say low for longer, something we have been saying for the ECB for some time. And hence, of course, it will be a tough environment for financials, in particular banks here, to make decent earnings. And of course, the pandemic is still, in a sense, around us, that it keeps travel and leisure at bay, and hence not many sectors are currently attracting investors' mind. So we would think here a lot of investors will use then this dip to rebuild positions in technology and healthcare.
Do you think the non-farm payrolls coming up later today will have a big influence on the markets? Because normally on an NFP Friday, that is what the talk of the town is, but these are hardly normal times. And when you take in the Fed dynamics into the equation, what do you think the influence will be, good or bad?
Absolutely. And if we haven't seen and wouldn't have seen this kind of correction yesterday and the day before, then I would have paid much more attention to the non-farm payrolls today. I would rather think now, given the correction and the dip, it's rather a non-event here. I mean, the expectation is between 1 to 1.5 million new jobs created. If it's plus minus a few 100,000, I don't think with this will then move the needle in either direction.
All right, so good to have your views today. Thanks for your time. That is Tuan Huynh from Deutsche Bank International Private Bank joining us. And still to come in the program, FANG stocks losing their bite overnight in a tech pullback. They are still showing impressive gains year to date. Impressive could be an understatement. But is the party over? We'll be asking Ray Wang at Constellation Research on the other side of this break.
Squawk Box on CNBC.
We've all just lived through extraordinary days in the history of our country. It began with an explosion of shock and anger, but in recent days across the country, that anger has seemed to grow into resolve. It is said there's nothing more powerful than an idea whose time has come. Perhaps the time has come to fully realize the dream upon which this great country was founded: equal justice under the law. I'm Lester Holt. Please take care of yourself and each other.
It's 11:30 in Singapore and Hong Kong. Here are your top stories this hour. Asian markets sell off following a tech wreck on Wall Street. The Dow losing 800 points, wiping out a full week of gains. Virgin Australia's creditors giving the green light to Bain Capital's proposal to purchase the moribund carrier for 3.5 billion Aussie dollars. And shares of Chinese beer maker Tsingtao down sharply on news that Chinese conglomerate Fosun International is reducing its stake in the company.
One of the big stories today, in fact, the biggest story really is the tech wreck on Wall Street. The biggest losers from the space will come up on for you on the screen, that is. We are looking at all of the big tech stocks stateside seeing very significant sell-off in the overnight session. Market darlings like Tesla and Zoom also having a bad day in the overnight session, down nearly 10% for both the stocks. Semiconductor stocks getting a smackdown as well, so no place to hide, suffice to say, within the broader tech sector as well. Ray Wong is Principal Analyst, Founder and Chairman at Constellation Research and joins us live from Silicon Valley. It's great to have you on the show, Ray. Yeah, hi. How are you doing? Give us your own sense. Weigh in on the sell-off and what do you make of it?
You know, it's definitely a sell-off. We call it a relief valve. People are headed to Labor Day holidays. They don't know what the job employment looks like. They're not sure what that report's going to come up, and they just want to cash in on the gains. I mean, you got Amazon and Apple up 60% since January. It's been a great rally, and I think people are just cashing in for the time being. But big tech is still hot. You've got a whole nother group of folks that are really excited about tomorrow buying on the dip. So it's going to be interesting to see what happens Friday morning here in the U.S.
Yes, indeed. Let's break it down. And I think a large part of the sell-off that we're seeing in Apple and Tesla, people are attributing it to the runaway rally that both these stocks witnessed in the anticipation of that stock split coming into effect. So there's just some adjustment to that from a price perspective that's kicked in. Do you believe that this is just interim and things could rebound very quickly? What's your broad sense on the earnings and the underlying fundamentals and the underlying earnings trajectory for these names?
I'm definitely on the interim camp. I think it's going to come back. Here's why. The retail investors have gone crazy, and they were really anticipating the splits, and they jumped in. And so they took advantage of getting in on stocks that they couldn't get in before from the price basis, but that has no value basis. But Apple is still a very, very strong stock. We've got a 5G rollout coming. They have access to the Indian market, 1.2 billion users that they potentially have access, and the services business is still growing. So Apple is fundamentally in good place. When you take a look at Amazon, Amazon is the post-pandemic winner. And in fact, they've been winning, and they're taking market share from other retailers. They're taking market share in healthcare. They're taking market share in a whole bunch of areas, from subscriptions all the way down to the cloud. And so we think Amazon will also be doing well. And then when you look at what happened with the Tesla split, Tesla's a different story. If you liked Tesla and you were trading at, you realize that it was pretty high at about 100, 150, now converted, right? That was a high number. That was high for an automobile stock. But if you see it as a big tech play, a data play, an insurance play, an autonomous vehicle, all the stuff that you can do with supply chain networks and even energy electrification, then 500 is actually still very cheap.
Yeah, although some will say a lot of what you're talking about, I mean, the expectation of it as a tech play is part of what's fueled the rally there so far. I'm curious why you say it's still cheap. I mean, what are you basing that on?
So we're basing it on the fact a lot of people came in when Amazon was considered expensive and losing money. They thought the Amazon stock was hot, and it's hot for e-commerce, but they missed all the other plays. Tesla is actually monetizing its data, and it's going to be able to do it just not only on the location side, it's also doing on the electrification and the energy markets, which are huge. They have a play in not only the power generation, the distribution, and of course in the future, trying to figure out how to tie that back to what they're doing on the cars, what they're doing on their solar plants and solar cells, and then, of course, what happens when they actually get logistics networks up and running. And so it's purely a data game. It's a big digital giant.
Yeah. I mean, you raise an interesting point here, too, though, which is, I mean, the fundamental story behind these darlings of the tech world are very different. So I wonder if this correction, if it continues, the move to the downside, let's say, is an opportunity for people to take stock, to reassess, and then when they go back in to buy, there's a bit more differentiation.
There is. The monetization models are a little bit different. Apple doesn't sell your ads. Apple is focused specifically on getting to services. Facebook and Google are in the ad business. They operate a little bit differently. Facebook and Google are both one-trick ponies in the ad network side, whereas Apple has got a diversified portfolio. Amazon's got a diversified portfolio, which sets them apart. Netflix, same thing. Netflix is one of the ones that basically are a one-trick pony on subscriptions, but they've done a really good job. If we watch them start to monetize other digital areas, and that's advertising, search, membership, subscription, goods, if they start moving in those directions and start diversifying their monetization models, then they're actually going to see even more bumps.
What did you make of the sell-off in semiconductors, chip makers, chip designers, essentially, despite Broadcom coming out and saying that the outlook is not all that bad? Yes, there was a delay with Apple orders, but even so, are you broadly optimistic about what this space has to offer?
I'm broadly optimistic. I think there's going to be even more compute power used in the world. As we go more digital, you're going to need more data centers. As we go more digital, the cloud and the AI capabilities that people are expecting, the ability to actually do risk analysis, all this is going to require more compute power. So whether it's coming into devices, especially on the IoT and the edge side, whether it's coming into PCs, whether it's coming into servers and cloud computing, they're all going to need the chips. Now, not all of them are equal. We like NVIDIA because we think the GPU has won the bet for now. And I think that's a very important piece. AMD is well positioned as well. And of course, Broadcom's done a good job.
Ray, I want to ask you just what the feeling is on the ground there in Silicon Valley, since that's where you spend most of your time. And, you know, we've been talking about the big tycoons of the tech world and how much money they lost just in one session if you look at their stock holdings. And it's pretty remarkable, some $25 billion across the slew there, as you can see, Bezos, Musk, Zuckerberg, and Gates. But a lot of other people down the ladder are becoming very wealthy and have been for quite some time. But given the rise of names like Zoom, given what's going on with Tesla, do you get the feeling people are walking around feeling confident, kings and queens of the universe? Or is there this little bit of nervousness, like it could all end badly?
There's always some trepidation in the valley. There's boom and bust cycles. I think in this cycle, if you're in software, if you're in digital services, you're doing really well. Hardware, networking, you're always a little bit, there's a little bit of trepidation because you're worried about the thin margins, but it's really a volume game in those areas. But in general, I think the mood in the valley is we're worried about other things. We're worried about fires that are going on. We're worried about social injustice that's happening. It's a little bit different. We've all been working from home, so people are a little bit stir crazy. So that's really what's going on here. But I think in general, low interest rates, some people are moving out of the valley because they're trying to get better homes and they're trying to get more space. So we see some of that going on as well.
Yeah, no, it's good to get your perspective because we talk so much about what's happening from a stock market perspective, but on the human element too, good to get your views, Ray. Thanks so much for joining us. We do appreciate it. There's Ray Wong of Constellation Research. Thank you.
Hi.
Have a great weekend.
You too. Long weekend in the U.S. if you're watching from there. Let's get back to the markets right here in Asia, though, with a look at the Nikkei 225 and how it's trading right now. We have seen it moving lower throughout the session, but just by about 1% now. We've kind of been in this range of 0.9 to 1% for most of this show, at least. The topic's off by 0.9%. And the dollar, which had been slipping previously overnight and a bit this morning against the Japanese currency as people seek safe havens, actually making a very slight, I stress slight, rebound. It is pretty much steady at 106.22. Let's check in on the heavyweights for you to get a fresh idea of where they are trading. And they're all moving to the downside now. SoftBank Group, the biggest loser there. That makes sense given their exposure to tech. And Fanuc is off just about 0.9%. Apple suppliers in focus in Japan, well, they have also been taking a hit after the iPhone maker tumbled 8% overnight. Although these losses to the downside not moving in tandem with that move for Apple, but still under some pressure. And Honda shares have been bucking the downtrend throughout the day after announcing plans to develop new vehicles for North America with General Motors. The stock is higher by just about 2.5%. So a reminder that you can find some winners if you are looking to pick them selectively in this environment.
There are always winners in the market. This is not a broad-based sell-off, so that's something to take on board. Okay, now let's go across and understand what's happening in South Korea with the South Korean market. Sherry Kang joins us with the movers and shakers and the internals there. Sherry.
Thank you very much, Tanvir. Yeah, I'm going to try to find some winners in South Korean markets as well. I mean, investors selling that, hitting that sell button, sure, that's sort of old news now. Now we're already halfway through the session today. So yes, Kospi is down. But if you take a look at some of the energy names, for example, they're actually outperforming. Down, the sub-index is down just about 0.3%. So when you want to, have that conversation about deep value sectors, I think that's interesting for me to point out as well. Sure, all other sectors are also down as much as 1 to 2%, but I think, this Kospi coming back up a little bit, and also the major heavyweights like Samsung Electronics, SK Hynix, those major tech stocks, Apple suppliers, are coming back a little bit. If you take a look at what's happening with SK Hynix, the story is that they are just about 0.1% of a downside is coming through. In terms of some of the random green spots that we see in sectors like South Korea, EV battery makers or healthcare or internet or game developers, I think this is an interesting story moving forward for South Korean markets, at least, because we've got a South Korean bourse operator, Korea Exchange, set to give out more details on this so-called New Deal indices. And now they're coming out with 5 new indices. The ETFs will be launched next month, but the details will come through next Monday. And what this is that South Korean President Moon Jae-in's administration is really pushing for these funds being created in order to fund national projects for infrastructure as well as the new growth engines like the sectors that I just mentioned. And he actually said he basically calling for more retail investors, individual investors to jump onto the bandwagon, saying that this is good for, quote, more stable profits. So we're going to see more of these actions perhaps once we know which sectors will be included these indices, but certainly it looks like some speculation is going around. So SK Innovation up 3%, and I don't really see any, specific headlines going for that particular stock or the company at this point. Nancy, back to you.
Yeah, we're bucking the trend today, that's for sure. Sherry, thank you very much for the update. And before we head into the break, we want to check in on the Singapore Straits Times Index for you. It too has been in negative territory and remains the case, off just 1.5%. The US dollar against the Sing dollar, pretty steady as she goes. But Wall Street's tech dive also weighing on tech plays right here in Singapore. You can see that reflected in Venture, which is off 4%. Creative not faring quite as badly, though. The big banks, let's bring those up for you on the board. You are looking at some red arrows, but not huge losses. DBS is the laggard. They're off just 1.4%. And Capital Land-related stocks, well, they are looking like this, lower to the tune of 2 all the way to 3.5%. Street will be right back after this short break.
Technology has enabled a crisis response in data collection through wearables and apps. But these solutions are contentious due to privacy issues.
The perception of privacy varies across different cultures. On one end of the spectrum, we have China and its intrusive approach to harnessing data, while Germany is on the other end with its extremely cautious approach to privacy. And in the middle, we have East Asian countries such as South Korea and Singapore.
The trove of data gathered during the pandemic is a double-edged sword. Health data can be predictors of potential health issues or even behavior, making it particularly valuable on the black market compared to other types of data.
Privacy and safety need not be mutually exclusive. Whether countries can strike that balance will set the tone for privacy even after the pandemic ends.
Global coronavirus cases now topping 26 million with more than 860,000 deaths. The World Health Organization is appointing an independent panel to probe its coronavirus response, giving access to all files to the 11-member panel, who will prepare a final report by May of next year. And as drug makers rush to find a vaccine for COVID-19, Pfizer is saying it will know by October if its vaccine candidate is working. The U.S. drug maker has enrolled 23,000 patients to test the vaccine that it is developing with Germany's BioNTech. And the vaccine race has been fueling concern about a possible rush to get U.S. FDA approval ahead of the November presidential election. NBC's Tom Costello has more.
With the November 3rd elections looming, President Trump has insisted a COVID vaccine could be coming soon.
You'll be reading about them very soon, way ahead of schedule.
The CDC has told state governors to prepare to distribute millions of vaccine doses as soon as November 1st, a massive logistical challenge. Vaccine maker Pfizer says its vaccine could be ready for FDA approval in October.
It has nothing to do with elections. This has to do with delivering safe, effective vaccines to the American people as quickly as possible and saving people's lives.
But Americans are nervous about a fast-tracked vaccine. A survey conducted by Stat News found 78% of Americans worry the process is being driven more by politics than science. While an NBC News SurveyMonkey report found 44% of Americans would get the vaccine, 22% said they would not, 32% weren't sure. Public health experts are concerned.
If we cut corners on the vaccine, I think it will end up undermining both of those agencies, FDA and CDC, for a generation.
Dr. Anthony Fauci says the FDA is following proper protocols.
I know the Data and Safety Monitoring Board people, they are independent and they are very committed to making sure that science prevails and not politics.
The CEO of drug maker Eli Lilly suggested the industry has too much to lose by rushing the process, saying we're not going to make something or we're not going to sell it until we've proven to our own standards it's safe and effective.
For all the speed that has occurred before those phase 3 trials, as long as we hold these vaccines to a phase 3 standard, then I think that the public can be confident.
The CDC says it plans to prioritize who gets the vaccine first, including healthcare workers, essential workers, anyone 65 and older, and racial groups most at risk.
So there you have it. I mean, we are all hoping and wishing that this vaccine gets out as soon as possible. And look, I have so much respect for those who are working on it, and we owe them so much. I think the concern here is that when you tie it into anything political, whether or not it is being rushed out for political considerations, which the FDA has denied any of those charges, I worry that people will be more reluctant to get the vaccine, and you need full uptake here in order to get the impact that you want to in terms of immunity.
And I have no issues with laying down a timeline. It's important because it's indicative, right? It helps you kind of prepare mentally that, you know, there is a vaccine in the works and the world is at it to find a cure to COVID-19. But my problem is how policymakers are taking it upon themselves to direct the course here without there being much consideration on what is being communicated as far as the safety, effectiveness, and the efficacy of this vaccine is concerned. So that should not be compromised on. Otherwise, the timeline is important because, like I said, it just lays the groundwork to be mentally prepared for what comes by the end of the year.
And what we've heard from the FDA, you know, in that clip is that they're not going to compromise on safety. I think seeing a full phase 3 clinical trial will give a lot of people confidence. And prioritizing it for healthcare workers, that makes sense. So when they talk about, let's say, November, if it is going to high-risk candidates like the healthcare workers or the elderly population, that's not a bad thing as long as it's been through all the safety checks. And then hopefully there will be enough in terms of resources to get this thing out and running because it's a huge factor in getting things to return to normal for the economy.
It is, but the White House saying that nobody's pressurizing the FDA.
Right.
I mean, I don't know. Because the timelines keep shifting on that. We've already heard President Trump earlier on talk about how he was looking at a deal by November 1st before election date. And now most members in the government are saying that it will be end of this year. So, they're saying their stand is that they're not pressurizing the FDA. But let's see what happens on that front. Okay, we'll take a short break right now. But coming up, Indian markets have joined the trading day. We'll check in on the early movers when Street Science returns. Welcome, everyone, to the closing bell.
It's the most important hour of the trading day.
20 minutes to go before the close.
Do you think the volatility is going to stay with us?
When stocks move, when volume spikes.
A story that everybody on Wall Street was talking about.
Keeping you on the leading edge of what's driving the market.
We are up 4% on the Dow and the S&P and the Nasdaq.
Minute by minute.
It was worth 6% on the upside.
Wilfred Frost.
Well, what a crazy week it has been.
Sarah Eisen.
There's the closing bell.
Closing bell. Weeknights on CNBC.
Back with an update on Malaysia's 1MDB scandal. A local court has dropped criminal charges, and this is an important development, against the units of Goldman Sachs after the bank's $3.9 billion settlement with the government over its alleged role in stealing billions of dollars from a government investment fund. So just wanted to highlight and update that for our viewers.
Yeah. Let's bring the focus back to the markets and take a look at what's happening in Australia, because it's been the laggard through most of this session, but it does appear that it's touching near session lows. So let's get out to Will Kalouris for more details on what's on the move. Will.
Good morning, Nancy. That's exactly right. We're getting absolutely thumped in the session today, and there isn't really that much hope of any kind of upside. Obviously, the US futures pictures does play into this. We saw that terrible Wall Street leading, but at the same time, a lot of investor hopes were being pegged on some kind of deal being done at the National Cabinet that was going to provide some form of those internal borders reopening and sometime soon. That is not going to be the case. And now what the Prime Minister Scott Morrison is currently talking about is the fact that they're going to move to a consensus approach, and some states, particularly Western Australia, don't necessarily want to follow the same timeline as the rest of the other states. And this is actually going to have an impact on not just a lot of businesses, but also the airlines. Basically, what Scott Morrison is saying is 7 of the 8 states have agreed to try and get to where we were hoping to be at the end of July, now by the end of December. So that is another 3 months of perhaps some kind of lagging when it does come to the internal borders. And that does impact, like I did just mention, the airlines as well. We had Virgin Australia, some further clarity when it does come to the results of that creditors meeting, basically saying that the creditors are going to take 6 to 9 months to get any kind of payout, that 9 to 13 cents in the dollar that was expected. But it will be interesting to see how this does play out in terms of this national border decision with Virgin in particular, because they're going to be trying to hit the ground running when it does come to competing with Qantas. And now the fact that the states can't get organised as to when they're going to open their borders and really kickstart domestic travel, how long they're willing to burn cash over there at the new and improved Virgin is going to be something to watch, Tanvi.
Yeah, that game plan would be important. Thanks very much, Will, for joining us and giving us the latest on this story. Indian markets are up and running. Let's go across to Mumbai for the early action with CNBC TV 18's Nigel D'Souza. I'm seeing a weak start to the market. Is it a weak day for Indian techs as well? Nigel, good morning.
Well, morning from here in Mumbai. It's a freaky start to this Friday, actually, because the Nifty is under pressure. Remember, the S-Shakes Nifty was suggesting a cut of around 110 points out. Guess what? We've started off with a cut of around 180 points. Now, we have a crucial support level at around the 11,300 to around 11,320 odd mark. That's because earlier this week we did visit levels closer to those levels, and in fact, you have the 20 DMA as well is at around that 11,390 odd. So this zone of around 11,350 odd, that's going to be the crucial level that we're looking to defend. So the Nifty is under pressure. That's because the Nifty Bank, that's bulk of the constituents on the Nifty, that's down closer on 2.5%, and the IT index as well is seeing some selling, but it'll be all eyes will be on a couple of these telecom majors. So Vodafone Idea, remember they have to raise nearly around 50,000 crores in terms of Indian rupees, to pay some of those dues. That's the AGR dues that are outstanding. Now today there's a board meet when they're going to be considering fundraising. So who are the people who are coming in there to give them some money? The entire group will be in focus, because will one of their group companies like a Grasim look to bail them out? So Vodafone Idea, that's going to be a stock that's rallied from around 9 Indian rupees to around 12 Indian rupees in just the last 3-4 trading sessions also. We'll keep an eye out on that one. And besides that, Reliance Industries as well, reports indicate that they're looking to raise close to around $5 to $6 billion via a 10% sale of the Reliance retail assets. So both these two stocks will be tracking all through the day. Back to you guys.
All right, Nigel, thanks for highlighting the names to watch on the India session. We do appreciate it. Thank you. Have a great weekend. Well, let's give you a look at the Asian markets, why don't we, on this Friday. And we continue to see red arrows across the board. We already highlighted the ASX 200 as the one underperforming the broader region, but elsewhere you're seeing the Nikkei 225 off by more than 1%, and that's pretty much the story for the China markets and for the South Korean market as well, across the board, really. Let's give a look at U.S. futures, why don't we? It is almost midnight on Wall Street, so it's an early indication here, but once again, it looks like the Nasdaq is set to underperform in what was, no doubt about it, Tanvir, a tech-focused wreck overnight.
Oh, absolutely. And tonight, stateside, we will be watching out for the non-farm payrolls report as well as the unemployment numbers. And the broad expectation is that for the month gone by, the unemployment rate will come in at 9.8%. The only point I'll make here is watch out for not just the direction of the data, but also how the numbers fare in the month of September and October when the Q3 earnings reports come out. Sure. And if the numbers pick up there, if earnings profile improve, what do companies say about their hiring, rehiring plan, and what that means for the jobs market ahead of U.S. elections remains to be seen. Okay, with that, we come to the end of this edition of Street Science. It's curtains down on the show from Nancy and myself. Thanks very much for watching. Capital Connection is up next. Have a great weekend.
See you Monday.
With the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
In navigating markets,
green is the theme across the board.
What signs point to opportunities?
Gold hitting a near 7-year high.
In economic political crossroads,
global slowdown grows. Central banks are feeling the pressure.
How do you brace for the risks ahead?
Debt levels in the world are rising.
Set your money on track with Nancy Hungerford and Tanvir Gill. Get up to speed with the day's biggest moves, real-time updates, actionable insights. Street Signs on CNBC. CNBC Breaking News. Market sell-off.
Welcome to the program. I'm Dan Murphy. Let's get straight into your headlines at this hour. First today, the tech rally grinding to a screeching halt. Wall Street diving to its worst day in months and taking Asia along with it. Traders now bracing for the August non-farm payrolls data. Also today, weekly US jobless claims falling below 1 million for the second time since the pandemic as concerns mount about the recovery in the labour market. And Virgin Australia's creditors have given the nod to Bain Capital's purchase of the carrier that will pave its exit from voluntary administration. Good morning. Let's go straight to the markets. And Asia is broadly lower, on track for its worst weekly performance since April. We are seeing a marked pullback after a long period of stretched price action here. Australia has been leading regional equity losses. Stocks in mainland China, Hong Kong, South Korea, Japan and Singapore are all declining. All of this coming after a massive sell-off on Wall Street, led, of course, by tech. The S&P, NASDAQ and Dow seeing their worst days since June. The Dow diving over 800 points, or nearly 3%. The S&P slid 3.5%. The NASDAQ down a steeper 5%. Hefty losses in the tech space as the darlings of this market went into sharp reverse. Apple tanking 8%, along with Amazon, Alphabet and Microsoft. Tesla also taking a hit. The equity sell-off sending Treasury yields lower. Take a pulse check of what's happening with the 10-year yield right now. You can see tracking at 0.63. In focus, weekly jobless claims stateside falling to a seasonally adjusted 881,000, but that was also due to a change in how the Labor Department calculates seasonal adjustments. The big risk event for the markets now is going to be the August non-farm payrolls this evening. Let's get a check on what's happening with US equity market futures, and you can see here traders now bracing for more losses when Wall Street resumes trade. Downside calls expected for the 500, the Dow and the NASDAQ. Still, keep this in focus though. Despite the moves that we saw overnight, US stocks are still up at least 50% from their March lows. Let's get you more analysis on what's happening in the markets right now. We have reporters across the story for you. Will Kalouris has all of the asset market reaction in Sydney. Sam Bartas is following the China response. But let's start with Sherry Kang, who is in Hong Kong, where it has been an ugly morning session. Sherry, hello to you.
Hello there, Dan. Yes, certainly investors hitting that sell button pretty much across the board. All sectors on the Hang Seng Index are losing money. If anything, there was a bit of an outperformance, relatively speaking, when it comes to utility sectors. But of course, as you can imagine, the tech index under a lot of pressure, down 3.5%. That has been really the case all morning. But bear in mind, all this is actually coming off from the session lows, so deeper in the red right at the market open. But when we're talking about the Hong Kong markets, this actually started yesterday in terms of the tech declines. But today, we're actually seeing deeper pain pretty much across the board, sort of that sell-off spilling into other sectors as well. Let's take a look at some of the top heavyweights just to show you what the likes of Tencent Holdings are doing. And of course, there is really no exception for the financial names either, with the exception, of course, the CCB. I stand corrected. In the meantime, I think it's important to point out how what's happening at the market close today. The Hang Seng Index rebalancing is happening, welcoming in new constituents, including Alibaba, Xiaomi, as well as WuXi Biologics. So Tencent's weighting will be adjusted lower a little bit. And in the meantime, we've got stocks such as Alibaba giving up a lot of its recent gains, down as much as 5% in the early morning trade, or in the morning session, I should say. In the meantime, Taiwan markets are seeing a lot of tech weakness as well. Remember, this is a very much of a tech-driven, Apple suppliers-driven market, and that index is also down 1%. Notably, though, the Taiwan dollar is actually a regional outperformer in the region as well. That's a quick check on Hong Kong and Taiwan markets on this Friday. Now let's get out to Sam Vadas for a check on the mainland Chinese action. Sam?
Thanks very much, Sherry. And in terms of the reaction to that sell-off on Wall Street overnight, over on the mainland markets, we have seen Apple suppliers falling after the tech giant tumbled 8% in its worst session since March. Over in Shenzhen, we had Lens Technology, which produces touch panels, and Goa Tech, which makes acoustic components, leading the declines this morning, both falling over 3.5%. We also saw leading Chinese consumer firms dropping again over these concerns of high valuations. Leading the fall this morning was Foshan Haitian Flavoring, which is said to be the largest manufacturer of soy sauce in the world, which has dropped as much as 9%, extending those declines yesterday of 6.8%. The index, which actually tracks these consumer staples, has shed as much as 3.5% and is actually on track for its worst session since July. But it is still up more than 50% this year amid these efforts by Beijing to actually boost domestic demand. We have seen, though, pretty much red across the board in the morning session, with consumer non-cyclicals and healthcare stocks really leading the declines on both the major indices. Bucking the broad trend, though, today has been shares in Chinese semiconductor firms, which climbed this morning off the back of a Bloomberg report of more state support for the domestic industry. So this report says that China is now planning a set of new government policies to actually help boost the sector and counter some of these restrictions from the United States. And so leading the gains this morning was Tech Semiconductors over in Shenzhen, which climbed over 13%, while SMIC, that is Semiconductor Manufacturing International, China's big chip maker, has been up over 2.5%, which of course is interesting because it does come as China has been throwing a lot of support behind homegrown companies in the face of some of this US pressure as it becomes or aims to become more self-reliant in the tech sector. But that's a quick check on the mainland markets. Let's have a look at the Aussie markets with Will. It's over to you.
Thanks, Sam. Though the ASX is the laggard of the Asian market session. It's off by around about 3.1% right now. The Australians are also showing weakness at 72.7. And even some of the sectors where we did see a little bit of strength earlier on, especially when it does come to Australia's gold plays, they're all off and in the red. So there really has been a lack of any kind of positive conviction or momentum here on the Australian markets. And I suppose that's been buttressed by the fact that there's been no clarity on the national border situation internally here in Australia. We just heard from the Prime Minister, Scott Morrison, talking about how only 7 of the 8 states could come to some kind of agreement. Listen in.
We agreed that before you know what you're going to do, you've got to agree about where you want to get to. And we agreed today with the objective that was set out in the May plan to be at the end of that Step 3 process, which we will seek to ensure is even better defined. We said before we wanted to get there in July, and the virus prevented us from achieving that. 7 out of 8 states and territories want us to get back to that position in December of this year.
So the laggard when it does come to those states, Western Australia, they've got no plans to reopen up their borders. Perhaps that is somewhat tied to the fact that the mining industry, if there was to be any kind of issue, would be severely impacted by any kind of outbreak of COVID-19, and is incredibly important overall to Australia's economy. At the same time, though, this is also going to impact this December kind of aim from the federal government and the states, the airlines, and in particular, one that has recently just had everything sorted out when it does come to its ownership process for the most part. Bain Capital winning in that creditors' vote when it does come to the administration process that is currently underway. So they got 97% of the creditors by value, which is considerable considering the amount of bondholders that were relatively miffed at the process. And there is some reporting that does suggest that there was a little bit of consternation between some of those bondholders and the Virgin administrators trying to basically claim that Virgin was insolvent back in November when it raised cash and not in March as they've previously guided. So it is going to be interesting. But I think more important, Dan, is going to be if we don't see these borders reopen, not only for Virgin Australia, but for Qantas as well, how long they'll be able to burn the cash at the levels that they currently are, and whether this does put Virgin in a bit of a pickle when it does come to competing with Qantas moving forward.
Thanks, Will. We'll unpack that story a little further later on in the program. Live analysis on the markets now with Mark Joly. He's global strategist at CCB International Securities, joining us from Hong Kong. Mark, good morning to you. I know you've been following the asset market reaction here. Great day for the bears, bad day for tech stocks. Is this the sell-off that we had to have?
Well, you knew it was coming eventually. Look, I think so. I think there are three things going on here. One, you know, I could give you a shopping list of indicators that suggest that, you know, equity markets were facing some kind of price exhaustion. Secondly, you know, I think economic surprise is starting to roll over. You know, we're going to see a withdrawal of economic stimulus in the next 6 months, so that's going to slow the growth recovery. And then thirdly, you know, the market has rallied on this expectation of yield curve control, which I think is not going to happen. And so there's some risk we're going to get a jump in yields as growth slows. So these are three things which I think are, you know, underlying the market, and may mean that we get a more deeper pullback than what we've seen to date.
Okay, so Asian stocks on track as we speak for their worst weekly decline since April. You're saying we could have a further pullback from here, is that correct?
Yeah, I think so. I mean, if you simply look at, I think, you know, the US markets are clearly leading this. If you look at the S&P and the NASDAQ, they're both, you know, at the top of very important kind of trading ranges, trading channels. It would be surprising if they only pulled back, you know, 3 or 4% after, you know, such a massive rise. I think it's much more likely that they at least pull back half of what they've delivered in returns since March.
What are you telling clients right now? Do you see any opportunities to add to positions in this environment?
You know, look, it's a very interesting situation that we're in. We've been in a market where certain sectors have just outperformed and crushed other sectors. Obviously, tech, consumer discretionary are the two. Other sectors like financials, materials, energy, you know, have collapsed. So, you know, at some point, I think we're going to see investors rebalance towards some of these underperforming sectors and away from tech. And you know, I would be suggesting that because I think the very low interest rate environment that we're in is changing, and that will cause other sectors to perform much better in a relative sense than they have. But overall, you know, our view would be that, you know, EM looks very cheap here relative to the US, particularly credit, US dollar credit in Asia, I think, you know, looks quite attractive relative to global credit.
Okay, very interesting. You know, Mark, at the same time, we have investors now counting down to the release of the non-farm payrolls data this evening. This week, we've seen a dismal slew of data points, the ADP missing by 500,000 jobs, the Beige Book also saying that the US recovery is slowing. Are we going to see confirmation of a jobs build slowdown when we see this data this evening, or are we going to see a surprise to the upside? It could go either way.
Yeah, so I mean, the situation we have is we have a lot of people who have been temporarily laid off. And, you know, the question is whether or not they remain laid off permanently or whether employers start to put them back on. The pattern that we've seen so far is that for every firm that hires back 4 labourers, they let one go. But that's because we've had a lot of fiscal stimulus, a lot of government support. That government support, as it's dropping out, and it's obviously dropped out in the US quite significantly because of the, you know, what's happened with the CARES Act. You know, I think the risk on US numbers over the next 2 months has to be disappointment. So, yeah, I would agree. I think there's some risk on this number.
Mark, I also wanted to ask you about a couple of other factors weighing in the market as well. There is some complacency about the US-China narrative right now, and I understand that. Obviously, this has been a theme that investors have been focused on for a number of years now, and the complacency is understandable. But there does also seem to be some complacency with regards to the US election risk, and this is something that I wanted you to weigh in on as well. What do you think equity markets are pricing right now? I understand there's distortion in the market today, but which way does this sway? Because if anything, I would assume that markets right now are pricing a continuity of Trump policy. Is that a fair assumption? Is that the right way to be thinking about this? Because I'm not really understanding what markets are expecting here regarding the US election.
Yeah, it's a tricky one. If you look at volatility curve, which is, you know, kind of a contract that prices risk, it's pricing in very significant event risk around the elections. So, I think people are expecting that we're going to see a lot of volatility around the election. But from a directional point of view, I think that the view has been that the equity rally will continue regardless of who wins the election. That would be my perception. Certainly a couple of the major US houses have come out with fairly, optimistic viewpoints on whether it's Biden or whether it's Trump. But, from my perspective, I think the tax implications for corporates and the overall operating environment will be much more less favorable under a Biden victory. So, I would tend to agree that it's not fully priced. In terms of the US-China conflict, I think the problem has been that most investors have been very focused, on tech, and have taken a view that, the Sino-US dispute isn't really going to affect the bottom line of the big tech names like Tencent and whatnot very materially. But, I think that remains to be tested, because what's kind of confused the situation is the US support to consumers has been so high, it's really boosted Chinese exports to the US over the last 6 months. What worries me is that, as we move into the election, if President Trump wants to use the US-China relationship as an election issue, I think it could be that could definitely cause some volatility.
Right. Mark, we'll have to leave it there. Thanks for joining us today, talking us through all of the market action. That's Mark Joly from CCB International Securities. More news and analysis straight ahead for you. Stay with CNBC.
How we see the economies functioning is actually slightly better than the assumptions we've put into our models. So we think that we've been very conservative in the first and second quarter.
Retail activities, they kept up well despite the major impact of the lockdown on clients, on point of sales.
We assume that there will be a U-shaped scenario. We will see a recovery now also coming already in the third quarter.
Should expect lower credit provisions going forward, unless, of course, the macroeconomic assumptions change to the worse.
I do expect the second half of the year maybe not to be as benign as the first half, but still quite robust.
The economies will not go in the same lockdowns that we saw in the second quarter. We see an improvement, whether it's retail or CIB.
There's a lot of uncertainties in the marketplace, so we don't want to get too far ahead of ourselves. But I think it's gratifying to see, the momentum continue into the third quarter.
Welcome back. Well, Middle East markets ending the week like this. Dubai leading the gains, up 1%, seeing a rally in property stocks. Here in Abu Dhabi, markets edged up 0.1%, helped by gains in First Abu Dhabi Bank, while the Saudi Tadawul rose 0.4% as heavyweights Al Rajhi Bank and SABIC propped up the index. Meanwhile, the Turkish lira slipping to a new all-time low as inflation remains high. The rate hovering at that 12% level despite the lockdowns, well above the central bank's 8.9% forecast. The month-long lira sell-off stems from concerns over the central bank's thin currency reserves, and some analysts now warn that if the sell-off continues, interest rate hikes might be needed, despite the economic slump the country is in due to the pandemic. And Saudi Arabia's finance minister says the kingdom's economy isn't out of the woods, prompting the government to accelerate non-oil sector reforms. Speaking at a Euromoney event, Finance Minister Mohammed Al-Jadaan said the easing of restrictions in the kingdom had resulted in higher occupancy rates across hotels and accommodation and growth of 15% year-on-year in the tourism sector. But challenges remain, with the severe impact of the pandemic and low oil prices forcing the government to balance its giga project plans with new fiscal austerity.
Signs are actually very positive that the economy is getting back and recovering. But we are also very cautious, and we wanted to make sure that we are not out of the woods. We wanted to be cautious and watch what is happening around the world and be prepared.
The IMF says the world's largest oil exporter could be set to record its worst economic year on record this year, with growth falling by almost 7%. Let's get you a check on what's happening with crude oil prices right now, and you can see oil well down. You can see WTI and Brent off by more than 1% here. More losses after 2 successive days of losses. Risk aversion in the broader financial markets means oil is now on track to record a weekly drop. And with oil down more than 1% here, I also wanted to flag some research from MUFG today. The firm was out with a note last night saying essentially the pulse of oil markets remains wedged between the push and pull stemming from the virus and the reopen. Analysts say there's no case for 50 USD oil yet, but also there's no case for oil to break below 40 USD. Get this as well, they also flagged 3 key risks to the outlook. The first is bouts of volatility due to changes in investor sentiment. Interestingly, look, that's playing out right now. The second is a risk that OPEC Plus could switch strategy from supporting prices to defending market share. CNBC is going to have some more insights on that for you next week. But I think the third point is the most interesting. MUFG saying a Biden presidency could, quote, materially distort global oil markets, given his promise to spend $2 trillion in clean energy and possibly re-enter the Iran nuclear deal, which could add to global supply. Some food for thought for you, with prices on track for a weekly decline. Coming up on the program, Facebook bans new political ads in the lead-up to the US presidential election. Its latest move to stamp out misinformation. We'll get you all of those details up next when Capital Connection continues.
Across the world, lockdowns and social distancing measures have forced many retailers deemed non-essential to close their physical stores. The shock fall in revenue has pushed many firms into financial crisis. In the UK alone, fashion chains Oasis, Warehouse, Debenhams and Cath Kidston, just to name a few brands, went into administration. At the same time, consumers confined indoors were forced to use online shopping for most items. In April alone, Inditex, the biggest fashion group in the world, which owns Zara and Pull&Bear among others, reported a 95% increase in online sales. H&M reported a 40% jump in online sales from December till the end of May. And this is a trend that's likely to accelerate as more people come online.
Welcome back. We're about 2 months away now from the US presidential election in November, and President Trump is encouraging voters to test the system, suggesting they can cast their ballot twice, once by mail and once in person. That, as you can expect, is not sitting well with electoral officials. NBC's Pete Williams has the story.
In North Carolina, where mail ballots start going out, President Trump continued his attack on voting by mail, suggesting that voters test the system by voting twice, once by mail and then again at the polls to see if they can do it.
So let them send it in and let them go vote. And if their system's as good as they say it is, then obviously they won't be able to vote.
That prompted a stern warning from election officials and prosecutors.
To go and try to vote a second time as a way to test the system is a felony in North Carolina. Do not do that. It's a terrible idea.
Election experts say it won't work anyway. Here's why. If a voter is sent a mail-in ballot, that's noted in the official voting record. When voters show up in person, a poll worker checks their names in an electronic or printed version of that record. It flags those who were sent an absentee ballot, shown in this example from Michigan with red question marks. If they insist they never sent it in, they get what's called a provisional ballot, which won't be counted if it turns out the mail ballot was sent after all. Experts on the nation's election system say duplicate votes are easily flagged.
If someone were to vote twice, even if they did so innocently or they forgot what they had done, that will be caught.
Many states allow voters to track their mail-in ballots online to make sure they're received. But President encouraged people who vote by mail to go to the polling place on Election Day anyway to see if there is a record of it, and if not, to vote in person. State election officials advise against that, saying it will just slow down the voting line for everyone else. And now Twitter says the president's tweet violates its rules on election integrity.
Facebook has announced it will limit last-minute political ads in the week before the US election. The individual campaigns will still be allowed to run ads that are already in the system, but no new content will be permitted. CNBC spoke to Nick Clegg, Facebook's VP of Global Affairs and Communication, about the level of transparency the company hopes to achieve.
All these ads go into an ads library, which is far more transparent than political ads that are run on television or radio or in the printed press, where you can see who's paid for a political ad, who's targeted, when they're running it, all the different variants of the political ads. So we believe that that mixture of extreme transparency with this hard limit that new ads cannot be produced for a week up till election day, hopefully will mean that the ads do what they're supposed to, which is allow politicians to communicate to voters, get the voters to vote in the first place, but avoid an ad being run at the very last minute in a way that sort of hijacks the final stages of the campaign.
Nick Clegg there. Coming up on the programme, the annual Ambrosetti Forum kicks off today as European policymakers gather on the shores of Lake Como to discuss the future of the bloc's economy amid the virus. We'll be live with our very own Steve Sedgwick up next. Stay with us.
is CNBC Breaking News. Market sell-off.
Welcome back to the program, and we're following a market sell-off across Asia today. Let's get you a pulse check on what could happen when the European session gets underway. Here's a look at some of the European opening calls, and you can see downside pressure expected for all major markets when trading gets underway. This, of course, comes after we saw the S&P, the Nasdaq and the Dow recording their worst day since June overnight. Policymakers and European leaders are in Italy as the Ambrosetti Forum kicks off today. From the global pandemic to the market sell-off, there will be no lack of things to talk about. Someone who's pretty good at talking is Steve Sedgwick. He joins us there live now. Steve, I was speaking to one guest earlier on the show today, and I asked, look, is this the sell-off that we had to have? Valuations have been looking pretty stretched. What's your take on the market sell-off that we're seeing right now? How would you characterize it?
Yeah, well, I will comment on that because it is quite extraordinary what we're seeing, but not unprecedented, Dan. And actually, we have seen sell-offs of greater magnitude before in this crisis. And also, let's face it, as the point that I and others on this channel have been trying to make for a very long time, not all stocks are created equally. And if we look where the sell-off was concentrated yesterday, it was the stocks that have had this most meteoric rise. Now, we know that a lot of the stocks in the technology arena, IT services, communications, consumer discretionary, primarily likes of Amazon and Apple and others, have had an extraordinary run-up. They have gone to extraordinary levels. And if you are an investor rather than just some punter or some Robin Hood retail investor who's just trying to ride a momentum trade, there is probably a longer-term trade in there still, according to the copy I'm reading. But the fact of the matter is, if you are an owner of these stocks and looking to be an owner, they have had an extraordinary run-up, including yesterday's sell-off, so nothing particularly to worry about there. But the fact of the matter is, if you are just a punter and just trying to ride the waves of momentum on this market, then maybe you had a bit of a bruising day, because I can tell you, no one in the real world, and it's great to be back in the real world. This is my first outside broadcast outside of the United Kingdom that Mike and I have been on pretty much since the height of the crisis. Well, no one in this real world, where we're looking at economics, where we're looking at politics, where we're looking at central bank action, is looking at the markets and saying, oh yeah, they were right, we're off to the races, everything's fine, because the crisis is clear and present still. There is no doubt about it. We have seen a rise in COVID infections around the continent, and of course globally it continues to be stunningly infectious. And I've already done 2 panels here at Ambrosetti last night where nobody was ebullient about the short-term prospects for the economy, despite hopes that actually this could be a catalyst, this crisis, for greater things to come, greater things for the Italian economy in terms of structural reform. They're looking at digitization, they're looking at green initiatives, they're looking at more social inclusion, but they now have an opportunity to do this because of the recovery plan, which has put 209 billion euros potentially into the economy. But they've been given cover by the ECB, given cover by the EU and the European Commission. The question is, what will they do with that cover? Because the numbers are still very, very bad. And I've spent a lot of the last 10 years with Jeff and Karen looking at 130% debt to GDP for Italy. Well, I can scratch that out now. You can make it near 160% debt to GDP. But is the heart and soul of Italy back within Europe now? Because there were questions early in the crisis about the response of Europe towards Italy, which went into this crisis very early on with circa 35,000 mortalities, horrendous numbers. But I've already been speaking to some of the great and the good here as well, including Valerio Di Moli, who is the managing partner and CEO here at the European House, Ambrosetti, and he made some very interesting comments about Italy and Europe and about Brexit.
Now, it seems that the Italian position within Europe is much stronger now than it was with the so-called yellow-green government 1 year ago, for sure, even though the Prime Minister is the same, but the coalition is completely different. And also, the Brexit situation impacted tremendously on the rest of the European Union membership. The other member states became much closer, and the veto power that the UK expressed for every single vote decisions is now non-existent anymore.
So is the EU better off without the British?
I think so.
You do?
Frankly speaking, yes.
Without the net contributions, without the...
I'm not talking about the economic and the financial aspects. This is a different story. But I'm talking about the geopolitical climate and the agreement mood you know, with all the differences and nuances, the Nordic countries, the Netherlands, you know all the story. I don't want to bore you too much with whatever is already renowned, and now to the history. But was a great fight, reduced in a couple of weeks negotiation. Now it's over, and for the first time in history, the member states, the 27, have accepted a consolidated debt. The recovery fund is consolidated debt. It's nothing different than that. Then we can talk about the financial situation and everything else. But as an entity, the European Union is highly attractive for investments. In a general environment where yields are negative or close to zero, Europe can be very attractive also as a destination for investment. So I don't think it will be a major problem to replace the lack of money coming from England.
So for so many years, you and I have talked about, quite frankly, political chaos in Italy as well. Are you saying that COVID has not only given more cohesion to Europe, you've answered that question, but also created political stability in Italy as well? And we'll find out a little bit about that in the regional elections soon to come.
I think so, yes. It's nothing that we would have wished. I would have preferred big chaos, as always, and not the COVID around us, frankly speaking. I mean, we are now joking a bit around the topic, but we have registered 35,000 deaths in Italy only. So it's really a tragedy. We didn't really want to have that in order to have a little bit of more stability. But as a matter of fact, yes, you are right. Now, nobody has the interest in breaking up and in changing. In the political history of the country, we always have had some party, some coalition, someone with a great interest in breaking up and destroying the table.
I think it's very interesting here what you had to say, Dan. I think there is a degree of optimism in there as ever as well. I think there are elements that are populist elements in Italy which are rearing their heads still. I think they're coming from the right of the political establishment. We'll talk about that a little bit more later on over the next couple of days here in Ambrosetti. But back to you for now, Dan.
Steve, appreciate the update. Looks absolutely gorgeous out there. Enjoy it, won't you? Steve Sedgwick live for us in Italy. OK, coming up, Chinese President Xi Jinping hailing China's resilience and warning it will never be bullied by external forces. He made those comments at an event marking the 70th anniversary of Japan's surrender in World War II. Listen.
Never will the Chinese people allow any attempt of anyone or any forces to impose their will on China through bullying, to deviate the country's progress, or to hinder the Chinese people's efforts in building a better life.
President Xi will be speaking at the China International Fair for Trade and Services later today. The trade event in Beijing is the first major one for China since the pandemic, and Xi will no doubt continue to champion global growth through cooperation. Up next on the show, markets waiting for the next big risk event. It is, of course, non-farm payrolls due later today. Will it help to stem the market slide? Ahead of that, here's where gold is tracking. We're back in 2 minutes.
CNBC brings you conversations with the world's greatest minds. From the world of politics.
We are not going to pay any single cent for such a stupid war.
To the boardroom.
Failure is not the opposite of success, it's a stepping stone to success.
And royalty to Hollywood royalty.
I want to give a cultural face to older women.
The biggest topics and the biggest names, all on the CNBC Conversation.
As we cover COVID-19, our business is business. Stocks are telling us that the economy is going to come back and resurrect itself relatively more quickly than some of the economic numbers say. Making sense of the disconnect is what we're trying to do every day for our viewers. The way we socialize, the way we travel, it's all going to be changed for many, many years. This is seismic, it is historic, it is the story of our lifetime.
Welcome back. We're following a market sell-off across Asia after heavy declines in the United States overnight. That sell-off taking place ahead of the release of August non-farm payrolls report, which is due later on this evening. You can see downside calls on the S&P 500, the Dow and the Nasdaq, traders bracing for impact. Rosanna Lockwood joins us now with a preview of what we could expect out of that NFP report. And Rosanna, clearly a lot riding on this from a market perspective, but a lot riding on this for the economy as well.
That's absolutely right, Dan, and a lot riding on it for the tens of millions of Americans who are still looking for jobs at the moment. So you've got the big non-farm payrolls report coming out stateside Friday. Economists polled by Reuters expecting around 1.4 million jobs to be added to the US economy. But even with that 1.4 million add, that would still leave non-farm payrolls about 11.5 million below where they were pre-pandemic. So by any normal metric, that's a big add, 1.4 million. But not by today's standards when we are still trying to make up that shortfall from the pandemic. US unemployment rate, Reuters economists expecting to be around negative 9.8%, which is below that negative 10% that we have seen as well. There has always, for the last couple of months, been a big divergence between the non-farm payrolls and the ADP report that we got out on Wednesday. Saw 428,000 jobs added to the economy, and that is down to methodology differences. And picking up on methodology differences, how about this? The weekly jobless claims coming in below a million mark to 881,000, but must point out that the Department of Labour has changed its methodology for its seasonally adjusted data. So economists saying actually perhaps look at the non-seasonally adjusted data. And when you look at that, the raw data, there was a 7,500 jump from a week-to-week basis. So despite it looking below that million mark for the initial claims, you've got to look at the bigger picture net as well and the methodology used to crunch these numbers down. And it perhaps isn't the rosier picture that you might see in the headlines. And once again, pointing to the stalling recovery in US labour market data.
Very interesting. Rosanna, thanks for the update. Let's get you some more analysis now with Rob Carnell. He's Chief Economist and Head of Research Asia Pacific at ING, joining us from Singapore. Rob, before we dig into the details of the NFP, I thought I could get your reaction to the sell-off that we've seen stateside overnight and what's happening in Asia right now. You know, when you look at these markets, we saw the Nasdaq up around 20% in the third quarter alone. The Dow and the S&P really not too far behind that. How would you characterize this, and is this the sell-off that we had to have? It seems to be the general theme that many are saying right now.
Yeah, I kind of been looking for a sell-off for some time. I'd have liked to have seen a proper one, but I think all this really is a bit of profit-taking. If you look at it on a nice sort of lengthy chart, giving yourself plenty of back series to look at, it's not that significant. We've seen such big rises in the Nasdaq and the S&P for that matter, that what we've just seen is really very small beer compared to this. And I think ahead of the payrolls numbers, you can really just put this down as, well, you know, just maybe taking a few bets off the table, not wanting to be too exposed going into these always tricky to predict numbers.
So what does the market reaction pre-data tell us about what we should be expecting tonight? What's the narrative on non-farm payrolls from your perspective?
Yeah, it's a very difficult one because, you know, I'm a macroeconomist, that's my day job, and much of what I look at has had very little impact on the markets. It'd be nice to think that the macroeconomy and the markets at some stage would actually converge and start giving us more or less the same story. And of course they don't at the moment. I mean, your reporter earlier was talking about the big gap in terms of pre-COVID employment, even if we get this 1.5 million jobs gained tonight, which, you know, is questionable. The ADP numbers haven't been great predictors, but they're the best we've got out there. And they've consecutively told us now things aren't going quite as well in the labour market. So it's entirely possible that we get a softer figure. And normally you'd expect the market to sell off on that. But, you know, given the way that markets behave these days, it's anyone's guess how they respond.
Yeah, indeed, a really interesting repricing here. So, Rob, what does the jobs recovery look like stateside, and how are you assessing the recovery overall?
Yeah, well, it's slow. It's much like everywhere else. You've got a lot of people who are still furloughed, a lot of people who've actually lost their jobs. The overall picture for the US economy isn't bad, but it's very, very mixed. And there's still a lot of sort of artificial support there, which looks rather creaky. So a lot of the retail spending numbers, which look, you know, by almost any definition like a V-shaped recovery, that's almost entirely supported by the federally paid supplemental unemployment benefits that are running out, basically. I mean, a number of states are saying they've got about another week left of these things before they'll have to stop paying the extra money. So people on these benefits are looking at quite substantial pay cuts. And we keep on talking about fiscal stimulus. But what we're actually talking about for a lot of these people on these benefits is a substantial pay cut, even if the money keeps coming, which is in question. Other bits, industrial production, still look pretty soft, 10% down on where they were pre-COVID levels. So it's a real mixed bag out there.
Indeed. Rob, before I let you go, I wanted to ask you about another conversation that seems to have taken centre stage this week, and that is what's happening with the US dollar. And perhaps we can just pull up the US dollar to get a look at what's happening right now, because looking at this, we're actually on track for our first weekly gain in about 4 weeks here on the greenback. Do you think that perhaps some of the factors that have driven the USD lower over the past 4 to 5 months are starting to wane here?
It's possible. I mean, the main narrative for this has been the Fed's commitment to basically keep rates on hold virtually forever, it seems. They're saying that, we're not going to see any substantial moves or tightening until we see inflation push above probably the 2% inflation target. Now, by most people's guesses, that's not likely to happen in any sort of near-term time frame. That's been supportive, but how long can a market just rest on one story alone? It always seems to need a little bit more to keep going. But in the absence of apocalyptically bad news, this is a market that's wanted to just keep on going. So, again, I wouldn't want to stand in front of this right now and wave a big flag and say it's definitely over.
Rob, we'll leave it there. We know you'll be staying up late tonight to watch that data drop. That's Rob Carnell from ING there. All right, moving on, and let's get you a check on what's happening with shares of Goldman Sachs. This is going to be in focus when the US session gets underway, because a Malaysian court has dropped criminal charges against the US bank following its $3.9 billion 1MDB settlement. Goldman was the main banker for the state fund, you'll recall, helping it raise billions of dollars. Wouldn't be Capital Connection without your sport hit as well. The English Premier League has ended a major Chinese TV streaming contract with PPTV after just 1 season. The league made the announcement with no further comment. PPTV reportedly paid $650 million for 3 years of broadcast rights in China, but disagreements have emerged about the value of those rights, and PPTV is said to have withheld a payment due in March. PPTV is owned by Chinese conglomerate Suning, which has a majority stake in Italian club Inter Milan. Coming up on the program, Virgin Australia's creditors have approved its buyout by Bain Capital. Details up next. And as we head into a break, take a look at shares of Honda. Have a look at this, bucking the broader trend, rising over 3% at one point today after the automaker announced it was teaming up with General Motors to develop vehicles in the United States. Shares at 2,747 yen, up almost 2%. A bright spot in an otherwise disappointing day. Capcom back in 2 minutes.
A former world leader dedicated to making a difference.
I'd always had a sense of mission, a sense of purpose.
A statesman looking to heal rifts and repair relations.
In my case, it's trying to act as some sort of bridge between, I won't say East and West, maybe China and the United States.
Join me, Tanya Breyer, as I sit down with former Australian Prime Minister Kevin Rudd, only on the next CNBC Meets Defining Values.
Virgin Atlantic is set to seal its £1.2 billion rescue deal this week. The airline's restructuring plan got a green light from a London judge, and the company now hopes the deal can help it weather the coronavirus storm, which has forced it to close its Gatwick base and cut over 3,500 jobs. It has said it would run out of cash by the end of this month without a deal. Meanwhile, Virgin Australia's creditors have voted to support Bain Capital's buyout of the airline, which will allow the carrier to exit voluntary administration. Under the deal, unsecured creditors would get a return of 9 to 13% of their investment. It would also cut about a third of its workforce as it trims unprofitable routes. Let's bring in Peter Harberton on this. He is Chairman Emeritus at CAPA, the Centre for Aviation, joining us from Sydney. And, Peter, this is really interesting because what we've seen here is certainly some heavy disruption for the international airline industry. But with regards to Bain and Virgin, do you think that Bain is the right shop to repair some of the damage done at Virgin and ultimately to resolve this issue for its creditors?
Well, I think the creditors have taken something of a haircut in this process, unlike a lot of us in lockdown. But I think that the key things are, first of all, Bain has got deep pockets, which is going to be necessary. Secondly, I think they've got the model pretty much right, which is pitching it somewhere between Qantas Group's Jetstar and Qantas itself, full-service carrier. It's an interesting sort of not low cost, but what you call value airline in the future.
So how is it going to play into that gap? How do you increase the customers' willingness to pay here if they pivot the airline from what was originally going to be this full-service international airline to be a more domestic carrier now? How do you increase willingness to pay if you're going to be between that gap of Qantas and Jetstar?
Well, it was predominantly a domestic carrier before, and the domestic market is the one that's going to come back first. I should have said too, of course, in the process of the Bain buyout, they've also dropped the Tiger low-cost airline subsidiary, which was there to compete directly with Jetstar. Yeah, so it's a good question. How can they compete in that market? I think what you're going to see is an airline which is going to go for the business market, but it's going to go for probably a much more price-sensitive business market with a standard fleet of 737 aircraft, which don't have the lie flats of its previous A330s for domestic operations. So it's very much a sort of budget business class, but also with a much lower cost base, attempting to attract a lot of the passengers that will go otherwise to Jetstar.
It's an interesting pivot, isn't it? I remember years and years ago, Virgin came out to Singapore with a massive pitch to international business class travellers. They were investing heavily in the cabin, trying to move people further and further up the nose of the plane where they would have better margins. Clearly, that strategy didn't work. John Borghetti perhaps eating humble pie here. Peter, when you move forward, though, looking at the domestic market, one of the other challenges that Virgin is going to face as it tries to get back into the sky now is the lockdowns that you see state by state in Australia. Quarantine measures are still in place. This is something that IATA has been talking about as well, urging governments to find alternative means to quarantine in order to get people flying again. How challenging is that going to be for the airline on this pathway to recovery, and how soon before we see perhaps some of those measures starting to ease up?
Yeah, there was some movement today. We have a sort of federal cabinet operation with the state premiers involved as well, and there is some movement and getting some sort of predictability in terms of when states and on what basis states will open up to other states which don't have substantial numbers of cases, and I think we're seeing some movement there. Victoria is the worst one at the moment, and it's at the end of two of the world's domestic city pair routes. So once that opens up, things will change. Internationally, I don't think we're going to see a change for quite a long time, frankly, in terms of the 2 weeks quarantine on arrival. And in fact, a report came out this morning from one of our major think tanks in Australia, suggesting that keeping the borders closed until there was much more stability internationally from a health point of view would actually be beneficial to our economy by not having hotspots open up. So it's quite an interesting development in that case.
Indeed. Peter, we have to leave it there, but thanks for joining us today. That's Peter Harbison from CAPA, the Centre for Aviation. Before we go, let's get you another check on what's happening with Asia markets right now. We've been following a sell-off throughout the morning session for you. And as we now push into the European trading day, this is the lead-in that you are getting. Good morning if you're just waking up in London. Hello to you across Europe. It is a dismal day across Asia. Stocks here actually on track for their worst weekly performance since April. A marked pullback here after a long period of stretched price action. That wraps up Capital Connection. Thanks so much for your company today and this week. I'm Dan Murphy in Abu Dhabi. Squawk Box Europe is coming up next. This is CNBC.
Weekdays, Kelly Evans connects investors to newsmakers, stirs up high-stakes debates, and digs behind the numbers. Strengthen your investing strategy on The Exchange. Weekdays on CNBC.
Breaking the cycle. What companies are doing now to diversify and bridge the divide.
Then is anything going to change?
Corporate Insight, Smart Solutions, Squawk Alley.
Welcome everybody, it's Squawk Box, and joining us from London, myself and Karen Cho, and Steve is on the shores of Lake Como. We're going to hear a lot about the views from Italy on the state of the world economy. But let's get into your headlines. Selling strikes Wall Street. The Dow sinks over 800 points in its worst day since June as investors flee tech stocks in an abrupt end to the winning streak. Apple shares plunge 8% in the stock's worst day since March as the tech giant loses $150 billion in market value during the trading session.
Asian equities see red following US majors lower as big technology firms across the region lead declines.
Well, we're seeing volatility resurgent, of course, with the VIX showing its biggest one-day rise since June. whilst here at the Ambrosetti Forum on the shores of Lake Como. The mood remains very cautious about what the rest of 2020 has to offer.
Italy has never seen in its history such a rebound, such a growth rate, and has never seen such a collapse.
So excitement unbounded. I can't remember the last day the three of us actually worked together, and what an irony that just as we're planning to put this programme together overnight, the markets decide to take a bath. So we're going to have a fantastic conversation, I think, over the next 3 hours here as we come to you live from London and, of course, northern Italy, where Steve is at the major forum there. So we'll get to that in just a second. Guys, let me put you on pause for a moment. I'm going to trot over to the wall. I'm going to have a look at how these markets actually closed up the session. So, as you know, if you were watching your portfolio yesterday, the US markets fell fairly heavily throughout the trading session. Largely, it was the technology stocks that took us lower here. So we were off 4.96% at the close for the Nasdaq, the S&P off 3.5%, and the Dow Jones Industrial Average finishing the day down 2.78%. There are so many ways in which we can take this conversation. My technical friends are all getting very excited about this, and the ones who look at the history of these markets are talking about 1929 all over again. They point out that the 3rd of September was a key moment. It was a high for the markets then, and they are looking at the timing of this pullback, and they're saying, could we, dare we, make the comparison with that period? But let's not get carried away with ourselves here. We've had a remarkable run for these markets, as we know, and I think it's a little too early in the day to start doing the big grand comparisons. But you do have to ask yourself some questions, and we're here to try and help you out with those today. Do you buy the dips? Do you sell the dips? We're obviously going to have some choppiness through the month of September here. Has technology gone too far? Has the value segment of the market got an opportunity to catch up here? As you break down some of the performances, the individual performances here, it is worth just noting that as the iShares Russell Growth ETF fell 4.89%, the iShares Russell Value ETF was only down, and I use that word advisedly, 2%. What also I think was quite interesting about the action yesterday was that some of the traditional safe havens didn't actually save you a whole lot. Gold was down 0.35%. Well, that looks a lot better than the declines here, but it didn't stop you from losing money effectively in the selling session yesterday. The Russell down 2.9%. We don't have it up here on the board, but that also just gives you a sense of how broad the decision to step away from equities was. But let's refocus on the headline technology story, because, Karen, I think really that's where the major pain was felt here.
It's the tech superstars. We've been talking about them for months and weeks. The outperformance we've seen just recently, these were the stocks that fell the heaviest. And if you take a look at Apple's stock, that was down about 8%. This is a stock that recently claimed the $2 trillion market valuation level. And despite the falls yesterday, where it showed about $180 billion in market value, it still held on to that $2 trillion valuation. This is the largest one-day loss for any company in history. So a huge reversal taking place in that stock. But before you shed a tear, this company has still had a huge gain so far this year, up roughly about 65% since the start of this year. So stunning gains we've had. And you talk about a reversal like this, sure, it was very sharp, very swift, but is it healthy to see a form of correction like this come into a stock that is trading so high on the multiples? In terms of what we're seeing elsewhere, some of the other big FANG stocks across the board also marked lower. Not as much as we saw in the Apple stock reversal, but still 4 or 5% reversals for some of the other major names. If you take a look at, the likes of Alphabet, that stock down 5%, Amazon down 4.6%, and Amazon, of course, still a stock that is highly rated by the analyst community because of the stay-at-home trends where people are doing more e-commerce than ever before. So Amazon is a stock that a lot of investors still want in the portfolio, yet in session, as everything was sold off across the basket, this stock fell too. But you can see very similar ranges for a lot of these particular companies. Alphabet, if I can just call out Google, I mean, this stock is still up 22% year to date. Microsoft is up 38% year to date. So still enormous gains in the sector. I think you've seen a lot of heat, though, in some of these stocks in particular, and Tesla is a good example of that. It's had a fairly rapid sell-off in recent sessions, about 18% 3 days of losses. That particular stock has suffered. Investors have seen just a huge herding into some of these names in particular, and you can see that stock down 9% yesterday. So that's an outperformance to the downside. Zoom Video also seeing a fairly significant sell-off. So across the board, there was just nowhere to hide in technology, and that's what you expect. I mean, these stocks have rallied, been incredibly resilient. The huge gains we've witnessed have been in lockstep across the board. So it probably makes sense that as you see the market flip, they become leaders to the downside. Steve, you may want to weigh in on this because the market was talking a lot about how there was no shorts out there. No one wanted to get steamrolled with short positions, which is why you had exaggerated selling on a day like this.
Hang on a second. I thought some of those geniuses who have come on this channel for the last 20 years that I've been on it have been telling me about the fear index, about the VIX, which is a great metaphor for the fear in the market. And as I've tried to retort back to them every single time, having traded one or two options in my lifetime myself, in my previous career as well, it is the worst indicator of fear going. It only shows fear when fear has already arrived. It gives you no knowledge in advance at all. In fact, if you look at your VIX chart now, which showed a 26.5% rise yesterday, up to 33.6 from its low, the low of the year, down about 21.3 on the 17th of August. The fact of the matter is, it is the perfect inverse compared with some of these raging bull markets we've seen as well. In fact, you'd have a beautiful inverse chart of what the VIX has done as a time when the market has rallied, because you quite rightly say nobody was prepared to take out shorts in this bull market. Nobody wanted to take out some insurance policy as well. And I say to you, well, this is great news now for those retail investors who are learning on the job, for those legions of new Robin Hood investors who are coming into the market thinking it's a one-way market. Well, what a wonderful lesson you've had. You've still got, as Karen was saying, your 65% increase on the year-to-date in Apple if you were a buyer of this stock. You've still got your 82% rise in Amazon if you are an investor rather than just a punter. You've still got your 386% increase in Tesla year-to-date as well. But what you've got now is extra knowledge that markets can go two ways. You must have really enjoyed that yesterday because you must have learnt a lot.
Let me help our audience understand a few more things and tap into your background in the derivatives markets here, because the story that's been emerging in recent days, and one that I think those who are interested in the plumbing of the markets are concerned about, and those who are interested in the connection between equities and options, they've been looking at Apple and the action in the options market. They've been looking at Tesla, and they've been making a case here that a lot of the rise that we've seen in the underlying equity performance has been about hedging of call options. Now, this is your area of expertise, so let's just delve into this for a moment here. So the argument, as I understand it, but you'll explain the technicals to me, is that some of the hedge funds, some of the Robin Hood community have been buying call options on these companies, expecting the stocks will continue to grind higher. But obviously somebody has to write that contract, i.e. banks like Goldman Sachs. So how would this actually unfold, and why would it make the market vulnerable to big pullbacks?
Well, for a start, again, all these amazing investors who are now delving into areas which they completely understand, like such as the options market, they would have obviously looked at their lessons from the WTI April expiry and thought, oh, I can see what happens when I short a put, and the dangers involved in that on a contract settlement as they saw. So I'm sure they learnt their lessons from April there as well. But you're absolutely right. If you buy calls, you are basically putting a smaller amount of money on the table, expecting growth in that stock. Now, if you buy those calls out of the money i.e. the underlying stock price is below that, then what you are doing is taking an outright premium bet, i.e. you could lose that entire premium if the stock stays where it is or goes up only slightly. But of course, if the stock goes up aggressively, as it has been doing as well, then the delta, which is the actual amount that stock translates into underlying stock, that will go up, of course, as the stock goes in the money, as the call option goes in the money on that stock as well. And that means, as you quite rightly say, those that underwrit that option need to find more underlying stock to cover that as well. And if that's what's been happening, and again, I'll bow to your knowledge on this story, I didn't know that that's what's been driving a lot of this market, then the underlying writers, the shorters of those call options, will have to pick up more delta themselves. They will have to buy more of the underlying stock. But then if you see violence to the downside, of course, it's the call option holders who held the premium. Did they have a short in the underlying stock against it? Did they have some form of a position there, which is a very common strategy for many, i.e. you buy the call and you sell the underlying as well to try and take advantage of market nuances? That remains to be seen. But if the underwriters were short the stock and kept a short position on that stock, then of course they would do pretty well out of this as well, because, I beg your pardon, the call option buyers, because they would lose their premium, but they would have a short stock position to cover them on the downside as well. Were people buying puts as well? Again, my history dictates they haven't been buying puts to cover their premium to the downside as well. It remains to be seen whether this is just a short-term event or people, once again, remembering that options can go in two ways, and if you short them, it can be moved violently against you as the premium picks up.
Steve, it does open a conversation about what happens next from here. And if we look at all those fund manager calls that we keep on seeing day in, day out, everybody's suggesting technology and healthcare are the areas to invest in. So when you get an event like this, you can't help but wonder whether it just presents another buying opportunity for many market participants that may have missed out on buying some of the stocks that they want. And there seems to be an incredible repositioning around COVID-19. Fund managers want certain stocks, and we've clearly seen a remaking of the economy where some companies in particular are benefiting from these accelerated digital trends and others are missing out. This K-shaped index that we've been talking about, the K-shape that's been charted, where some sectors outperform, some underperform, and we keep on waiting for the catch-up to take place in the market, but it hasn't happened. And with an event like this, do we get a market catch-up, or do we just get more buying back into those big-name stocks? And I dare say it might just be the same old trade, that those big technology names come back to the fore yet again. One other point here is that it's not just on Wall Street. There have been question marks around some of the big technology names that are listed on other major stock markets, because they've also tried to play catch-up with those Wall Street names or Silicon Valley names. Jeff?
Karen, Steve, thank you very much indeed for that. We've got the next 3 hours together and an opportunity to help our audience understand in more detail what's happening in the markets. And it's a delicious day ahead, of course, because we're going to look at the non-farm payrolls number later in the trading session here. And we've also had a couple of pieces of data running into those figures, the ADP, the claims numbers, that I think have just left some confusion about the state of the labour market in the United States. So we'll get into that. One other thing, look, if you were watching those market declines yesterday, if you're looking at your portfolio this morning and you're choking on your Cocoa Pops, just hang for a moment, because if you think you had it bad, there are some billionaires who are really counting their losses. The top 4 billionaires lost $25 billion in their net worth in yesterday's session. Jeff Bezos down $9 billion. Elon Musk down $9 billion, Mr. Zuckerberg down $4 billion, and Bill Gates down $3 billion. So some significant paper losses witnessed by those key billionaires. So as Karen was rightly saying, the point is not what happened yesterday. The point is what happens today and what happens on Monday and the following days after that. Speaking to CNBC, Allianz chief global advisor Mohamed El-Erian warned he thinks U.S. stocks could go down further.
We could have another 10% fall easily if, I want to stress, if people start thinking fundamentals. Ultimately, Wilfred, it's do you look at absolute valuation or do you look at relative valuation? In relative terms, stocks seem cheap to everything else. In absolute terms, stocks are expensive. If you're in a liquidity-based paradigm, you will be dominated by relative thinking, and that's where we've been. If you're in a fundamentally based paradigm, you ask the question, am I being paid enough? Am I being paid enough yield on high-yield bonds? And the answer is no, you're not paying it for an economy that faces not just moderation in the rate of improvement, but a rising level of bankruptcies.
Well, Mohamed El-Erian then giving his view that he thinks we could see another 10% to the downside. What do the European calls look like? Well, largely as you'd anticipate, but to be honest, I think these really don't reflect the kind of pain we saw in the US session yesterday. But maybe that shows us that the markets are being discriminating, that it was largely a technology-led sell-off, and while European markets haven't enjoyed the degree of upside we've seen in the Nasdaq and the NDX, perhaps the European markets will give us less downside when there is this kind of selling pressure. Early doors here, but just worth pointing out, the August PMIs have largely this week suggested a little bit of a loss of momentum in the European recovery, but the markets themselves don't seem to have been too perturbed about that economic data. But while we're talking about the legacy as we come into the European session, it's worth catching up with the broader Asian market wall here. And as I look at this wall, again, let me make the point. Investors are being discriminating about the markets they sell off and about the sectors that they are selling off at this stage. Let's get out to Sherry in Hong Kong, who's going to tell us a little bit more about where the most pain is being felt. Good morning, Sherry.
Good morning, Jeff. So, as you rightly pointed out, investors were being selective here in Hong Kong so far this, session. So, yes, technology is really the bottom performer, as you can imagine, given the Wall Street price action overnight when it comes to that particular sector. And that did send the Hang Seng Index down 1.6%. It did actually drag down on some of the other sectors, such as health care, as well as consumer cyclicals that had quite a good run, especially on the back of course, this liquidity rally. But if you take a look at some of the sectors like utilities, for example, they actually, relatively speaking, outperformed or performed less badly. So there is that nature of being selective on a day like this. However, there has been some signs for the last 5 straight sessions. It actually has declined when it comes to 4 out of 5 past sessions when it comes to the Hang Seng Index. And there's a perfect gauge for tech weakness, and that is the Hang Seng Tech Index, and that is down 3.4%. Remember, there has been a lot of excitement over this DNA change when it comes to Hong Kong stock market, with a lot of Chinese technology names coming into to list here in the city. So I think that froth is being taken off the table. Really quickly, there is going to be a rebalance for the Hang Seng Index at the market close today. We've got, of course, Alibaba, Xiaomi, and Wuxi Biologics will be joining the Hang Seng Index as of Monday morning. And so that is perhaps another factor that, behind this price distortion when it comes to some of the heavyweights like Tencent Holdings, which its weighting will be adjusted downward a little bit. Alibaba shares are down 4% at the moment. Jeff, it's back over to you.
Terrific, Sherry. Thanks so much for that. And of course, as we chart the $150 billion decline in Apple, it's worth just remembering where a lot of the Apple product is made. Let's get directly to the China story. Sam, you've been taking a look at the tech stocks in particular as they tie into Apple and, of course, as they exist in their own right. Just walk us through what happened in the Chinese day.
Good morning to you, Jeff. Well, you're exactly right. In terms of the specific reaction to that sharp sell-off on Wall Street overnight over on the Chinese mainland markets, we have seen Apple suppliers falling this morning on both the major indices. The tech giant, of course, tumbling 8% in the stock's worst session since March. So we have seen shares in Chinese companies that make everything from, touch screens to acoustic components falling up to 3.5% today. We have also been seeing leading Chinese consumer firms firms dropping again over concerns of high valuations. We did actually see this yesterday. Leading the fall has been a company called Foshan Haitian Flavoring, which is actually said to be the largest manufacturer of soy sauce in the world, which dropped as much as 9%, extending yesterday's fall of 6.8%. The index, which actually tracks consumer staples over in China, has shed as much as 3.5% and is on track for the worst session since July. Actually, it is still, though, up over 50% for the year amid this boost in terms of domestic demand by Beijing in the wake of the coronavirus. But we have seen, investors pulling back right across the board today in terms of the sectors. Chinese mainland market certainly under pressure, with the benchmark index over in Shanghai actually on track to snap a 5-week winning streak. Steve, back to you.
Excellent, Sam. Thank you very much indeed from that. Well, away from the market oscillation, there is a real world out there, and the real world is tough, as we know, and Italy has had an extraordinary heavy toll which is paid in the COVID-19 crisis. But are there signs of hope? Is there a recovery on the way? Well, we've been discussing already with Valerio De Moli of the Ambrosetti Forum. We'll listen to some of his interesting thoughts after a very short break on Squawk Box.
We expect the second half of the year to remain very volatile. We expect the on-trade not to come back to pre-COVID level until there's kind of a more structural solution. Until that moment, it will be really 2 steps forward, 1 step backward.
The consumer demand will come back. We're confident about that. The pace of recovery, as you point out, is uncertain, and it's very local.
Countries got the crisis under control as much as you can control it. So we'll see how it goes, but obviously going forward there is some volatility associated with the probability that we will see a second wave.
Particularly in the Americas, yes, there's a second wave, but there's still the first wave, which is ongoing. So lack of visibility, difficult to give guidance.
Within automotive, we have seen a certain recovery coming. China getting back, so is also Korea. So we expect that the worst is behind us.
So we're here at the European House Ambrosetti Forum in Como, and it's very interesting, of course. This is one of the biggest gatherings of academics, politicians, big thinkers out there as well. And we're here in Italy, of course, which has had such a huge toll which it has paid. I mean, circa 35 1,000 people have lost their lives in the COVID-19 crisis. The economic toll is enormous as well. GDP falling the best part of 13% in the second quarter. Huge declines there as well. Household spending down 11.3%, exports down 26% as well. And debt to GDP, which we spent a lot of time talking about since the great financial crisis, has now leapt up from around about 130, 135% of GDP to around about 155 to 160. But are there signs of hope? Are there signs of recovery? Well, one of the great wins for Giuseppe Conte was the fact that he persuaded more frugal northern countries to go along with the idea that actually a large amount of money should be given to the south, not in the form of loans, but in the form of grants as well. And Italy will be getting 209 billion euros of that. Has that cemented Italy's position in Europe rather than leaving Italy on the periphery? Well, a lot of people are thinking actually that Italy and its view of the European Union has improved because of that largesse shown at an EC level as well. I was speaking to Valerio De Moli, who is the managing partner and CEO of Ambrosetti, the man who runs this very interesting event with a lot of big thinkers here as well. And he was saying, look, he thinks now, rather than being pushed to the periphery of Europe, actually Italy is back right at the centre of it. He also had some very interesting comments about what Brexit is doing to the European Union. Let's listen in.
It seems that the Italian position within Europe is much stronger now than it was with the so-called yellow-green government 1 year ago, for sure, even though the Prime Minister is the same, but the coalition is completely different. And also, the Brexit situation impacted tremendously on the rest of the European Union membership. The other member states became much closer, and the veto power that the UK expressed for every single vote decisions is now non-existent anymore.
So is the EU better off without the British?
I think so. Frankly speaking, yes.
Without the net contributions, without the...
I'm not talking about the economic and the financial aspects. This is a different story. But I'm talking about the geopolitical climate and the agreement mood, you know, with all the differences and nuances, the Nordic countries, the Netherlands, you know all the story. I don't want to bore you too much with whatever is already renowned and now to the history. But was a great fight reduced in a couple of weeks negotiation. Now it's over, and for the first time in history, the member states, the 27, have accepted a consolidated debt. The recovery fund is consolidated debt. It's nothing different than that. Then we can talk about the financial situation and everything else. But as an entity, the European Union is highly attractive for investments. In a general environment where yields are negative or close to zero, Europe can be very attractive also as a destination for investment. So I don't think it will be a major problem to replace the lack of money coming from England.
So for so many years, you and I have talked about, quite frankly, political chaos in Italy as well. Are you saying that COVID has not only given more cohesion to Europe, you've answered that question, but also created political stability in Italy as well? And we'll find out a little bit about that in the regional elections soon to come.
I think so, yes. It's nothing that we would have wished. I would have preferred big chaos, as always, and not the COVID around us, frankly speaking. I mean, we are now joking a bit around the topic, but we have registered 35,000 deaths in Italy only. So it's really a tragedy. We didn't really want to have that in order to have a little bit of more stability. But as a matter of fact, yes, you are right. Now, nobody has the interest in breaking up and in changing.
So, an optimistic Valeria de Moli there talking to me last night. I was on a couple of panels yesterday, including one with Peter Brabeck-Le Matte, who, of course, is the chairman emeritus of Nestle. He's got some very interesting things to say, so we'll hear from him a little bit later on Squawk Box. And also the former Prime Minister of Denmark, Helle Thorning-Schmidt, will join us as well, not only to talk about what happens next in Europe as well. She's got a very unique position to talk about that, but also she's on the oversight committee of what is going on at Facebook and expressions of free speech on that as well. So it'll be interesting to see how she sees tech regulation going forward. We've got all of that and so much more coming right from here on the shores of Lake Como. But for now, from Lake Como to northwest London, Karen.
Steve, it's so nice to see you on location. I think we're all very envious. Let me tell you what's coming up on this show. The US economy is expected to have added 1.4 million jobs in the month of August, but that would be the smallest increase since May. We'll give you a full preview of the non-farm payrolls report right after this.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Peterffy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building innovative trading and investment solutions. Move into the future and move your account to Interactive Brokers.
Killing regulations than any you know this one.
Good morning, everybody.
Squawk Box, covering the 3 R's on the latest readiness, relief, and record-setting results impacting the nation. Squawk Box on CNBC.
With over 1.3 billion people affected by disability, what can be done to improve inclusion?
This problem is too big for governments and charities alone to resolve.
A missed opportunity for business.
We're losing about 7% of the GDP because of this exclusion. Even if you put the bottom line first, it actually leads you to inclusion.
Finding solutions for disability inclusion with me, Tanya Breyer, only on CNBC.
Everybody, this is Squawk Box. We are live from London and the shores of Lake Como. Here are your headlines this hour. Selling strikes Wall Street. The Dow sinks over 800 points in its worst day since June as investors flee tech stocks in an abrupt end to the winning streak. Apple shares drop 8% in the stock's worst day since March. The tech giant losing $150 billion in market value during the session.
Asian equities see red following their US majors lower as big technology firms across the region lead declines.
Well, volatility, as you'd expect, is resurgent, with the VIX marking its biggest one-day rise since June. But here at the Ambrosetti Forum on Lake Como, the mood remains very cautious on what the rest of 2020 has to offer.
Italy has never seen in its history such a rebound, such a growth rate, and has never seen such a collapse.
So let's come back over to the wall and let's just continue to keep you in touch with the markets as we go into what could be a very interesting Friday session and very pivotal for the way we set up for coming trading sessions. So this was where we closed, and it's clear that the biggest pain was felt really in those indices that have made the biggest gains in recent trading sessions. So the Nasdaq down nearly 5% here, with the S&P 500 off 3.5%, and that tech subcomponent of the S&P 500 really doing the damage. The Dow Jones, well, I was stood here yesterday talking about how we'd finally got back above 29,000 on the close, and that represented the first time since February of 2020. Well, now we are back below 29,000 as the Dow shed 2.7%. The Treasury market is interesting here, I think, because perhaps you might have expected Treasuries to get more support as we got a rotation away from some of those technology, those growth sectors, back into the Treasury market as people look for safe havens. But quite frankly, and I've just dug up some of the research on this, over the course of the week, the two-year yield has gone from, what, 0.127% to, from where it was last Friday, 0.129%. So it's hardly a significant move. And as you look at the week-on-week comparison as to where we were last Friday, probably the most notable change is here out at the long end, where last Friday we were at 1.5%. So perhaps, if anything, the fact that those yields are lower does indicate that there's been some movement into the longer end of the curve here for portfolio protection, as people have perhaps decided to buy a bit of long-end Treasury curve and barbell with some action in the equity markets. Dollar. Part of the reason I think we may have seen so many interesting twists in the commodity market was just the action of the dollar yesterday and in the session today. And the point is that the dollar was a little bit firmer against the recent trend that we've seen with the greenback. Although, having said that, most of the big move yesterday did seem to ease off before we finished the US trading day. But it was enough to do some damage to those key commodities that are priced in dollars. So let me just show you those. WTI, we're back at $40.97, and Brent, $43.70. I will just say, though, before I leave the energy complex, that as you looked at the sector performance yesterday, while tech was by far and away the worst sector performer, energy, ironically, was the best, although it was still down. As you look at the numbers, 0.9% weaker, but that was a whole lot better than the rest of the sectors in the S&P. Gold just climbing back here, making up some of the losses we saw in yesterday's trading session, but it hasn't been a particularly good week for gold. We were down nearly 1.9% week to date. That number obviously needs adjusting here as we make a little bit of gain on the spot gold story. So what are we set up for then as we come into what is a critical day for jobs data? Well, the US futures have us indicated, I would call that flat, really. A little bit negative on the Nasdaq, obviously, with the implied open down about 100 points. But as you look at the S&P 500 and the Dow, really, that doesn't give us a huge amount of direction. So I guess, Karen, if we're trying to connect the market action with the economic data, that does make today's non-farm payroll number quite relevant.
Hard to know whether we get bad news that becomes good news because the market thinks we're going to get more stimulus, or whether good news is good news at this point. So let me just break down some of the figures we've been watching on the jobs market for you. First up, the new US weekly jobless claims came in at 881,000. That was well below the Dow Jones estimate for the first time. Unemployment applications of 950,000. Continuing claims fell by over 1.2 million. Meanwhile, benefit claims under the Pandemic Unemployment Assistance Program rose by around 25% to nearly 760,000. The US economy is expected to have added 1.4 million jobs in August, the smallest uptick since the recovery began in early May. The unemployment rate is expected to fall to 9.8%, the lowest level since the peak of lockdown in April. Now, if we do see that unemployment rate below 10%, that will be the first time since March. In terms of the overall number, the 1.4 million, the payrolls that we're expecting, keep in mind that would be down from the 1.76 million clocked up in July. So even though jobs are being brought back to the economy, it's a slower pace, and the market has been a little bit concerned about that. Given how many jobs have been lost during the crisis, you still need a fairly steady pace of jobs added back to the economy to make up for those job losses. Just in terms of where we sit now, as we count down for the rest of the year in September, we're coming up to the key holiday season, and keep in mind the United States, there's a lot of seasonality around these numbers. Typically, you see more jobs added because there are more Christmas parties, more people are dining out, so you see more of that in the retail sector, on the restaurant sector. But in terms of the other part of the retail sector, of course, more people shopping for Christmas presents, so typically you see those jobs added. The question is whether this time is a little bit different, and you see more cautious employers anticipating that people are not going to be dining out as much, they're not going to be buying as many presents or shopping in stores, they might be reverting to more online deliveries, so that could skew the job picture a little bit more in coming months. In terms of what you've had too, in terms of restaurants, some of those have been added back to the economy, and that's not been too bad of a sector. But more broadly, we've seen these furlough schemes where a lot of employees are being told that they're not coming back to jobs. And I think the next step is going to be federal assistance, whether we see more support tipped into the economy to support those jobs so furloughed staff do actually come back to jobs, Jeff.
Yeah, absolutely. And I think, you know, as we always point out on the programme, you've got to look very closely also at the salary levels and what's happening with wages here. And Steve, I know we were sent a very interesting chart by Chris Watling from Longview, where he's been charting household income. And the chart that he gave us clearly shows a rolling over of household income levels. And if Karen's point about those coming off the furlough and not having jobs turns out to be accurate over coming weeks here, then it looks like the appetite for consumption is going to be weakening.
Yeah, there are so many elements to this as well. And one of the things is that actually Americans and Brits and consumer-led societies, which is what 2/3 at least of the economy, have been saving. Households have been saving. If you've kept your job, you've been saving because you're worried about your job. If you've lost your job, then of course you haven't been spending as much as possible. So as you previously would say, it is absolutely logical that consumer spending has dropped off fairly aggressively. Plus, we're seeing enormous structural changes, of course, in that retail arena that Karen was talking about. A lot of those retail jobs, those bricks and mortar jobs, are never coming back again. We know that. We know that they're never coming back again. In fact, as terrible as it sounds, a lot of these retail parks, that they are gone for good as well. But there are so many elements to this. And one element I want to add is, only a week ago, we were all getting obsessed about Jay Powell, about what he would be saying to the Jackson Hole meeting, and that actually this lower for longer policy of interest rates, this more latitude on inflation on the upside. It was supposed to be some great nirvana, and a lot of us left our heads scratching going, well, what difference does it make here and now when we don't even have to worry about inflation? Well, the answer the markets have told us is not a lot, isn't it, as well? Because the markets are looking at other forms of stimulus that aren't happening. They're just not happening. Where is the multi-trillion-dollar fiscal package coming from US politicians? Where is the infrastructure spending that has been promised, not just in the last couple of weeks or so, or the last couple of months? Where is it coming that's been promised for the last 4 years? That, too, has at least $1 trillion price tag as well. Where are the structural reforms that are going to boost the US and other economies, make them more digital-friendly, make them greener-friendly going forward, improve the social cohesion? And that's not a problem just for the United States. It's a problem for this side of the Atlantic as well. So there's a lot of wait and see. And also, there is a feeling that the central banks are getting near to capacity of what they can actually do to promote economic growth. They can keep a lot of asset bubbles higher. They can keep companies potentially from going bust by keeping zombie companies around for longer, by making their terms of credit easier. But how can they create new jobs and hence create more spending and economic growth as well? They can't. That is the very clear answer from many people that we've been speaking to.
Steve, I want to get into the conversation through the lens of the airline sector, because I think this is one where we all understand the pain points, whether these jobs should survive because the business may come back down the track, or whether we've seen a fundamental change in the industry where effectively business travel has changed and so too has leisure travel. United Airlines this week set of plans to furlough just over 16,000 jobs. That was actually down from an earlier target of roughly 36,000, and they said that a number of workers took early retirement. Some of them had buyouts or long-term leaves of absence. So there was a tweaking behind the scenes where workers made their own decisions, and I'm sure there was some pressure from management too. But in future, the airline officials are saying if there's more stimulus, if there's a further 25 billion bailout to help cover some of these costs, or maybe some of these jobs will not be lost. But it does raise the question whether some of these jobs do need to be shed for the long term, for the viability of the industry to protect it overall, or whether there should be some sort of bridging that takes place still until vaccines or treatments can be worked out, where we have some confidence to be travelling in the air again, Jeff.
Absolutely, Karen. I think, you know, we've spent a lot of years here discussing the nature of the fourth industrial revolution. I know you're very engaged with the tech story, and we talked about the migration to online retailing, and we talked about how we may travel less as we're able to print and manufacture domestically. And so it feels very much as though this COVID story has just hastened some of these trends. And I think we've got a lot to discuss over the next hour and 30 minutes or so. So let's squeeze in a break. We'll be back in just a moment. We're going to take you to Singapore in just a moment to look at how startups are preparing for a post-pandemic economy. We'll have that conversation when we come back.
This is where you can look towards the future and say, yes, I will build it the way I dreamed it.
Do it and do it fast.
Here we speak to inspire and push towards great.
And the connection is this soul in everything that we do.
Here you can change the rules of the game, but whatever you do, never stop.
One step at a time. This is an important milestone.
This is where your passion for reaching higher and creating tomorrow is made possible.
Start on top of the news. Global markets ahead of the game.
Time for this morning's big money stories.
Brian Sullivan, Worldwide Exchange on CNBC.
Think of Singapore and you might think of a bustling financial centre.
Major manufacturing hub, thriving technology haven.
But when the coronavirus hit in early 2020, that image came to a standstill.
Singapore, like much of the world, was sucked into the throes of the pandemic, forcing businesses to shutter and life to go on hold. Staying closed was not an option for long, though.
As the Asia-Pacific headquarters for many major corporations, ensuring business continuity is critical. I'm taking a look at how key industries are supporting that drive to revive the economy.
Even before the pandemic hit Singapore shores, the Southeast Asian island nation was positioning itself as a strategic business hub in a world increasingly fraught with trade tensions and supply chain concerns. But when a spike in COVID-19 cases led the country into an 8-week lockdown, authorities moved quickly to cushion the impact, unveiling more than $73 billion in stimulus.
The Singaporean Prime Minister Lee Hsien Loong has stressed the importance of urgency and agility in the pandemic response, while telling lawmakers, quote, "In the fog of war, it's not possible always to make perfect decisions." The city-state has reported more than 57,000 cases, with the government announcing almost $74 billion in stimulus to counter the downturn. Karen Gilchrist joins us with a special report on how startups are rebuilding. Karen, let's get into this, because these are businesses with hope, with optimism, but not generally a whole lot of capital. How have they fared?
Yeah, absolutely. Good morning, Jeff. So I've been taking a look at Singapore's efforts to move from crisis to recovery. And this week is the turn of startups and how they've been playing a role in this move towards recovery. So I've come down to Block 71, which is an innovation hub out in the west of the city, and where a lot of Singapore's success stories started their days. And I've been looking at how the businesses here have been managing to survive, as you say, and even thrive in this new environment. So whether that's in sort of rising industries like agriculture technology or internet connectivity, or in the case of one of the companies based just behind me, e-commerce, where we've been seeing this huge boom lately. So let's take a look at how one of these companies has been managing to move forward at this time. Startups play a critical role in Singapore's economy. So when the pandemic threatened to uproot the ecosystem, the government unveiled more than $200 million in funding to support promising startups. I've come to Block 71, the symbolic birthplace of Singapore's startup scene, to hear from one of its rising names, cashback platform Shopback.
Shopback is a shopping assistant. We build tools that help users to find great deals, save time, and get rewarded with cashback. Somebody goes through our application, we send them to the merchant portal, and whatever they buy, we get paid a commission, which we share with the user as cashback. This is real cashback they can cash out to their bank accounts.
Since launching in 2014, the Singaporean startup has grown steadily, providing $115 million in cashback to over 20 million users across Asia-Pacific. But when the pandemic hit, the business had to respond to changing consumer habits quickly.
I think users are not cutting their spending, they are just more mindful of how they spend, and they are also unsure where they can spend on when offline options are no longer available. So that's where we introduce what are new possibilities in this new norm. So it's all about helping users to shop smart in different ways.
That included getting more businesses online amid lockdown measures nationwide. In a recent study, 9 in 10 small and medium-sized businesses in Asia-Pacific said they are more reliant on technology due to the pandemic. Shopback, which earns a commission from its affiliate merchants every time a sale is made, added 500 new retailers between April and June, expanding its list of 4,000 brands, including Taobao, Amazon, and Expedia.
Merchants are increasingly more mindful of their marketing spend, and that's where our pay-per-sale model resonates with them. You can see this from the uplift in new merchants joining us. And in the first half of this year, we have driven slightly under $1 billion in sales for our partner merchants, which is actually more than the same period in 2019.
Now, you made an interesting point there at the start, Jeff, that this is a difficult time for cash-strapped startups. But in the example like we've just seen there with Shopback, they were not only able to sort of increase their operations and provide new ways for consumers to spend during lockdowns, but also onboard a lot of local SMEs, both in Singapore and across the region, so that they were able to continue their functions too. So this is kind of an example of where one of these tech-enabled startups is able to actually bring forward other parts of the economy as well. And I think that's an important piece where we're seeing the government is providing a lot of support for these kind of startups too that can help galvanise the wider economy.
Terrific, Karen. Thanks so much for the report. Karen Gilchrist with us from Singapore. And for more on the Singapore From Crisis to Recovery series, you can go to cnbc.com. There's a lot of information and content on there that I think you'll be interested in, particularly if you take a very close interest in Asian markets at the moment. Whether you are Greater China, whether you are Southeast Asia focused, clearly the message today is that the markets are in sell-down mode. But these declines, and I will make the point once again, the declines, whilst they are off more than about 1% across the board here, the Australian market off 3%, clearly a more significant decline. Nothing like the kind of declines we've seen in the US technology stocks. And it's worth pointing out Tesla is down 18% over recent trading sessions. Now, the opening calls for Europe, we are set up actually for a bit of a mixed start here on the futures. So we'll take a look again as we get a little closer to the start of the trading session. But, you know, we always grumble about the lack of technology growth drivers in the European markets. Perhaps this is going to be one of those days where it actually saves the European session somewhat from more weakness. What about the US futures? Let's pop up the board. Any significant declines? Well, actually, the Dow Jones has gone positive in terms of the implied open since we last looked at this board, and even the Nasdaq is showing slightly better performance, an implied open of negative 83 points at this stage. Coming up on the program then, US markets had a real stinker of a day yesterday, didn't they? We got a massive plunge in tech stocks. We will talk some more about the drivers of market action over the trading session for today, and obviously we'll touch upon that non-farm payroll expectation. We'll be right back.
Right now, you have to think about the pandemic in the context of every story and every stock. Over 25% of the S&P 500 is tech. Tech has been carrying the market. Tech was made for this moment. The stock market has already factored in so much good news. Now it's time to see if it lives up to the hype. We talk to the most influential investors at the most important time. This is a financial crisis, an economic crisis, and a health crisis, all wrapped into one. At CNBC, we deliver the market insight you really can't get anywhere else.
Next, managing Asia, Sunny Verghese of agri-food giant Olam International.
Africa alone, 150 million people have lost jobs during this crisis. The health pandemic is now become a hunger pandemic. Our first focus is to help the most vulnerable parts of the population to get them food.
The group CEO of Olam International on the next, managing Asia.
Good morning, everybody. Welcome back. This is Squawk Box. We are live this morning from London and Lake Como, Italy. The headlines: selling strikes Wall Street. The Dow sinks over 800 points in its worst day since June as investors flee tech stocks in an abrupt end to the winning streak. Apple shares plunge 8% on the stock's worst day since March as the tech giant loses $150 billion in market value during the session.
Asian equities see red following US majors lower As big technology firms across the region lead declines, European opening calls also point lower.
Volatility resurges as the VIX marks its biggest one-day rise since June, whilst at the Ambrosetti Forum on the shores of Lake Como, Steve has been just sensing the mood, and it appears to be cautious on what the rest of 2020 has to offer.
Italy has never seen in its history such a rebound, such a growth rate, and has never seen such a collapse.
So welcome back. Let's just revisit the US close here. If you're just joining us, I'll just make a few of the points that I made about an hour ago on the program. The Nasdaq, by far and away the leader in terms of the downside here, and that just reflected the fact that it was key technology stocks like Apple and Tesla and so forth that just led the overall selling, and that obviously infected the S&P 500, tech sector in particular, but all of the sectors, all 11 sectors on the S&P were actually negative. The Dow Jones Industrial Average back below 29,000. We were just talking about that yesterday, the first close above 29,000 that we've seen for the Dow Jones Industrial Average since February, and how quickly that number has now slipped back to something with a 28,000 handle on it. Before you sort of start beating your chest and say the end of the world is nigh, it is probably worth pointing out that actually this is the steepest fall since June. So we have had similar market action already this year, and many of the technicians I know are getting excited about some of the timings with 1929, arguing that the 3rd of September represented a peak for then, and we should think hard about how negative September sessions tend to be here. Well, is this just about a tempering of the enthusiasm that we've seen around particularly technology stocks, or is there something more significant going on at this point? I obviously don't know the answer to that, but it will unfold over coming sessions here. The question you have to think about if you do have fresh money to put to work at this point is, do you buy the dips, or do you sell the dips, or do you sell any bounces that we may get here, because obviously markets never move in a straight line. The other point I want to make about the nature of the market decline is that even as it was largely in the growth sector, we did see value fall, but not as far as growth. So I think that just points to the fact of how concentrated the losers were. And the iShares Russell Growth ETF was down nearly 5%, while the iShares Russell Value ETF down only 2%. Just revisiting the Dow Jones Industrial Average chart for you here, showing that 2.7% decline. What about the outlook for the trading session today? The US futures actually have been improving a little as we've been on air. The implied open for the Dow now looks positive, but we've got a lot of open water to cross before we get to this number. And before you get all choked up about the losses in your own portfolio, I will just point out how the billionaires have fared. Jeff Bezos lost $9 billion in that market session yesterday. Elon Musk, $9 billion. Mark Zuckerberg down $4 billion. And Bill Gates down $3 billion. But I guess unlike a lot of us, they have plenty to lose at this point, Karen.
And the same story when it comes to the big tech stocks that many of them founded. We saw a huge reversal in names across the board. These have been some of the market leaders around COVID-19. Apple, one stock we saw recently crossing the $2 trillion market cap level. It sold off aggressively yesterday, down roughly 8%, but still worth more than $1 trillion. The amount of money shed in one session, $180 billion in market value lost in one day, the biggest loss for any company. So a fairly significant reversal is what we witnessed. But keep in mind, the stock is still up a fairly mighty 65% since the start of this year. Now, why are these stocks reversing? Well, there have been questions about why they're so expensive at this point. We've seen this market rally that has seen outperformers, but has carried these valuations a long way. And some say this is the most expensive Apple has been in about a decade, at 40 times earnings earlier this week. Same can be said for many of the other FANG stocks, and you can see the extent of the reversal. Microsoft down 6% 5% off Alphabet, the owner of Google, and roughly 4+% off Netflix and Amazon. But still, year-to-date performance has been stunning. Alphabet stock is up 22%, Microsoft is up 38%. So in context, you can look at the yesterday's sell-off as just a little bit of reality coming into the mix, a little bit of profit-taking after extraordinary gains. And it gets worse if you plough just a little bit deeper into the technology sector. The likes of Tesla has been on a record run. That stock reversed even more than the broader market yesterday. It was down roughly 9% with about 3 days of losses, now bringing total losses to about 18% over the last 3 days. But it has been a fairly busy week in contrast to some of the other news flow. As you looked at some of the FANGs, questions were asked about what the actual catalyst was for the selling, but there wasn't much news specific around those names. Tesla, though, has had a huge week. You've had that stock split that the market's still been reacting to. On Tuesday, the company's saying it'll raise up to $5 billion through a new stock offering. And Wednesday, the largest outside shareholder reducing its position in the company around portfolio restrictions. So there's been a little bit of noise around Tesla stock. Zoom Video is the other big one to take a look at. The stock, it only just listed back in 2019. It was about a 25 billion market cap company. Clearly huge gains since then. It reported a blowout quarter earlier this week with a whopping 40% spike in the stock price on Tuesday. So the market reversing a little bit of that in session yesterday, 9%. So in context, you still had a huge outperformance in these names. So is a reality check a little bit healthy, Steve, at this point?
Yeah, Karen, I'll pick up there. I mean, it's just extraordinary the amount of new ways that investors and retail investors are finding to add volatility to their portfolio, whether they know it or not. And that's my problem as well. Some of these investors are going into products which, quite frankly, a lot of the professionals have failed ignominiously to make money out of for many, many years. And yet they're going in because they're being offered highly lucrative returns on a lot of these products. And that worries me stunningly. We'll get to some of those in a few moments' time. First of all, we should probably have a very quick look at what the VIX did yesterday. And VIX is often called by, again, some commentators on our channel, perhaps some of our colleagues as well, it's called the fear index. But it's never the fear index when we're going up on equity markets, is it? It never acts as an insurance policy that says alarm bells are ringing while the market's going up. It only ever happens when the market goes down. And that's what we saw yesterday with the VIX popping aggressively. Biggest one-day rise we've seen since June. It's 21.3 was its low back on the 17th of August. It popped up 26% yesterday to 33.6. So a very big rally there as well. But Jeff, we were talking about various products earlier on. Let's just think about this. What are retail investors getting involved with this year that people are saying why? And do they understand the ramifications? One, they got involved with shorting puts on WTI contracts as well in order to get some income from the moves on WTI. And that, of course, led a lot of people into trouble with that crazy April WTI expiry. Two, now you tell me they're buying call options on the upside as well. Well, a call option's pretty much a one or nothing in many ways, i.e. they will either close out of the money, in which case your premium will go to zero, so very high cost there, or they will close in the money and you will make money. But it is stunningly binary decision. Three, they're buying into some of these technology stocks regardless of the valuations. And Karen quite rightly talked about the extraordinary moves we've seen on Tesla this year. This was an $86 stock at its low. It's been a $450 stock, give or take the change, at its high as well. So we've got investors getting involved in those. They're also getting involved in leverage products as well. We have many contributors trying to come onto our show saying, we want you to have this guest on talking about inverse 3 times leveraged margin products. Well, and we're like, I'm not going to touch that with a barge pole. It's not right for our viewers to even be looking at that kind of stuff in the current environment. So I think there's a lot of products out there that retail investors are being told, get involved in these, you're going to make money out of them. But I've got to be honest with you, I don't know if they know what they're doing, because, yeah, you may make extraordinary gains, but as days like yesterday showed as well, you're going to have some violence along the way.
Absolutely, Steve. And I think you make some terrific points about how fast the learning curve is going to be for a lot of retail investors who may be participating in parts of the market where they don't necessarily fully grasp the potential downside. Let's just migrate the conversation to the Asian session and see what the legacy looks like as we come into the European trading day. And I just want to make a point here about the concentration. We were talking earlier about the outsized losses that we saw on the Nasdaq compared to the Dow Jones and the S&P. Well, if you look at perhaps South Korea, look, here's an index that is quite tech-heavy, and yet we are only, and I use the word advisedly, only off 1.2% at this stage. So in spite of the fact that you do have some pockets of concentration, like Taiwan, like South Korea, like the China Tech Index, actually, as far as the Asian session is concerned, it would seem to me that maybe the selling has been a little bit more measured. Perhaps that's a reflection of the fact that really, when we talk about concentration in tech, we really are only talking about a very narrow group of American tech companies. But let's break out the Asian session in a bit more detail for you. Sherry Kang is with us from Hong Kong with more on the market action. Sherry.
Thank you very much, Jeff. And just to help you out, elaborating on that point, TAIEX, for example, that's the benchmark index in Taiwan, which is very much of a tech-driven market. That's down only 0.9% for the day, if it helps. And actually, the Kospi did actually start things off in a much worse fashion, but it actually made a lot of recovery down just about more than 1%. Here in Hong Kong, we've got the Hang Seng Index down just about 1.5%. I think it's important to point out how there wasn't really much of a bigger sell-off or the deeper pain as we progressed with the day's session today, because it actually opened lower by 1.4%. It actually is staying at that level. And if you have a board for Hang Seng Index volatility, since you guys were talking about the volatility index and so on, I thought it would be helpful to talk about what's been happening with the Hang Seng Index volatility, because it's up 11.8% at the moment. It is the highest level since the end of July this year, but it's not exactly the level that we haven't seen since the market rout, since at the end of March. So just to put that into context. However, when it comes to the sectorial theme, yes, the technology seems to be the worst performing sector here in Hong Kong as well. And remember, there was so much excitement over a lot of Chinese technology names coming to the city to list here. And of course, that includes the likes of Alibaba, NetEase, JD.com, Xiaomi, and so on. And they are deep in the red today. So that explains, of course, the Hang Seng Tech Index, which is down 2%. However, it is quite a recovery from the levels that we saw at the market open. Once again, it was open, it was down 5.4% at the moment at the market open, but now it's recovered quite a bit as well. Today is an interesting day in terms of looking at the Hang Seng Index and some of the heavyweights as well, because we've got Tencent, for example, the #1 heavyweight on the index, being adjusted downward in terms of the weighting on the index, because we've got newcomers including Alibaba, Xiaomi, and Wuxi Biologics, and they will be coming in to join the index as of next Monday, or I should say after market close today. So a bit of distortion. Alibaba shares down more than 4% for the day. Jeff, back to you.
Sherry, terrific. Thank you so much for that. Let's have a look at the call then as far as the European story is concerned. Here's a snapshot on the early look at the futures. And as you can see, we're starting to get, I think, some firmer data around the futures, implying that we will have a modestly negative start to the trading session for both the CAC and the FTSE. I will just mention in passing that we had some German manufacturing orders within the last 10 minutes or so, and those numbers were a little bit weaker than the economists polled had expected. These manufacturing orders numbers came in at 2.8% month-on-month for July. The market was looking for a 5% number. So while still positive, they suggest perhaps just a little bit of steam coming out of the German manufacturing segment. Let's bring in Simona Meyer, Global Co-Head of the Alternative Capital Group at UBS. Simona, can we just kick off, before we start to talk about some of the specific areas of the market you work in, maybe I could just get you to address the market sell-off we saw yesterday and what you think that tells us now about risk appetite.
Good morning. Yes, I think what we've seen yesterday is really a result of the fact that all the market is very fragile. I think when you read the commentator, no one could make any sense of some dynamics. It's very hard these days to evaluate companies based on the traditional corporate finance techniques, doing DCF and cash flow and profit. The sentiment is what has been driven a lot of this valuation and a lot of market behaviors, and this goes up and down and changes quickly. And this is, I think, what, in a simple way, is driving the market moving in a way no one seems to be able to predict or explain.
I mean, there has been a rational argument for saying that the markets have led the anticipated recovery. And up to, I guess, this month, we have seen a couple of months where we have actually had a reasonable rate of change in economic activity figures. We're losing some momentum, it would now seem, particularly in the Eurozone. But in the past, you could kind of rationalize a rebound, particularly for technology stocks, because they've benefited not only from the stay-at-home trend, but from broader structural shifts for the economy. Where do you think we are now in terms of that rebound? Are we finding out that it is just a rebound and not an overall recovery?
I think we will continue to see the winner takes all mentality that we have seen over the last couple of months, i.e. investor concentrating and piling on some sector which will benefit from, you call it rebound or recovery, and penalizing the others. So tech clearly has been the net beneficiary of this, as well as healthcare. And I think we will see this continue, but this will go the up and down, i.e. these shares will also be the one who will have the most volatility. And I think it will change. I don't think, in my view, this is in 2 weeks from today, yeah, we can have the same conversation. I think the picture is going to change based on news flow, daily news flow.
Simona, I want to ask you about the special purpose acquisition companies, or SPACs as they've been called, because some people think this is a sign of some of the market excess, about $24 billion raised for this area of the markets since the start of this year. We saw in some of the news flow this week that Bill Ackman was trying to use his SPAC to purchase Airbnb, but that approach had been turned down by the company in favour of a traditional listing. What do you think happens here if all these SPACs are sitting on money that they want to use to acquire a mature unicorn company in the technology space, yet tech has no issues in going to the market itself? So what happens next here?
I think the SPACs are here to stay. I think it's another way for investors to get exposure to public markets without going through the volatility we have been discussing about. So I think the reason why you're seeing a lot of SPAC in this year, it's because the volatility has not been conducive to IPO, and this is effectively another way to benefit from public markets. And so I think we will see more of them. We have a lot of high-profile sponsors which are providing credibility to the product. And as you were saying, we have bigger size coming up. That means they're able to really implement big acquisitions. So I think it's here to stay.
Simona, what's the benefit, though, of these unicorns turning to the SPACs when they can just go to the market themselves, though? I understand the money's been raised and sitting there, but unless you get more market events like we had yesterday and there's more uncertainty, why would the technology companies take the easy option of going to these SPACs?
I think because you would benefit usually from a very good sponsor that is either an individual which provides or a group of individuals which provide a lot of industry expertise. And in a lot of cases now you have also institutional investors like the TPG, the Trio Carlyle, but also if you are in a company, you effectively can keep control of your business versus going public where you lose it a bit in the hand of the public shareholders. So the economics and the math continue to be very profitable for the target companies who might pursue this route.
Simona, can I ask you about just how private equity changes structurally going forward from here? I mean, I like many people, have been astonished that private equity companies or businesses run by private equity here in the UK have had their hand out for government funds like other businesses, and yet many of these companies have been leveraged as the private equity businesses have taken their return from their acquisitions. Are we going to see that model change here? Not least because it's quite distasteful to see the flow directly through from public taxpayer money to private equity owners because they've been able to get access to government support.
When you look at the take-up of private equity support by the government support by private equity, it's actually not been meaningful, and the reason being that it comes with a lot of strings attached. So the private equity community realized that if they want to benefit from this, they will need to change their behaviors, i.e., they can't distribute a dividend, they will have some control on the type of deals they can do, on the leverage, etc. So I actually think that we are going back to the old model where PE, if they are in trouble, they will need to go back to their LPs and ask for money. Otherwise, the old model, I think, will be challenged because of the constraint in behaviors and in economics, which is very different from what they sold to the investors.
Simona, it's been a pleasure. Thanks so much for joining us this morning. Simona Meyer, Global Co-Head of the Alternative Capital Group at UBS. Steve's next guest from the Ambrosetti Forum believes stakeholder capitalism requires a broad rethink of how commerce operates and how value is created. Let's take you back to Mr. Sedgwick at Lake Como.
Thank you very much indeed for that, Jeff. Well, look, let's get straight to Peter Brabeck-Le Mathé, who is, of course, the chairman emeritus of Nestlé and one of the most well-known businessmen in Europe, I would say, as well. Peter, there are so many things to discuss, and we covered a lot of interesting issues last night in our panel, and I think there was some very interesting comments from our colleague joining us from MIT yesterday. We might come to that in a few moments' time, but just a very basic question to start off with. What has COVID changed about your world, about the world of business? Good morning to you.
Good morning. Well, I think COVID has changed a lot of things, not only in my life or in the life of corporations. As a matter of fact, I think it has started a fundamental change that will unfold over the years to come. We are just at the beginning of the COVID crisis. We are not at the end of the COVID crisis, without any doubt. And I think what COVID did, it acted like as an accelerator for tectonic changes that had already happened before. Take the political side. On the political side, very clearly before, we already had the move from a monopower world to a multi-power world. We had the retrenching of globalization and multilateralism. COVID just accelerated this even more. If you think about nationalism, the way how we are handling today the question of vaccines, it's a great example of everybody's first, nobody is together. Okay, so this was a theme already there. If you look at the economical side, I think we had before the impact of what we call now the fourth industrial revolution, based on the technological breakthroughs which were mentioned yesterday also. COVID, what did it do? It accelerated this. And you can see that very clearly if you look at the stock market. There were some sectors which were exploding and other sectors which were going backwards. So another accelerator, socially, for example. I think the social fracture has become bigger than smaller. So all of those things have changed. Now, in the business environment, there are also several things that have changed. The first one is that the role of the CEO, who is normally the visionary, the leader of an organization, had to change rapidly to become an operational manager. The most important thing was take care of the safety of all your stakeholders, of course employees first, but all other stakeholders. Keep on that the operation is running, okay? This is operational management. And then afterwards, start to think about how has consumer changed and how do I adapt to this. So there's a big change in the way how you're running a company during a crisis.
Let's unpack a few of those things, because, again, there were a lot of issues raised there, a lot of issues raised last night about the role of the CEO and actually how good CEOs are. You were indirectly called one of a class of, well, as an acronym, of HIPPOs, which is the highest paid person's opinion, i.e. the CEO is the highest paid person in the room. He gets to make the final decision. And actually, compared with an algorithm, apparently, we heard that the CEOs and the HIPPOs perform very badly as well. So do we need a look at CEOs and their extraordinary remuneration and the extraordinary way they've run companies over the years and say that just cannot be anymore?
Well, like always in those things, there's a little bit of exaggeration. First of all, I don't think that the opinion of the leadership of a CEO is necessarily reflected by its salary. Frankly speaking, there are wonderful CEOs who have a very small salary, and then there are some CEOs who have an exaggeration of salaries.
The average numbers have gone up from about 20 times an average worker's salary in 1960 to about 300 times in 2018. They are, by and large, remunerated at an extraordinary level.
I fully agree, and I think this is not necessarily good so, because it's part of the social fracture that we have. So there has to be limits to this. But to say that because he has a high salary, therefore he is not necessary anymore, I think is a wrong conclusion. Let me put it this way. I am absolutely convinced of one thing in life. I prefer to have teams which have a leader instead of having teams as a leader. And as long as you believe in this, now you can say that's not the case. Perhaps with the new technologies, that what yesterday our colleague was saying, we will not need leaders anymore. We just let the algorithm make the judgment. I don't believe in this. I believe as long as we are human beings, and we might discuss how long are we going to be human beings, that's a different story. But as long as we are human beings, I think we will need good leaders.
And the leadership is changing, and what the rationale of a company is, according to people like yourself, you're saying that companies need a purpose now. It cannot just be about shareholders. It has to be about broader stakeholders as well. Well, I would suggest come back at you and say there are large parts of the investment community, whether it's the venture capitalists, whether it's private equity, whether it's the activists who have assaulted your very specific sector aggressively, and companies such as Unilever, such as Nestle as well. They have no time for such sentimental views as well. All they care about is raw profit and raw return.
Which I think is basically wrong. You cannot have a successful company in the long term if you are only maximizing shareholder profit. And I would say also there's another thing. Look, one of the parts of the world that is suffering the most is nature. I just cannot understand where the logic is to exploit nature, to make the maximum of cash, and then afterwards to use part of this cash in order to heal nature. This is not a very intelligent proposition, is it? Okay? That was the same story with corporate social responsibility. So there we were, I remember in Davos, saying we have to give back to society. And I was the only one standing up and saying, I have nothing to give back to society because I have not been stealing from society. I have created value for society by the things I'm doing. I have built the corporate social responsibility inside of this company strategy. And the same thing we have to do with nature.
But Peter, your industry, the food industry, the food processing industry, the consumer industry, will take, or has to take, a lot of the blame for where the planet is, doesn't it? Of how we have extracted resource from the planet without giving back, how we focus on certain types of farming, for instance, as well. Can your industry give back on that front now and say, actually, enough is enough, we need to change how we're taking resource from the planet?
I fully agree with that. We have to rethink this from completely. Take agriculture. Agriculture is using most of the water that we have in the world. Okay, it withdraws about 70%, it uses up to 90%. Now, agriculture uses 2.5 times more water than what it physiologically really would need. Why we are doing it? Because it has no value. So this is a typical example where we are taking advantage of nature, overexploit it, because we don't give any value to it. It's very clearly. We have to change. We have to change our agricultural system. We have to change the way we are producing. We have to think, when we are talking about climate change, we have to think much more holistically. You know, it's very easy to say, okay, CO2 and that's all of the world. It's not true. If we are using synthetic biofuel and we are needing 9,100 liters of water to produce 1 liter of fuel, well, is this a good holistic approach to the problem? No, it is not, okay? And this is one of the biggest problems we have today. We are talking about electric cars, and this is the best thing, and that's why Tesla has a market value of I don't know what, okay? Well, the reality is, if you look behind, you have in every Tesla car 74 kilos of lithium. Where did you get the lithium from? You go up to the Atacama Desert and you see, and you look where before we had the Rosa Flamingos, now we have lithium plants. Is this the right way to do? And have you thought about it, what we are doing with the battery 5 years afterwards, how much energy we need in order to scrap it? No holistic looking. It is just politically, we are going to diminish CO2 and with this we have saved the world. That's not the right approach.
Peter, plenty more things to discuss, and we'll do that hopefully on another occasion. Perhaps not in Davos, but maybe in Davos later next year. Who knows what the timing is going to be as well. But Peter, very nice to see you, and thank you very much indeed for your time today. Peter Brabeck-Le Mathé, of course, who is the Chairman Emeritus of Nestlé. Huge number of issues coming up last night and indeed just there of our conversation. But we've got many more conversations to come, not least what policymakers are doing in Europe, what happens with Brexit, what happens with social media and regulation next. Well, someone who can talk about all of that is the former Prime Minister of Denmark, Helle Thorning-Schmidt, who will join us on Squawk Box a little bit later on.
All right, terrific, Steve. Thanks very much indeed for that. And of course, we also must remain anchored in where the markets are likely to go through the trading session today. The early look at the futures here in Europe on the back of the latest German manufacturing output numbers for July. They were a little disappointing, but still positive. Maybe that explains why the losses implied for the DAX don't look as big as for the other European markets on these boards. And we've slipped back into negative territory on the implied open for the Dow. We'll be back in just a moment. 28 minutes and change until we start the trading session.
Established in Hong Kong in 1985 and currently based in Guangdong, China, Yuexiu Group has undergone over 30 years of reform and development. Its asset portfolio ranks amongst the top state-owned enterprise groups in Guangzhou. Yuexiu Group established a 3+X modern system incorporating major industries, including finance, real estate, and transportation, infrastructure, traditional industries like papermaking, as well as strategic emerging industries. In 2014, the group acquired Chongqing Bank as part of its effort to build itself into an international financial holding group. In 2018, Yuexiu Group's total assets reached RMB 600 billion. With an annual revenue of RMB 48.3 billion, Yuexiu Group will create greater value for the world. Beyond excellence, Yuexiu Group.
How we see the economies functioning is actually slightly better than the assumptions we've put into our models. So we think that we've been very conservative in the first and second quarter.
Retail activities, they kept up well despite the major impact of the lockdown on clients, on point of sales.
We assume that there will be a U-shaped scenario. We will see a recovery now also coming already in the third quarter.
Should expect lower credit provisions going forward, unless, of course, the macroeconomic assumptions change to the worse.
I do expect the second half of the year maybe not to be as benign as the first half, but still quite robust.
The economies will not go in the same lockdowns that we saw in the second quarter. We see an improvement, whether it's retail or CIB.
There are a lot of uncertainties in the marketplace, so we don't want to get too far ahead of ourselves. But I think it's gratifying to see, the momentum continue into the third quarter.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Weekdays, Kelly Evans connects investors to newsmakers, stirs up high-stakes debates, and digs behind the numbers. Strengthen your investing strategy on The Exchange. Weekdays on CNBC.
With over 1.3 billion people affected by disability, what can be done to improve inclusion?
This problem is too big for governments and charities alone to resolve.
A missed opportunity for business.
We're losing about 7% of the GDP because of this exclusion. Even if you put the bottom line first, it actually leads you to inclusion.
Finding solutions for disability inclusion with me, Tanya Breyer, only on CNBC.
As we cover COVID-19, our business is business. Stocks are telling us that the economy is going to come back and resurrect itself relatively more quickly than some of the economic numbers say. Making sense of the disconnect is what we're trying to do every day for our viewers. The way we socialize, the way we travel, it's all going to be changed for many, many years. This is seismic, it is historic, it is the story of our lifetime.
Everybody, we are live this morning from London and the shores of Lake Como, Italy. In their headlines, selling strikes Wall Street. The Dow sinks over 800 points in its worst day since June as investors flee tech stocks in an abrupt end to the winning streak. Apple shares plunge 8% in the stock's worst day since March. The tech giant losing $150 billion in market value during the session.
Asian equities see red following US majors lower as big technology firms across the region lead declines.
And as you'd expect with these markets, volatility is resurgent, with the VIX marking its largest one-day rise since June. Here on the Lake Como shores at Ambrosetti, the mood, though, is much more cautious about what 2020 still has to offer.
Italy has never seen in its history such a rebound, such a growth rate, and has never seen such a collapse.
So let's just remind you, this is where we are trading in the Asian session, with a lot of these markets beginning to ease gently into their afternoon and to their close. And just a couple of things that I think it's worth pointing out to you. One is, even as we've focused very much on the technology sell-off, some of those tech-heavy Asian indices are only down around 1% or so, largely mirroring what we're seeing across the rest of the Asian session. So I would say that Asia is not seeing the same degree of selling pressure as we saw in the United States around the Nasdaq. It's more reflective, perhaps, of what we saw with the Dow, and maybe it's a little bit tempered here as we reflect on the economic data that we're going to see from the United States later. This is the non-farm payrolls number, which will give us a better sense of just how robust labor market trends are in the United States at this point, or otherwise. What about the European Open at this stage? The indication is that we will have a negative start to trade for the European markets. We did have a little bit of data in the last hour from Germany on the manufacturing side. The number came in at 2.8% month on month. The expectation was for 5%, so a little bit of momentum coming out of the German data, as we've seen with some of the other Eurozone PMI numbers, but it was still a positive, and I think that's something that some in the market will take comfort from as they continue to look to the German economy as one of the stronger areas of the Eurozone. The US futures, we should take another look at the US futures board here, because we've seen a lot of choppiness already this morning, a lot of volatility around the futures calls, and we are just in negative territory on the implied open for the Dow. But it continues to be the Nasdaq that I think most will focus on, and we've gone back to an implied open that is more than 100 points weaker at this stage. So we are all grappling, really, to figure out what the significance is of yesterday's price action. Is it worth continuing to look at your opportunity in these technology stocks? Is September just doing its classic job of embarrassing those bulls in the market? Well, speaking to CNBC, Allianz Chief Global Advisor Mohamed El-Erian warned that US stocks could see further declines.
We could have another 10% fall easily if, I want to stress, if people start thinking fundamentals. Ultimately, Wilfred, it's, do you look at absolute valuation or do you look at relative valuation? In relative terms, stocks seem cheap to everything else. In absolute terms, stocks are expensive. If you're in a liquidity-based paradigm, you will be dominated by relative thinking, and that's where we've been. If you're in a fundamentally based paradigm, you ask the question, am I being paid enough? Am I being paid enough yield on high-yield bonds? And the answer is no, you're not paying it for an economy that faces not just moderation in the rate of improvement, but a rising level of bankruptcies.
To the latest on the jobs picture, and new US weekly jobless claims came in at 881,000, was well below Dow Jones' estimate for the first-time unemployment applications of 950,000. Due to a seasonal adjustment, this week's reading is not comparable to last week's 1.01 million figure. Continuing claims fell by over 1.2 million. Meanwhile, benefit claims under the Pandemic Unemployment Assistance Program rose by about 25% to nearly 760,000. On the ticket today, though, the big non-farm payrolls report, the US economy is expected to have added 1.4 million jobs in the month of August, the smallest uptick since the recovery began earlier in May. The unemployment rate is predicted to fall to 9.8%. That is the lowest level since the peak of lockdown in April, and it would be the first time we're back below that 10% level since March. Steve, let me toss it back out to you.
Karen, excellent. Thank you very much indeed. Well, look, there are a lot of guests who are physically here on the shores of Lake Como. There are a lot of ones who are coming through a video conference, and we're going to speak in a few moments' time to Helle Thorning-Schmidt, who'll join us by video link on the shores of Lake Como here to talk about a whole host of issues, not only issues surrounding Europe and the EU and what happens next, but also about Facebook and regulation of the internet. We'll discuss this.
COVID-19 has launched the greatest behavioural change in our lifetime. We vaulted 5 years in the adoption of digital in just 8 weeks. Now we're speaking to leaders who are asking, how do we bottle the stuff that worked? Even before the crisis, 92% of business leaders felt that their business model would not remain viable through the current rate of digitisation.
For Marcus, the pandemic has strongly reaffirmed our unique business model of digital combined with a strong balance sheet. We can innovate the distribution and consumption experience of financial services.
We've created a brand new processing plant by just making incremental improvements. Our people did it with AI, will, and enthusiasm.
The road to recovery is paved with data. Those companies that can harness it best will set the pace.
Breaking the cycle. What companies are doing now to diversify and bridge the divide.
Then is anything going to change?
Corporate Insight, Smart Solutions, Squawk Alley.
Welcome back, everybody. It was the great Matt Monro who sang about days like these. And people who look at the VIX, the volatility indices, have been asking the question, why have we been seeing the volatility indices continue to rise as we've also seen gains on equity indices? An indication perhaps of risk aversion and complacency at the same time, some have suggested. Well, we got a little bit of a lesson yesterday, didn't we, on what perhaps some of these indices actually are telling us about the way investors are feeling. Let's just focus on the US technology segment as a whole, and here you can see writ large, I think, where most of the pain through the trading session was seen yesterday. And obviously the big number that we want to focus on here is that 8% decline for Apple and the fact that Tesla was off 9%. Tesla now, I think, over the last 3 days down more than 18%, Karen.
Jeff, let's take you to some news around Facebook, as it has banned any new political ads in the week leading up to the US presidential election. CEO Mark Zuckerberg had posted concerns on the platform that challenges due to the pandemic may make it impossible to confirm the result in a single night, and that the country may be at an increased risk of civil unrest. This after the company determined that Russia-backed accounts had been engaged in misinformation campaigns to undermine the election. Speaking to CNBC, Nick Clegg, Facebook's Vice President of Global Affairs and Communication, rejected suggestions that the action was unambitious.
Almost no one, I don't think any major Silicon Valley company fact checks what politicians say about each other, because what politicians say about themselves about each other is always full of exaggeration, caricature, hand-picked selective facts and so on. And the idea that a private company sitting in Silicon Valley should be the sort of sole arbiter of when caricature and exaggeration becomes something which is simply not true is something that no one has tried, because it's almost impossible, I suspect, to do it. What we are, however, ensuring is a huge level of transparency.
Well, let's get another view on this, and a very educated view, and someone who's working with Sir Nick Clegg on this as well. It's Helle Thorning-Schmidt, who is the, of course, former Prime Minister of Denmark, and we'll tap her brains on EU affairs in a few moments' time. But she's also the co-chair of the Oversight Board over at Facebook as well, and hence has a degree of a role in scrutinising what's going on the platform now. Helle, very good to speak to you today. Thank you very much indeed for joining us. Look, how far is Facebook, how far is the social media community away from where it needs to be in terms of regulation? One can't help thinking that things like the Oversight Board are very good ideas, but the sheer scale of the challenge means that your task is going to be pretty thankless.
I am worried that if we don't do anything in the coming years, this will go completely out of control. And what we are trying to do in the Oversight Board, which is completely independent from Facebook, is very important for me to say that, because none of us would have joined the Oversight Board had it not been independent. What we're trying to do is basically socialize the decisions on what content stays up on the platform and what content comes down. Until now, this has been solely up to the social media companies such as Facebook to decide to take these decisions based on a balance between freedom of speech and other human rights. Now they've decided they want an oversight board to do this, and they have also promised not only independence, but also that they will listen and abide by the rulings that we have and the decisions we have in the oversight board. So I think this is a very positive step in the right direction. Obviously, we're not up and running yet. We will be over the autumn, but when we are here, that will be a very solid step in terms of trying to socialize these decisions, make them transparent, and also for the first time, make it possible for users of Facebook and Instagram to complain if they're not happy with Facebook's decisions on content.
Helle, this seems to be an admission that the science, the algorithms are failing. I spoke to an MIT professor here at Como yesterday who was telling us that actually now that the algorithms can beat the Chinese at the 3,000-year-old game of Go, which just shows how far we've come in terms of AI as well. Why do we need you? Why do we need human beings to give oversight if the algorithms are so technologically advanced?
I think it's two different things. I mean, algorithms can do one thing. They can actually take, obviously every day there are millions and millions of pieces of content, and you can't have human eyes looking at all that content, deciding what stays up and what gets removed. So that is where you use the algorithm to do that. But in the ideal world, and I do admit we're not in the ideal world, the algorithm will reflect the decisions that we take, the community standards and decisions we take on what is actually appropriate to stay up and what should be removed. So this is the idea of the algorithm, that they don't go beyond what we have decided as human beings should stay up or should get removed. But when all that is said, I do think it's obvious to most people that we can't carry on in a world where it's basically Facebook and ultimately Mark Zuckerberg who takes the decisions on what content gets removed or stays up. So that's why it might not be ideal, and it might be a small step, but it is a step in the right direction to finally have an independent board, an oversight board that can take these decisions. This wouldn't have been good if we weren't independent economically, and also if Facebook has not been very clear that they want to follow our decisions. In that way, we are above Facebook, and that is how it should be. So this is the first step of regulating this. And obviously, it would be better if the UN or a multinational body like that could do this regulation because it is global and it needs some kind of regulation. But this is the first step in the right direction.
Hella, I do totally appreciate the independence of the advisory board as well, but is it just a line in the sand that the social media companies and Facebook in particular are trying to create, but actually the heavy regulation, as you just referred to, it's coming anyway, and it's coming aggressively on both sides of the Atlantic, and it's coming on content, and it's coming on monopolies, and it's coming on paying fair shares of tax as well. Regulation is coming very heavily, isn't it?
I think regulation is coming, and I hope regulation is coming in many areas of regulating social media. But I also think we have to think a little bit harder and deeper about what regulation is. We are just having a big debate in Belarus, for example, about election results. And one of the first things that happened there was that they closed the internet, because they didn't want people to communicate about this. They didn't want people to form groups so they could demonstrate. So I also think we have to appreciate that if regulation gets too heavy, it actually will impact freedom of speech very heavily. It'll be the same in Hong Kong and other places. So even though I believe in regulation, I believe that politics has to play a role, I also think we have to be a little bit careful in just demanding regulation, because at some point it will tip over and be a regulation on our freedom of speech, and I don't think any of us want that. The thing with social media is that it's been so great in giving so many people a voice, also people who are outside the political system, giving them a voice. But at the same time, we also have to make sure that social media don't push lies, that we don't have an attack on human rights, that we don't have hate speech on social media. So it's that line that we have to find. And I'm not sure that individual lawmakers in a government can make this line. That is why by nature this is global, and that is why I've decided to join the Oversight Board, as has my colleagues on the Oversight Board, because we can't see an alternative. It is no good to have more than 100 different regulations for Facebook, because that will actually go against this idea that we have one global media that can connect us all and create great movements like Black Lives Matter, Me Too movement, and other movements that are by nature global and where we have to connect with each other in a global way.
I've got time to sneak in one or two more questions about broader Europe as well. Did the Frugal Four get a bruising on this €750 billion recovery plan? And do you have grave concerns, of course, from your Danish perspective, that actually more money is going to be transferred to the south, and that's going to come at the detriment of the north, and actually that's going to create ramifications in countries such as Denmark?
Well, let me start somewhere else. I mean, I am so proud and so happy of the leadership in the European Union in this during this pandemic. I was so worried that we would return to the former days where no one wanted to discuss economic policies and big packages. But luckily, France and Germany joined hands, which is where stuff started moving in the European Union, and made sure that we had a real helpful package to help push the European economy. And I can't tell you how relieved I am, and how relieved people should be, just people caring about their jobs, their livelihoods, because this package will actually be able to solve some of the big issues coming from this pandemic. So I think the Frugal Four, they came into to this, and they had to give they had to change their tune a little bit in the negotiations. And to be honest with you, I'd actually think that was a very good thing that happened there.
Hella, I've got 20 seconds left. You have a unique position, you know, via your family and otherwise, both sides of what's going on the channel. Are we going to get a Brexit deal? I've got 10 seconds.
I'm so worried about the Brexit deal right now. It's coming up on the agenda and it's not getting better. We see negotiators basically walking away from the table saying that things have gone backwards. So even though I'm such an optimistic person and think that things can always be solved, I am worried about the Brexit negotiations now, and that will have a big breakdown.
Hella Thorning-Schmidt, I've got to leave it there. Thank you very much indeed for all your insight. We'll take a short break right here on Squawk.
Next Managing Asia, Sunny Verghese of agri-food giant Olam International.
Africa alone, 150 million people have lost jobs during this crisis. The health pandemic is now become a hunger pandemic. Our first focus is to help the most vulnerable parts of the population to get them food.
The group CEO of Olam International on the Next Managing Asia.
As the pandemic has unfolded, we've just seen this extra rapid pace of adoption of certain technology. Everybody had to think about grocery delivery, video conferencing, and telemedicine. E-commerce and video meetings are now part of the fabric of culture around the world. That's not going to change. At CNBC, we really remain committed to watching the data and bringing our readers and viewers the information that's most essential.
Good morning, everybody, and welcome back to Squawk Box. I'm joining the team to run you through the market open. We are just opening up here in Europe after U.S. markets took a nosedive yesterday, led by a steep sell-off in those tech stocks. NASDAQ dropping 5% yesterday. The Dow Jones falling more than 800 points, and the S&P 500 dropping 3.5%. Its worst daily performance since June 11th. Every single sector did sell off in the S&P, but the core of the selling did take place in the tech sector. So now investors across the globe asking the question, is this going to prove a blip, or is this the beginning of a bigger rotation out of those growth tech stocks that have driven the rally thus far into some of the more cyclical parts of the market, some of those laggards? We've been asking this question for a while. Now we are seeing the sell-off begin. Let's see if it is going to filter through into Europe, what it means for Europe that doesn't have those tech giants and actually offers a lot of cyclical opportunity. So the Stoxx 600 opening on the back foot this morning, down about 0.7%. Yesterday, the Stoxx 600 dropped 1.4%. Technology underperforming yesterday. And here's a look at the breakdown. Technology, the worst performing sector in the market in the first moment of trade, down 1.1%. Household goods, healthcare, and travel and leisure round out the bottom part of the market. Now, moving along to the middle, we've got some utilities, media, construction stocks. But very interestingly, the banks, they are the only sector this morning trading higher. The banking sector up 0.3%. It's a mixed picture within that basket, but the banking sector, of course, has been one of the most unloved parts of the market in Europe, one of the most value-focused parts of the market. And if this rotation does become something bigger, perhaps the banks will stand out as one of the sectors that could be a beneficiary of this money that's coming out of those tech stocks. Let's take a look at the regions and what the split looks like across the bourses. So even picture at the moment. The FTSE 100 down about 0.8%. The Italian market just getting going, down about half a percentage point. Worth noting that yesterday we did see some divergence among the different regions. France's CAC 40 was the most resilient region yesterday, dropping just about 0.4%. And now we've got the CAC 40 trading about 1% lower, so leading the losses this morning. The SMI over in Switzerland down about 0.7%. The IBEX over in Spain down about 0.1%. And I believe we're waiting for that opening print on the DAX. But as you can see, the losses spread pretty evenly, but much more contained than the losses that we saw on Wall Street yesterday. Now, U.S. tech stocks led declines on Wall Street, with the Nasdaq falling almost 5%. So let's take a look now at the European tech sector. Yesterday, technology underperformed, dropping 3.8% in Europe. Now, we are seeing some underperformance in technology, as you saw, is the worst performing sector this morning, but the scale of the losses fairly contained. So Capgemini down about 1.1%, SAP down nearly 2%, ASML down 1.45%, but otherwise fairly muted losses. Apple shares fell 8%, its sharpest decline since March. The drop wiped out some $150 billion off its market cap, staggering in one day. Just speaks to the scale of Apple, how much it's grown. And here's a look for you. This is the Frankfurt listing of Apple. We're waiting for an opening print there. We'll hopefully get it in a moment. And here you've got some of the key Apple suppliers. We've got AMS down 1%, ST Micro down about 0.7%, ASML down 1.6%, as I pointed out just a moment ago. So we'll keep an eye on the Frankfurt listing, and we'll show you that when it comes through. Let's take a look at the miners. Yesterday, the basic resources names came under particular selling pressure alongside tech. That sector has dropped about 3.3% yesterday, and it's a little bit of a mixed picture this morning. Some stabilization coming through in the mining names, but again, this comes after a steep sell-off yesterday. So we got Anglo American, BHP essentially flat, just a little bit below the flat line, Antofagasta as well, and Fresnillo actually a touch above the flat line. Let's get a check on autos and see how the auto sector is performing. Interestingly, autos, travel and leisure, and food and beverage were the only three sectors to end in positive territory yesterday. Now, we are seeing a bit of selling in the auto space today, but again, fairly contained moves. And as we saw with the banks, the best performing sector at the open this morning, the autos, another one of the most unloved parts of the European market. And if we see appetite for cyclicals, some of the key laggards, autos could be one of those opportunities for investors. Now let's take a look at oil. The energy majors of Brent crude is set for its biggest weekly loss since June. And here's a look for you at the energy majors. Fairly mixed picture here. Again, fairly muted moves in the energy space. Karen.
You know what, I'll pick up there. We seem to have a problem with Karen's microphone. Let's bring in Gerald Moser, then Chief Market Strategist at Barclays Private Bank. Gerald, good morning to you. As we look at your notes, I think you obviously had a conversation with the team yesterday before we brought you in. You said you still like equities, or you prefer equities in terms of asset allocation. What difference has yesterday's price action in the markets made to how you're now viewing that opportunity in equity markets?
Yes, good morning. Well, I think the reason why we like equity is the relative valuation. I mean, if you look across the market, every single asset class is very expensive. You know, equities, bonds, it's difficult to make a choice. But I think the difference, for example, now, if you look at the absolute valuation, it's not far from the tech bubble valuation. But at the time, what you were getting for investing in equity was not very much. Your equity risk premium was negative. I mean, right now, because central banks have been so active in pushing down rates, the valuation of equities on a relative basis continue to be quite attractive. But I think the lessons from those valuation metrics is that we should also be aware that the return we should expect for the next few years have to be lower than what we experienced over the past few years. This is basically what the valuations are telling us. They are not very helpful in the short term. And I think what we saw yesterday is just like sentiment driven. We had a strong rally. August was one of the best months in decades. And I think it was just like a bit of a breather for the market, but nothing in particular otherwise for us in that correction.
Obviously, we look to other asset classes to give us some protection on days like these, but it's been increasingly difficult to find good diversifiers. Where would you suggest our audience go just to give their portfolios a little bit more resilience, a little bit more of a barbell?
Yeah, that's a very good question. And you're right, the typical 60-40 portfolio is not as efficient as it used to be. You used to have some income coming from your bond holdings and also some protection with rates falling when there was a sell-off in equities. But that correlation has now shifted. What we like as a diversification tool is gold. And it has worked quite well this year so far. We also think that despite gold being at all-time high, it's still very interesting. Again, gold doesn't yield anything, so the main threshold or hurdle for gold is the real rates. And our real rates are negative pretty much everywhere in the world. So we continue to see value in gold, especially as a diversification tool for a portfolio.
Gerald, can I ask you about some of the catalysts for the market now? Because some of the big investment houses have turned cautious around the S&P 500 for the rest of the year. What do you think the triggers are going to be? We've got some data coming out today, the jobs report. I know a lot of market participants are concerned about second wave fears impacting the economy from here. We've got a year of an election cycle in the United States with stretched valuations as the market looks for more stimulus. So what are the signals that you're looking for that the market might be able to reinforce some of the levels we've witnessed in recent weeks?
Yeah, I mean, you just named some of the most important catalysts to come. And I think especially going into the US election, it's going to create more volatility in the market, which is already dealing with a pretty uncertain environment with the COVID-19, as you said, the risk of a second wave. Now, most governments have ruled out a national lockdown, i.e. the impact on the economy of a second wave would probably be lower than it was in a first wave if we were to go into that direction. But with the US election, it's still a possibility that the market, get a bit of a shake-up, and especially depending on the outcome. The market doesn't like uncertainty. So if it is a very close election, that's something that would be probably an issue for the market, as it wouldn't really allow the market to discount a clear outcome there. We prefer to look at the market, over 6-12 months at least. This could create an entry point for people who are still in cash, I would say, because again, you're better off being in equities and trying to get some protection if you fear a precise catalyst, like, for example, the US election. And we see that the market already start to discount some protection there around there. You look at some of the VIX future, but nonetheless, I think those kind of volatile environments we should look through, because overall equities tend to recover pretty quickly. We saw it again. It took less than 6 months for the S&P to recover from the COVID-19 crisis. So even if you have some sell-off around some of the catalysts you mentioned, for us it's something that we recommend to look through it and focus more on the fundamental of companies with strong balance sheet and strong cash flow.
Gerald, it has been noted that the market looked a little bit unhealthy recently because of this one-way bet. A lot of shorts had effectively been closed out because there's been such a loss-making trade since March this year. So very little protection of these stocks are being chased higher, which means that we can see more violent selling when it happens. Do you think now we've had a bit of a market event, we start to see more shorts come into the mix?
Well, it could be the case, but at the same time, it's very difficult, as you say, and holding a short position is something that is very costly and very difficult. It's very much sentiment-driven, as we said, and if you go back to the tech bubble, for 2 years, people were saying that the market was overvalued, and truly it was at the time. So I think that those positions are very difficult to hold, and it's difficult to go against the market. I wouldn't expect them to come forcefully here. As I said, I think what we saw yesterday was more sentiment-driven. We have to remember that the sell-off that we saw in most equities, and even at the index level, only bring us back to where we were 2 weeks ago. It's not like we erased like 2 or 3 months of a rally. So I think it's going to be very difficult today to say that the shorts are coming back into the market.
Gerald, if I think about where the money could go if we do see a further sell-off in the U.S. tech stocks, investors have long been waiting for a catalyst to get into the value cyclical parts of the market, and Europe really stands out relative to the U.S. in this respect. I mean, doesn't this set up Europe to outperform the U.S. if we do see a rotation begin in a big way?
Yeah, I mean, if we see this rotation happening, I think it would be a good potential catalyst for Europe to outperform. I'm a bit less convinced about that. I think, again, the valuation is a very good indicator when you think about 3 to 5 years. But I think in the short term, it's not because something is cheap that it will start outperforming. You need something more than that. And I think that the momentum behind tech, the fact that those companies are actually some of the best money-making stocks in the market when you look at the revenues of the large tech companies, I think that kind of fundamental support will still mean that tech will do quite well in the short term. I also think that we have to be very careful when we think about a value rotation, because some of the value stocks are also a bit of a value trap, and it's very difficult to value them properly. So I would caution about now putting on the rotation trade out of growth quality into value.
All right, so we'll leave it there. Gerald, thank you so much for joining us this morning. Gerald Moser, Chief Market Strategist at Barclays Private Bank. Well, let's get right to the banking sector. We've got some huge moves coming through in European banks this morning. Shares in Bankia and CaixaBank are rallying on news that the two Spanish lenders are considering a merger that would create Spain's largest bank. The all-share deal would see the formation of a group with assets of over 650 billion euros. And that news not only driving Bankia shares up nearly 30% and CaixaBank shares up more than 10%, but also lifting the broader Spanish banking sector. We've got shares rallying more than 3% in all the stocks. Banco Sabadell up nearly 10% as well. So this long-awaited consolidation, perhaps we're getting closer to it, and the Spanish banking sector performing very well on the back of that news. Let's get into the healthcare space. Roche has received emergency approval from the U.S. government for a quick coronavirus test. The Swiss drug maker has said the new test could quickly detect whether a patient has the virus or a flu infection, which would be particularly important as flu season approaches. And Roche shares are down about 1% this morning. Let's push on. Pfizer's CEO Alberto Boria has said the coronavirus vaccine being developed with BioNTech could be ready for approval by late October. The U.S. government had announced in July it would pay the companies nearly $2 billion to deliver 100 million doses if the treatment proves to be safe and effective. This, as documents published by the American Center for Disease Control, revealed it has asked state health officials to prepare to distribute a potential vaccine as soon as November. And let's take a look at the broader pharma space. We can see that healthcare is under a little bit of selling pressure today. Of course, healthcare, one of the most defensive parts of the market. So if investors are asking the question now whether we are at the beginning stages of a rotation out of quality growth defensive names into more cyclical value stocks, and healthcare, of course, could be one of the victims of that rotation. So far, the move's fairly muted, but they are trading lower this morning. Let's push on. One other corporate in focus this morning, EssilorLuxottica, the eyeglass manufacturer, has announced it will appeal the Rotterdam court verdict that threatened its bid to take over rival Grand Vision. The Dutch court has said that Essilux has failed to prove its claim that Grand Vision had breached their takeover agreement. And we are seeing EssilorLuxottica shares trade a little bit below the flat line this morning, but investors taking that news in stride. Just Eat has gained all regulatory approvals required for its proposed acquisition of Grubhub. This after the U.S. Committee on Foreign Investment decided the Dutch company's deal with the American takeaway platform poses no national security concerns. The transaction must now be approved by both companies' shareholders.
Coming up on the show, reversing the ECB's quantitative easing is far from obvious, according to the former IMF director, Carlo Cottarelli. Steve will be speaking to him in a first on CNBC interview from Amber Sethi. Stay tuned, we'll be right back.
We expect the second half of the year to remain very volatile. We expect the on-trade not to come back to pre-COVID level until there's kind of a more structural solution. Until that moment, it will be really 2 steps forward, 1 step backward.
The consumer demand will come back. We're confident about that. The pace of recovery, as you point out, is uncertain, and it's very local.
Countries got the crisis under control as much as you can control it. So we'll see how it goes. But obviously, going forward, there's some volatility associated with the probability that we will see a second wave.
Particularly in the Americas, you know, yes, there's a second wave, but there's still the first wave, which is ongoing. So lack of visibility, difficult to give guidance.
Within automotive, we have seen a certain recovery coming. China getting back, so is also Korea. So we expect that the worst is behind us.
Welcome back to Squawk Box live from the Ambrosetti Forum here on the shores of Lake Como. And if you've been watching the press regarding Italy over the last few months, you would have seen something quite extraordinary. If you'd have read that press in April, possibly into May, you would have seen Italy is pulling away from the EU. Italy is discontented with the EU, possibly to the tunes of some of the populist politicians, especially on the right as well. But now you read the press and it seems Italy is right back at the centre of Europe. Is it all about the Corona bonds? Is it all about the 209 billion euros? Well, let's ask Carlo Cottarelli, who is not only a former director of the IMF, but also the director of the Italian Public Finance Monitor, Università Cattolica del Sacro Cuore. Carlo, really lovely to see you yet again, and thank you very much indeed for joining us. What has happened in Italy over the last few months? We know that it went first into COVID very hard, a devastating loss of over 35,000 people, but now Italy seems to have basically refound itself in Europe.
Yes, certainly this is true. First of all, it helped a lot the money that is coming from the European institutions. First and foremost, this year, the money from the European Central Bank. And also the prospect that next year there will be the money from the Next Generation EU, the Recovery Fund. But also after the very severe lockdown in March and April, Italy was reopened. So the lockdown was severe, but it did not last as much as in other countries. And this explains, in my view, why already in May and June you see some rebound. The summer is not going very well in terms of tourism, in terms of foreign tourism. But domestic Italians usually go abroad. This year they remain in Italy, so it helped.
I did something for that. I have been to Italy on my holidays with my family this year, so this foreign tourist did make it down to the south, I can assure you. And it was, no, thank you, it was fantastic. But there is a problem. Tourism's down enormously as well. Unemployment is steady around 10%, but it's still much worse than many people want it to be. There are problems with the deficit as well, again, around circa 10% as well. And the debts have picked up naturally from the very high 135 to an even higher 155, maybe 160% of GDP as well. The fundamentals look bad for the Italian economy still.
Yeah, indeed. I am worried about the medium term. So far, so good. So far, so good. I mean, so far is better than expected. We have to see in the medium term. What is going to be critical is whether Italy now takes this as an opportunity to introduce the reforms that are long overdue. Infrastructure is one, digital infrastructure, more investment in human capital, research, schools, something that has been missing. The reform of the bureaucracy, which is red tape, is terrible in Italy. The reform of the justice system, all these things are needed to make sure that Italy restarts. It's not just a rebound from the bottom, but we start growing much faster than in the last 10 years.
That sounds great. But you and I probably had this same conversation pre-COVID. I certainly had this conversation with many of the other guests here for 10 years, Carlo. Yeah. Ever since the great financial crisis, you could have turned around and said, reform the justice system, reform the bureaucracy. Yeah. Why is it going to happen now? There
is one difference, and now we can rely on the money coming from Europe. And that money, however, is going to come only if reforms are implemented. There's a sort of conditionality. People don't call it conditionality. They call it, let's put priorities. But in substantive terms, the money is coming only if we do something. That may help.
But the populists aren't stupid. The populists are very smart. They will seize upon that. And you say we can't call it conditionality because that has ramifications for what happened to Greece in the great financial crisis as well, and for other nations who felt their sovereignty was challenged. Fratelli d'Italia, La Lega, they will seize upon that, and they will seize upon it in the regional elections coming soon.
Yeah, the regional elections, I don't know to what extent they will change things or not. In the past, some regional elections did change something. At the moment, I don't think. I think that the moment that the government will go ahead. The government has a chance. They may waste it. They have time until 2023 before general elections are due. So there is some time. If they don't do anything, then there will be consequences.
Yeah, and why this government? This is a very interesting government. Of course, Mr. Salvini, he made his play last year. He's in the wilderness for now as well. But you've got 5-star plus PD as well. It's a strange set of bedfellows when people first looked at it as well. Yeah. Is it working?
I don't know. I don't know whether they will be able to do something. So far, they've been able to manage the emergency in a way better than other countries did, in terms of the way the number of new contagions every day is much smaller than in most other countries. So far, they've been able to do it. I'm worried about something that is very important. Schools have to start very soon. The preparations are going slowly. We have to see. We have to see.
But you've referred there, of course, to the infections, and we've already referenced the devastating death toll that Italy has experienced as well. But it seems, in talking to people like Peter Brabeck yesterday, when you look at the numbers, this is a stunningly infectious disease, but it is not having the same kind of mortality rate that many feared at the start as well, because we're getting better at coping with it as well. But can there be any meaningful recovery for Italy, for the world, without a vaccine?
I think so. I think that we have to learn how to live together with the virus. As you said, it doesn't seem to be as bad as at the beginning. This said, everybody is uncertain, is worried about the second wave and the fall. When people will start sneezing just because they have a cold, and they will be sent home as if they had COVID. It's an unprecedented situation. I think there is a possibility of a recovery of the world economy and the Italian economy, even without a vaccine. But, you know, things will be much, much easier, obviously, with the vaccine.
But in terms of the ability to cope with a second wave as well, we've seen concerns, grave concerns in Spain especially. Thankfully, as of yet, the numbers have stabilised off their highs in Italy as well. But if we get the kind of numbers in the autumn that people are very concerned about, will Italy be able to cope?
The worst will be a return to the lockdown. From a psychological point of view, that will be terrible. Also because the government has said repeatedly that there is not going to be a new lockdown, complete lockdown. There may be measures, partial measures. If there are partial measures, I think the Italian economy will continue recovering. If there is a lockdown and a big second wave, then it's a disaster.
Carlo, I've always looked at these big numbers on debt to GDPs, and I guess I've been wrong, because I've been worried about the Greek debt to GDP for a decade. I have concerns about the Italian level over 130% for a very, very long time as well. I've been wrong to worry about it because the ECB has had Italy's back as well. You've been writing about these kind of levels of debt quite a bit and saying that actually actions on the ground and from the ECB are keeping inflation at bay. But for how much longer?
The Secret Formula, Sundays at 9 p.m. Central African Time, only on CNBC Africa. On the next episode of The Secret Formula, we delve deeper into Coca-Cola's World Without Waste project and visit Extropet, the largest and most advanced recycler of PET bottle materials on the African continent.
If we are going to use the package, and this is across all our, beverage packaging, let's think about where will it end. It's not just about buying it today. After the consumer has used the packaging, what happens to it?
We also see how the company is rebranding their Sprite bottles from green to clear plastic and launching a new returnable bottle range, all in the name of minimizing the impact of plastic on the environment. The Secret Formula, Sundays at 9 p.m. Central African Time, only on CNBC Africa.
A flamboyance of flamingos forages in the waters of Kenya's Lake Nakuru. In an area that's heavily reliant on tourism, it's a welcome sight, and it hasn't always been this way. Rewind 5 years, and Deputy Park Warden Maureen Musimbi was worried.
Right now, because of the level of water and more fresh water coming in, the number of flamingos has gone down.
High water levels shrink the flamingos' ideal breeding and feeding grounds. When Nakuru first started rising in 2012, rangers say the birds left for nearby Rift Valley lakes, such as Bogoria and Baringo, whose waters were shallower. But fast forward, and today, heavy rains have flooded those lakes, prompting the return of the flamingos and visitors, according to the tourism warden, Caroline Webia.
With the increase now of the number of flamingos, we have started seeing visitors also increasing. Most of the visitors are now coming back.
Mwebia declined to give visitor numbers, and the Kenya Wildlife Service did not return calls. But lockdown restrictions have hammered the tourism sector in recent months. But with the return of the flamingos, the future for Lake Nakuru looks a little more rosy.
Hello there. It is exactly 11:30 a.m. here in Kigali. If you have just joined us, you are right on time for Power Lunch East Africa with me, Naringwa Fiona Muthoni. We have a full show lined up. Coming up in the next 30 minutes, we will bring you a conversation with economic analyst Reginald Kazutu on strategies that the government of Kenya have put in place to boost revenue collection from the blue economy. Also, economic analyst Charles Bogi will bring us up to speed on news making headlines in Uganda. Finally, Alex Owiti, communication consultant, on Kenya's unemployment prospects for Q2. Stay tuned on the channel for these conversations and more, and also do share your questions, thoughts and suggestions by tagging us on Twitter at CNBC Africa. Use the hashtag PLEA410, or you can tag me directly at Fimuthoni. Let's kick off the show with regional headlines from the East. In Kenya, the central bank has frozen a bid by banks to raise the cost of loans following the removal of lending rate controls from on the 7th of November 2019, drawing protests from the lenders that are suffering reduced profitability. The regulator had asked banks to submit new loan pricing formulas that will be the basis of setting interest rates on new credit in an environment where the government was not controlling loan costs. Multiple bank executives told local newspapers that CBK has now approved their submissions, forcing them to operate as if they are still under lending rate controls to avoid falling in trouble with the regulator. Moving on in Tanzania, on the 31st of August, the Court of Appeal dismissed the appeal case lifted by African Barrick Gold PLC against Tanzania Revenue Authority over a tax demand of about $41 million US, which the company owed the taxman. It is the third appeal against the tax bill the gold mining company has lost. Finally, officials have said that the World Health Organization wants to secure an initial 230 million doses of any COVID vaccine for Africa, while emphasizing that any vaccine in development should also be tested here on the continent. The Global Vaccine Allocation Plan, dubbed COVAX, aims to help buy and fairly distribute 2 billion doses of approved vaccine by the end of 2021. Richard Mihigo, the Program Area Manager for World Health Organization, said that this will cover 20% of the African population, initially prioritizing those who are on the front line, health workers, then expanding to covering the vulnerable groups. That's all for today's regional top stories. Let's take a moment to look at how the market is performing. The government of Kenya has set aside $110.7 million US to boost the blue economy industry in the country. The funds will be used to upgrade fisheries facilities and reclaim landing sites. Economic analyst Reginald Kazutu joined us earlier on the country's plan to unlock the sector's potential.
COVID has kind of shown quite a lot in terms of the vulnerability and the how fragile the African economy is in terms of its ability to sustain external shocks that come, especially when it comes to supply chain stocks and income crisis that most countries are facing through. The blue economy definitely will be able to play a role to be able to diversify further the African economies. And why do I say that? 70% of the 55 African countries are all coastal or islands. We have a coastal line of close to 31,000 kilometers as Africa. Inland waterways around 300,000 square kilometers of that. But then if you look at the amount that the blue economy contributes to the African GDP, it is actually very, very, very low. So Africa has the ability to generate quite a bit more from the blue economy and diversify themselves away from the traditional economy in terms of where you are trying to find resources internally, you are trying to mine resources internally, which are affected by global demand. So Africa does have a foundation to actually grow the blue economy in diversifying its GDP and also increasing its GDP going forward.
Now, with focus on Kenya, we've seen the government has in the past drawn strategies they want to leverage on the blue economy. But when you look at how efficient would you say these strategies are? You know, what is not being done and what can they do different?
I think the problem that we have in Kenya in terms of policy towards the blue economy is that we've had so many fragmented policies and no integrated policy, so to speak. So as we stand currently, or as we are speaking currently, you realize Kenya is close to 7 or 8 different policies touching on the blue economy. You have the National Maritime Policy, the National Oceans and Fisheries, Wetlands Policy, Integrated Coastal Zone Policy, Integrated Ocean Policy, Mentioned Shipping, and Kenya Coast Guard policy, just to mention some a few. And those are all different policies touching on things that are on the blue economy. So I think the first thing that the Kenyan government needs to do, which I think it's a process that they're currently going through, is to actually come up with an integrated blue economy policy, which becomes one document that everyone follows for them to actually start benefiting from the blue economy. Because currently the blue economy in Kenya contributes only $1.8 billion according to the last figures that I have, and mainly looks at tourism, maritime transport, and fishery, where we are not even that efficient at it. So even as we come up with an integrated policy, that policy should definitely, number one, touch on increasing the human capital, the skills that are needed for the blue economy. For example, Kenya does not have skills or sufficient skills in deep sea fishing. It does not have skills in ship and boat building or repairing, or even container repairing. So if you're just looking at the cheaper things that the government can put in some resources in, you realize that we lack quite a number of human skills there. The second thing that is lacking there is infrastructure around the large water areas. So in terms of fish processing and the whole value chain that comes along with that, the infrastructure is not there. At some point in time, last year, Kenya was importing fish from China, which is like a complete embarrassment, so to speak. So the policy that needs to come up, which is an integrated policy, needs to look at human capital, needs to look at the infrastructure around it. Then once the policy is put in place, then the annual budgets we need to start seeing the blue economy getting a share of that budget, because then without resources, without capital going towards the blue economy, then you realize that the whole value chain for the blue economy will not develop, and we will not be able to get the benefits that come out of the blue economy.
Yeah, so just a few days ago, Kenya actually said that they are going to set aside 12 billion Kenyan shillings to boost the country's blue economy. But would you say that this money is actually going to be addressing those challenges that you've just mentioned? Have they outlined the areas where this money will be invested in?
That's where the problem normally comes in Kenya. We are quick to throw money at things without actually sitting down and planning. So when I saw that, my question was, okay, 12 billion to do what exactly? Because if you don't have an integrated policy that has timelines, objectives, and key results that you want to meet, and you say by 2025 or by 2030 we want to be doing 1, 2, 3, 4, 5, and then we can now trace and say, okay, so this 12 billion is going to sponsor 100 students or 300 students to go to where they will learn maybe shipbuilding or ship repairing or deep sea fishing. Then we can start tracing that the money is actually going towards achieving the goal that they want to achieve in the blue economy. But without an integrated policy and a plan which they are following, then the 12 billion becomes money that is sunk again in another venture where you're saying, okay, 12 billion has been put, but how do we measure the effectiveness of 12 billion? Is 12 billion even enough for that? And how does this blue economy integrate with the rest of the economy? How does it feed into job creation? How does it feed into alleviating poverty? So how much do we need to then put towards that blue economy, and which areas are going to suffer a lack of resources because of moving money to the blue economy, and what is the multiplier effect that we're going to get from this side? So I think there's a lot of trying to show that they're doing something, but not really in an organized and planned way that we will be able to see results in a couple of years down the road.
So last year, President Uhuru Kenyatta ordered that all landing sites which have been grabbed to be repossessed back, and he's also said that majority of the landing sites are in the wrong hands when you look at the private developers. You know, where were they looking when the land got into the wrong hands, and then two, do they have like a proper guideline of how they're actually going to be repossessing the lands?
The problem with the current Kenyan government is that they make a lot of declarations that are never followed up with actions. And I'm 100% sure 2 years, 3 years down the line, if a new president comes in, you might end up hearing the same declaration. Have we seen them being repossessed? I have not seen much traction on that area.
That conversation takes us for a short break. When we come back, we'll look at Kenya's unemployment prospects for Q2, as well as news making headlines in Uganda. Stay tuned.
As Africa and the world face our biggest challenge in recent history with the COVID-19 pandemic, we must remember one thing. We are in this together. Your continent is fighting alongside each and every African, every step of the way. The African Union, chaired by South African President Cyril Ramaphosa this year, together with peer African leaders, has been hard at work to find lasting solutions that will ensure that Africa beats this and any future pandemics to come. Through their united efforts, the African Union has raised over $60 million. Africa has shown unity and leadership in protecting its citizens and managing the spread of the pandemic with world-class expertise and resolve. We have called for debt repayments to be paused and even cancelled, freeing up billions of dollars to fight COVID-19. Africa is united. Together, we will overcome.
On the next episode of The Secret Formula, we delve deeper into Coca-Cola's World Without Waste project and visit Extra Pet, the largest and most advanced recycler of PET bottle materials on the African continent.
If we are going to use a package, and this is across all our, beverage packaging, let's think about where will it end? It's not just about buying it today. After the consumer has used the packaging, what happens to it?
We also see how the company is rebranding their Sprite bottles from green to clear plastic and launching a new returnable bottle range, all in the name of minimizing the impact of plastic on the environment. The Secret Formula, Sundays at 9 p.m. Central African Time, only on CNBC Africa.
Welcome back. As the country prepares to open its skies, Uganda Airlines has developed routes in Africa and is set to join other airlines in the intercontinental market by December this year. Moreover, the country has put in plans to boost border infrastructure for regional trade. Economic analyst Charles Bogi joined us earlier on for more on that.
It has really affected it I would imagine significantly because, as you know, Uganda closed down. And by closing down, it meant also the airport not being functional, and that being the home of Air Uganda, definitely. It had an impact on the operation side of things. But on the planning side of things and all the other activities behind the scenes in the background, I think the reports we are picking from the administrators of the companies that they've been ongoing. In fact, as it is at the moment, we're expecting 2 Airbuses by December. And there are again aspirations of going intercontinental. That is looking beyond, the routes on the African continent. So yeah, on one side, operations have been affected, day-to-day operations, but the ambitions and the plans and the organization behind the scene seem to be still on track.
Yes, now we've seen Air Uganda began operations last year following collapse in 2001. What were some of the plans that they had put in place when you look at what they wanted to achieve, and how much has really been, how much have they really managed to accomplish given what is happening with the pandemic?
Well, I think, of course, at the start, part of the ambition was to get the planes. And were able to receive the Bombardier planes that came around. And then, of course, the other thing was now to open the routes, the different routes, which were opened at the time. So that happened. And the other, of course, was acquisition of more planes to actually begin, the operations, for the different routes and beyond the African continent, which, again, we are seeing from the reports we are getting from the administrators that actually it is on track to getting those Airbuses by December. There's been, at the beginning, it was mainly acquisition. Of course, that entire process was cut short by the COVID-19 impact, first of all, on the aviation industry, but then on the measures that were used to now control the COVID-19 pandemic, which is locking down the airport.
Yeah, recently the Ministry of Trade, Industry and Cooperative said that they commissioned the construction for infrastructure in order to create a stronger regional trade, to boost the regional trade here in East Africa. What are some of the things that the government of Uganda is actually doing in order to boost inter-regional trade?
Well, the catchword for the Ministry of Trade especially is that Uganda, despite the fact that it's is landlocked, is actually interlinked. And that interlinking notion is, draws currency from the fact that Uganda is centrally located within this region. It is a gateway into South Sudan, a gateway into DRC, a gateway into Rwanda. Then for those that are coming from this side, the eastern side, rather the western side, is also a gateway into Kenya and the others. So the aspiration is actually to make, the gateway into those markets a lot more easier to investors who choose to base their operations in Uganda, but even Ugandan business people who would want to explore the markets in those neighboring countries. So that's why you're seeing a lot of effort and, energy put into building infrastructure that leads to those neighboring states, whether DRC routes, whether South Sudan, Rwanda, and Kenya, and more. Yeah.
Yeah, you said Uganda is interlinked, but due to the measures to mitigate the spread of COVID-19, some of the countries went ahead and closed the borders. How has this affected the trade?
Of course, quite immensely in certain times, because access to these markets has been hampered a lot by those COVID-19 measures, because even the Ugandan government itself, instituted that lockdown. So yes, the impact, especially for those that are looking at exporting, it has really been quite immense. But on the flip side of things, government has been trying to promote the import substitution strategy, meaning that a number of producers are now trying to see how they can realign themselves to actually focus on the domestic market and try to cut, of course, the import bill by now focusing on serving the domestic market, because we have quite a huge import bill. As you are aware, our balance of payment is not really favorable at the moment because we import a lot more than we export, meaning that there is some space that can be filled, that can be covered domestically.
Now, if they look at more inward, we can also say that maybe the trade deficit is going to narrow. Have we seen statistics, figures that have been coming out of how trade deficits numbers are looking in the first half of this year?
Well, I'm yet to look at the numbers, but I know for the fact that still we are importing a lot more. But given the impact of the COVID-19, I'm sure that that gap has narrowed because, the pandemic has most importantly disrupted the supply chains. For instance, the processors, the manufacturers, the businesses that are relying on imports, let's say from China and the others, have been impacted. You don't have that smooth movement. So those items that can be sourced domestically are now being sourced domestically. But we'll wait for the numbers to really get a full picture of that.
Yeah, now when we look at the agriculture sector, it's one of the backbone sectors, if I may say, to Uganda's economy. We're seeing the numbers. Tea exports have also managed to rebound. Could you just give us a whole overview of how the sector is looking at?
Well, key exports did rebound. First of all, at the beginning of the pandemic, around March, I think, there was a closure of the Mombasa auction, which is the auction where all of us in East Africa actually auction our tea. That is Uganda, I think even Eastern DR Congo, Rwanda, Burundi, and of course Kenya itself. So they closed because of the pandemic. But then when they opened, of course we saw a rebound in terms of the volumes of tea that Uganda sells at the auction. Actually, this deep rebound was driven mainly by increase in volumes and production, again conditioned by good weather. Uganda enjoyed quite a fairly good weather run for most of last year and a good part of this year beginning.
Moving on to across the border, according to Kenya National Bureau of Statistics, nearly 3.17 million young Kenyans eligible for work or school are idle in the 3 months to June. The survey analyzed the labor market situation for the population aged 15 to 64 years for the period from April to June 2020. For what can be done to reverse this, we had a conversation with Alex Owiti, communication consultant.
This is the latest report that was released by Kenya National Bureau of Statistics for the month of April to June. And it's indicating that, the rates of unemployment has actually grown from 5.2% to 10%, that is. And this particular unemployment rate has been brought about by, by the COVID-19 situation, or the pandemic, if you like. And as a result, we've seen many parts of the country shutting down because, one, we've seen transportation being brought down. People are not able to travel, so that means that people in the transport industry, especially the aviation industry, cannot be able to, to transact. We saw guys who were using matatus, or if you like, our public transport here in Nairobi, we call it matatu. So most of the people had to reduce the numbers because of the measures that are taking to reduce the spread of COVID-19. So we find that the numbers, the matatus could carry, or the public transport could carry, up to half or 50% of the normal numbers that they would carry every day. And so even when the aviation sector resumed recently, we saw that there were also other strict measures that were put in place to enable people to travel. So the aviation sector, the hospitality sector has really been hit badly. And also the building and construction sector has also been hit badly because people have had to go home. So this is the situation that we're seeing right now. And at over about 10%, and when you compare it with the global unemployment rate of 5.4%, this shows that things are really severe.
Yes, and how much of a shadow does it really cast when you look at the rates of unemployment vis-a-vis the country's economic plans?
Given that our economy was intimated to grow at close to 6%, and this has really gone down, we're expecting almost 2% growth this year, according to World Bank reports. You realize that with this kind of unemployment rate, which is also reflected in the global economic rate that we're seeing today, it means that the economy will not grow as much as expected. Probably in the second half of next year, probably is when we'll start seeing a bit of changes, because we've seen a bit of resumption of economic activities, especially when you look at the aviation sector. Certain measures that have been put in place for the hospitality industry when President Uhuru Kenyatta talked last time, and he said, people can be allowed to sell alcohol in some of these hotels, which of course, with the rest of the country, they're not allowed to sell drinks or part of the bars and the restaurants. So that means that a majority of the people who work in this particular sector have to forego, employment, or even, they're without employment totally.
Yes. Now, looking at the statistics, the formal sector generated about 78,000 new formal jobs last year, but comparing to informal jobs, it stood at about over 700,000 in the same year last year. Would you say that the government is looking at towards empowering the key players in the informal sector?
You know that most of the people are employed in the informal sector, and even from the small, medium enterprises, if you like. You realize that some of these sectors have really been affected badly. There is no funding that is coming in to boost their businesses. If you remember, the President Uhuru Kenyatta actually directed that some of these businesses be given back their VATs so that they can plow back into their businesses. But is that enough when the larger part of the economy does not even have a buying power for some of those goods or services, if you like? So the situation is still not looking good. It's still gloomy. But we hope that if at all the numbers will continue going down the way we've seen in Kenya, then it means that economic activities will resume and probably people will start getting jobs, or the numbers will start growing in terms of employment. Because remember, we are looking at a number that has grown from 2.3 million to 4.6 million of unemployed people because of COVID. And COVID is just, I would say it was the last nail on the coffin because the economy was not even performing very well. And people had already started losing their jobs from certain sectors. So this is just the situation that we are currently facing. And we're hoping that the measures that the government is trying to put in place will try and help the situation.
You're saying the World Bank as well as the African Union and other institutions have come forward to actually sensitize and encourage investments to be put into the agriculture sector in order to prevent rural-urban migration, or rather reduce actually the rural-urban migration. When you look at Kenya, some of the sectors that the government is putting much efforts in, would you say that this is one of the areas? Or what are some of the sectors that they should be changing their attention to?
Agriculture definitely is one of the major backbones for this country. And we've seen a situation whereby the activities within the agricultural sector has been going on very well, especially from domestic or substantial farming, if you like. But for commercial purposes, that has been hindered by the global measures that have been put in place. Remember, people are not traveling. From March up to the other day when the aviation industry resumed, people were not able to export, people were not able to import goods. But now with the measures that are being put in place by governments across Africa to kind of resume the economic activities, we believe that this could see the agricultural sector starting to export some of the agricultural products. And this is where the youth, actually, when you look at the unemployment rate that is currently there, over 20% of the youth within this unemployment rate are actually heavily affected with this particular COVID situation that has rendered them unemployed. So definitely agriculture becomes one of it. But secondly, the informal sector needs to be supported. Government needs to put in place some of the incentives or some of the funds that we've seen, like the youth fund that has been around. We've seen in Kenya, there's what we call Kazi kwa Vijana, or a sort of like a program that is put in place to support the youth who are unemployed to kind of sustain themselves.
That brings us to the end of today's episode of Power Lunch East Africa. You're with me, Narengwa Fiona Muthoni. If you have any questions, suggestions, feel free to write to us on Twitter at CNBC Africa. Use the hashtag PLEA410, or you can tag me directly at Fimuthoni. For more on what is moving and shaking the East African market, join us later on today at 4 p.m. CAT on Closing Bell East Africa.
In challenging times, it is easy to forget what ignited your passion for business. Remember when you were a dreamer, a change maker, a job creator. Recall the promise, the rush, the prospects of success, and the dawn of a brighter tomorrow in the absence of isolation. The new reality of today requires a reboot, a reimagining, and a redirection of ideas. Let's reload opportunities, reimagine growth, renew connections, redirect conversations, regain advantage, revive this economic powerhouse, reignite Gauteng. In us, you have a partner who can open doors, connect you to opportunities, and unlock Gauteng's dynamic possibilities. Remember GGDA.
Welcome to Powerland South Africa on this Friday afternoon. We've got a packed show for you today. It's been a very, very rough week in business, but we're still standing. From me, hello, Chris Bishop.
And from me, Zinati Kuma, it's hello. So yes, it has been a rough week with Eskom and load shedding, and I'm just concerned as to how that's affecting businesses that have actually fought tooth and nail to survive through COVID-19. But we've also got results. We've got Truworths, we've got Fortress, and we've got Spur deferring their interim dividend payment even further. We're going to be finding out about that from our Market Watch, and then we'll be having Fortress in for their results, and also we'll be talking a business confidence. But before all of that, let's take a look at your top stories.
So Retail Group SPAR has named the managing director of its South Rand division as the new group CEO with effect from March 2021. Brett Botten is a qualified chartered accountant and has been with the group since 1994, serving as the MD of SPAR's South Rand division from 2010. Botten will be replacing Graham O'Connor after the group's 2021 annual general meeting, and O'Connor is then expected to become board chair.
Now, the COVID-19 Relief Fund's audit has exposed the excessive amounts of fraud and irregular spending of the funds by government employees and institutions. The report has noted that the processes of releasing funds were flawed with a lack of oversight from officials and institutions. Reuters reports.
Money from South Africa's multi-billion-dollar COVID-19 relief package, set up to help the most vulnerable affected by the pandemic, may have been fraudulently paid to improper beneficiaries.
A massive social and economic support package.
That's the assessment of the country's Auditor General, Kimi Mokwetu. The relief package totals 500 billion rand, or $30 billion US. And Mokwetu said analysis of 145 billion rand of expenditure intended for programs like unemployment and poverty grants had identified, quote, indicators of a higher risk of fraud and abuse of funds. He described an increased risk of payments to ineligible beneficiaries, overpayments, underpayments, the invalid rejection of beneficiaries, fraud and double dipping, and said payments to 30,000 recipients of the 350 rand unemployment grant required further investigation. Reports of suspect deals between government officials and businesses providing medical equipment or food aid parcels for the poor, as well as alleged mismanagement of the disaster package, have sparked public outrage. Mokwetu's report says some government departments paid more than double or even 5 times the prescribed price when buying personal protective equipment. In a separate briefing, South Africa's Labour Minister said the Commissioner of the Unemployment Insurance Fund, responsible for paying out jobless claims, had been suspended along with 3 other executives as a result of Mokwetu's report. The corruption allegations have heaped pressure on President Cyril Ramaphosa, who had pledged to clean up his African National Congress Party's reputation, following decades of scandals under predecessor Jacob Zuma.
There's some of the controversy swirling around the UIF and the payments that are being made during these difficult days of COVID-19. Now, joining us to discuss the market is Lance Williams, the Managing Director at iCapital. Lance, and I'm sure you, I and Zinati weren't the only people sitting in the dark last night. Eskom is back on load shedding and it doesn't look good.
No, not at all. Good afternoon, Chris and Zinati. Yeah, it's really couldn't come at a worse time. We've exited the hard lockdown in level 2, and we greeted with load shedding. So it really is worrying. It's going to further hamper economic growth and any kind of recovery for the South African economy, which has been totally battered by these lockdowns and COVID-19. So it really is. The outlook for us is really tough and really unclear. As we were finding our feet, we seem to have just hit another wall here. So it's going to really take a lot of work to get this right. I think that's dawned upon people, but also just sentiment in general, locally and internationally. It really is going to put a dampener on that. And so the recovery is going to be an even longer, harder slog. And I think we've got to be really resilient in this environment.
And talking about sentiment, Lance, the rand has weakened this morning, and of course Eskom is not doing the rand any favors, but that's also ahead of US jobs data coming up. What can we expect from that?
Look, I think the US economy did have a nice bounce, and now it's settling down again, where you'll see those figures worsen. Unfortunately, there has been a sort of second spike in many countries, and the US sort of has had that. So the lockdowns eased, and then they had to harden them again, and you'll most probably see that coming through in the jobs figures, where some of the euphoria of that has passed by. But these numbers are quite volatile week on week, and so it's difficult to see a pattern. The rand, funny enough, is stronger this morning, and I think it's more dollar weakness, unfortunately, rather than rand strength for us. But look, I guess we'll take what we can get.
So, Lance, in the show today, we've got Steve Brown, the CEO of Fortress, coming in. It seems that they've been battered by this COVID-19 lockdown and not looking as secure as fortresses should do. And it seems that they have got a backup plan, though. I mean, what's your take on the company?
So it's interesting that they most probably fared a little bit better than most REITs. And the whole REIT status is quite interesting because there's a minimum dividend that these REITs need to pay out to maintain their REIT status. And so there's a lot of scrambling around getting authority to pay out lower dividends as a result of these results, because they're all looking to conserve cash. And that's just in general of the whole of corporate South Africa, where you're seeing a lot of dividends passed for companies. So they got some nice sectors, logistics, which is quite defensive, and that's most probably grown with the e-commerce. But they've also got quite a big listed portfolio in other property companies, and that they had to mark down dramatically, which actually pushed them into a loss. So, yeah, the commercial property, I don't think will ever be the same. Some is better, but office space, I think the demand is most probably going to drop. There's an oversupply, and you're going to see an increased work from home going forward. So they're going to have to do a bit of portfolio restructuring. But as I say, maybe a little bit more better off than some of the other property companies.
Now, Lance, Truworths coming out with results. You can just walk us through the key factors there. And also, I just want to ask, so Truworths CEO Michael Marks says the retailer struggling UK footwear, that's Office, is worth saving. Do you think it is? And secondly, Michael Marks been at the helm since 1991. Do you think it's time for a change in the executive team and the strategy?
Well, the strategy, it's difficult to change that. They did put a big stake in the ground, along with other South African companies going into the European market, in this case, the UK market with Office. And they've had to write down that investment. All the intangible value that they paid for Office has been written off. And so that had a marked impact, actually causing them to go into a loss. But I think the business most probably is worth saving. Office in particular seem to be pivoting quite nicely to online. Footwear is a type of product that can pivot online quite nicely. So I tend to agree with him. It would almost be throwing the baby out with the bathwater. And they've taken the pain where, as I said, they've written off all the goodwill on that acquisition. And I think a lot of South African companies have been forced to do that, but then you take the big bath approach where you just throw everything into the bath and sort of write off as much as possible so you don't have further write-offs going forward. So, yeah, it's a bit of a tale of two halves for Truworths, because the first half of the year was kind of pre-lockdown and the second half of the year was in the hard lockdown. So there's quite a pronounced change between the first half of the year trading and the second half of their financial year trading, and the second half much worse. So it'll be interesting to see how much they can recover. I think the consumer in general is under a lot of pressure, and they are going to feel that for quite a long time to come. Yeah, it's definitely time for a change in leadership, and I think there has been some announcements made in that respect.
Thank you very much indeed. That was Lance Williams, the Managing Director at iCapital. Thank you very much for your insights. Going to a short break now. When I come back, we'll be talking to one of the big banking bosses about high finance. Do stay with us.
Faces two challenges: dealing with the health crisis and rebooting the economy. The strategic focus for Gauteng is currently on smart mobility as an enabler. What can be done to rebuild the trust between public transport operators and passengers?
Given that the virus itself cannot spread on its own, it needs humans to move it from one place to another. And because public transport is often in a confined space, it really presents many challenges.
Probably about 20% of our passengers don't have access to cars. Is that every single one of them has obeyed the directives that have been given. They've worn masks, they've sanitized, they've maintained very good social distancing on this. And for us, it's been about being able to accommodate the numbers and be sure that however many people arrive, we can transport them as safely as possible.
As a regulator, as part of the support we're giving to operators in this instance, we've been assessing their safety plans, and we are obviously putting a key focus on ensuring that there is safety and security of their assets, primarily, but also the safety of the passengers.
Welcome back to Power Lunch South Africa. Now, South African President Cyril Ramaphosa's call for an institutional cleanup was heeded by the Auditor General this week with a bombshell report that has been top management of the Employment Insurance Fund suspended due to fraud and financial mismanagement of the COVID-19 relief funds. But on a positive note, the COVID-19 crisis could provide much-needed policy and systematic change as pressure mounts on government and businesses to become more compliant and transparent. This is according to Murtaza Mulvi, the head of financial markets at Standard Chartered Bank, and he joins us for more on this. Now, as I was saying earlier, Murtaza, I am especially worried about businesses that have been battered by the COVID-19 pandemic. They fought tooth and nail to survive the pandemic, and now they've been hit by load shedding. What is your business outlook?
Good afternoon, and thanks so much for having me. I think, as you said, I think load shedding is not something which can either result in higher business activity or give business the confidence they need to move forward. But something that you mentioned earlier on, in the fact that, given the pandemic, there has been a massive drive by both corporates and government to make sure that they use this opportunity to get much leaner, much more effective. And I think going through the pandemic, giving the kind of oversight from the government, add onto that the amount of investment coming from abroad, all leads to a lot more oversight, both from the government and the corporates, in order to clean. When I say clean house, I mean get more efficiencies in place to actually manage through the pandemic.
I mean, on the one hand, it's this brave new world we're facing post-COVID-19, whatever that will be. It's a good thing. There's going to be a lot more, obviously, competition for business as many people struggle. One would like to think that only the clean and only those that eschew corruption will survive. But are we just being idealistic here and thinking this?
I have a different point of view, and I'm, do give me a couple of minutes, because I do think people are, there is a lot of talk around the unemployment rate, and the lack of business activity, which is quite evident over the last couple of months. But if you look a little bit further and you try to decipher the information coming through, and I'll tie it back to why I think it is a good opportunity for businesses. Inflation is at its lowest it has been over a 10-year period. This is, a great opportunity for prices to correct, for essentials to be much, much more affordable in an environment where there is this relentless upward pull on prices. So that is great. You've probably clocked the largest trade surplus over a 10-year period. I think shy of 40 billion rand. Exports are up. Yes, imports are up too, but overall it's looking extremely healthy. Retail sales, even through the pandemic and post the pandemic, have been extremely consistent and strong. And lastly, and probably the most important part, and tying it back up to why corporates should not only be looking at the headline numbers. Manufacturing PMI at 57 plus 57 is probably the highest factory activity we have seen over a 10-year period. So, there is this natural life cycle of some corporates coming to the end of shelf life, but also the activity clearly indicates there's a lot more to play for, and hopefully get the corporates a bit more efficient and much more competitive.
Yesterday, IHS Markit released some PMI data, basically showing that South African private business sector activity had contracted for the 16th straight month. And that also emphasizes economic weakness from even before COVID-19. And I do understand that you've said there is fertile ground for changes to be made, but what are those changes that need to happen?
I think, as you mentioned, I think changes have to be. Please, when I highlight the positives in the economy, that doesn't take away from the fundamental changes that need to be made. Oversight, accountability, and the amount of emphasis on as we manage through COVID, of mismanagement. I think these need to be addressed. It doesn't take away from what needs to be done by government in communication and putting in steps where corruption is addressed. But I do think there are a lot of work streams going on where we are seeing, there were challenges pre-COVID, which are not going to go away just because of COVID. But I do think there are green shoots, and I do think activity is picking up. And if you want to tie it back up to how the markets see it, we have seen, the rand come back, we have seen bond yields come back, we have seen the stock market come back. So there is an inherent trust in the system and the central bank. But yes, there has to be a lot more done around accountability and management of funds. Absolutely.
Thank you very much indeed. That was Murtaza Mulvi, the head of financial markets at Standard Chartered Bank. Let's have a quick check-in on your markets. Company news now, and property group Fortress has declared a reduced annual dividend for its A and B shareholders and a headline loss of 161.5% as it withstood difficult trading period, to say the least. The group reported robust rental collections and a healthy balance sheet as it was in a strong position before the crisis. Now, joining us to unpack more is the CEO of Fortress, Steve Brown. Yes, it seems you've got a backup plan, which we'll talk about a little bit, but just give us an idea of how badly Fortress has been battered in the last 6 months of COVID-19.
Yeah, look, I think, our financial year ended in June. It was really a story all about the last quarter of the year when we went into the hard lockdown. So our property values at year end on the 30th of June took a bit of a knockdown, 4.7%. And then what really did hurt us was the mark to market on our shareholding. We've got 23.3% of Nepi Rockcastle. So that also did hurt quite a bit. And obviously that mark to market, as you said, does go through the income statement. But I think a couple of positives. We've looked back, as you said, over the last 5 months, April to the end of August of lockdown. We managed to collect 93% of our rent for that period and 97% for August. So I think there are, I mean, dare I say it, some green shoots, and things are looking slightly more normalized. And yeah, fortunately, we went into this pandemic with a strong balance sheet, and that has allowed us to weather quite a lot of the storm.
Now, you say that you reported robust rental collections, and I just want to know, is it because you were lucky that maybe most of those businesses were open during the stricter lockdowns? And also, are there any relief measures that you were involved in with some of your tenants?
To answer the second part, we gave our tenants across our portfolio relief of about 143 million rand, and that was deferrals and discounts. It was about 60% discounts, 40% deferrals. I think really what stood out compared to a lot of the other sectors is the defensiveness of our portfolio. We are overweight in really logistics real estate, which is mostly warehousing, and I think that did perform much better and slightly better tenant quality. And our retail, which is also a big component, about 35% of our portfolio, also was quite defensive. We've got 59 shopping centers, but not big malls, I think, which were slightly, I think the consumers were far more apprehensive to go and visit the big malls, but we've got more convenience centers, township centers, rural centers, and I think those were a lot more essential services, and I think have proved to be quite defensive through the lockdown. So yeah, I think we were quite fortunate with the composition of our portfolio.
And also, you do say green shoots. A lot of companies are coming on to CNBC Africa and telling us they are saying it's encouraging for the economy. But what about this fear of what everyone's talking about, from Edward Kieswetter at SARS to a lot of the CEOs we talk to, that there's going to be this tremendous debt crash a few months ahead down the line later in the year? What's your feeling on that?
Look, I think, the rand has been volatile. Earlier in the year, we had really a derivative product to get us some euro debt called a cross-currency swap, and we were quite proactive in closing those early in the year. So we repaid quite a lot of euro debt, and for the 6 months from December to June, we closed, essentially repaid all of our euro debt through the derivative at an average rate of 18 rand and 18 cents to the euro. Now it's sitting at around about 20 rand to the euro. So I think we were quite fortunate. I think the rand that rand impact is probably going to remain. I can't see it jumping back, just with the very low interest rates in South Africa now, which has been a bit of a little bit of a positive sign, us being a kind of interest rate sensitive sector, that they've cut the repo rate to record lows. But I think the counter to that is that the rand is unlikely to come bouncing back as we've seen in the past, because that carry trade is now just, so the economics have changed so much. So I think, we would share that view. I think we are possibly quite negative on the currency from here. But the issue with the corporate debt is the government debt is a major problem. I mean, I don't know how the powers that be expect to fix it, but if I could, apply it to like a corporate balance sheet, they've got too many costs, so they need to go and cut some costs, because the revenue line is looking like it's going to be hard to grow for the government.
Now, Steve, where do you see opportunities going forward, especially with the Africa Free Trade Continental Area coming to the fore, and as you grow your logistics portfolio?
Look, I think that is, I really hope it turns into a big positive. It's certainly getting, traction and heading in the right direction. As we've said before, with South Africa still having, the port infrastructure, the rail infrastructure, which hopefully, the move from road to rail happens, and still good highway networks, we would really be in a great position as an owner of warehouses and logistics real estate if South Africa could become more of a hub for the rest of Africa, because then I think we become less dependent in this asset class on SA growth, and we can sort of have a sector that really grows much bigger than just the domestic market. So I think that would be a huge positive. We haven't seen much of it yet. We do have some exporters in our tenant base. They're still doing quite well, and in fact doing very well because of the weak currency. So they're exporting a lot since the ports have been open. So I think, we're really hopeful that will, create a bit of demand for our big development pipeline, which is, we need to fill about 1 million square meters over the next 3 to 5 years. So we really need we need a lot of tenants to occupy that space.
Thank you very much indeed. That was Steve Brown, the CEO of Fortress, on the company's figures there. And that was Power Lunch South Africa for Friday afternoon. Do have a good weekend, and we'll be back on Monday.
Right, from us, the Power Lunch South Africa team, it's goodbye.
Goodbye.
يا ولد سأخبر أمك.
Attends que je le dise à ta mère. So put a mask on, or else we'll tell your mom.
From a tourism sector perspective, we have consolidated, put together with the industry and the sector what we deemed as a recovery plan for the province. If one considers the contribution of tourism in the province from a GDP perspective, you're talking about 18%, which translates to about 67 billion, seriously affected. One of the things that we have been acutely aware about it is that we need to have to box cleverly in this. So it's a smart marketing messaging, encouraging supportive messages to the general public so that people do not forget about the wonderful offerings that the province has to offer. So we've been planting messages in all the social media platforms so that people are able to keep in mind about the hidden treasures and the jewel that the Eastern Cape has to offer.